Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about the futures market. No, I know, it sounds super complicated, right? It's this massive, powerful part of the global economy that most people kind of shy away from. But here's the thing. It's all built on one surprisingly simple idea, and we're going to break it all down. So to really get a grip on futures, you got to ask, what problem were they even invented to solve? And it all comes down to a problem that anyone who makes or buys stuff has to deal with, not knowing what the price will be tomorrow. Seriously, think about that for a second. Put yourself in the shoes of a farmer. Your crop is still just a seed in the ground. Or maybe you're a manufacturer and your product is still just a pile of parts. The price for your thing might be great today, but who knows what it'll be in 6 months when you're actually ready to sell. That is the fundamental dilemma. And the answer to all that uncertainty? It's this really clever financial tool called a futures contract. The goal isn't to predict the future. It's actually about locking it in. Okay, so this is the official textbook definition. It sounds a little dense, but stick with me. A futures contract is, at its heart, just a promise. It's an agreement between a buyer and a seller to make a trade, could be for corn, could be for currency, on a specific day, way out in the future, for a price that they both agree on right now. Let's boil this down even more. Forget the jargon. Every single futures contract has these 3 basic parts. It's kind of like pre-ordering a new video game. You know exactly which game you're getting, you agree on the price today, and you know the date it's going to be released. A futures contract is the exact same concept, just for things like wheat, oil, or gold. To really see how powerful this is, let's jump into a classic, real-world example. We're going to follow the story of a cotton farmer who's staring that problem of price uncertainty right in the face. Picture this. It's April. Our farmer looks at the market price for cotton, and he is loving what he sees. It's a really, really good price. But he's got a big problem. His cotton won't be picked for another 7 months. He can't sell something he doesn't have yet. And you know what? He's right to be worried. He's hearing that it's going to be a huge harvest season all over the country. And when there's a ton of supply, what happens? Prices can totally plummet. If that happens by November, all of his hard work might be for nothing. So what's a guy to do? He's at a crossroads, right? 2 choices on the table. Option A is the gamble. Just wait it out, cross his fingers, and take whatever price the market gives him in November. Or there's option B, certainty. He can use the futures market to sell his November crop right now, in April, at that great price he sees today. Now, by picking option B, our farmer is doing something called hedging. And as this quote from our source explains, he's not trying to strike it rich. This is a defensive move. He's taking risk off the table. He is choosing a guaranteed price over a roll of the dice. Okay, that makes sense for our farmer. But how does he find someone to make that deal with so easily? I mean, who else is thinking about November cotton back in April? Well, it works because this isn't some one-off handshake deal. It's all happening in a massive, well-oiled market. The secret sauce, the real magic here, is one word: standardization. This is the simple but absolutely brilliant idea that makes the whole thing tick. It means our farmer doesn't have to go out and find a specific t-shirt company and negotiate every little detail of a contract. And this slide shows you exactly what standardized means in practice. Let's take a corn contract. Anybody trading this knows that one contract means exactly 5,000 bushels of number 2 yellow corn for delivery in one of these specific months. All the details are already set. That makes every contract totally identical and interchangeable. And because every single contract is a perfect clone of the next, you get something the pros call a liquid market. Think about it like a dollar bill. You don't care if you have this dollar or that dollar because they're all worth the same. That interchangeability means there's a constant, massive river of buyers and sellers, so you can make a trade pretty much instantly. And check this out. You can actually see that liquidity happening right here. The chart on top is the February gold contract. The one below is for April. Just look at those volume bars at the bottom. As the February contract gets close to expiring, you can see all the trading activity just seamlessly shifting over to the next contract, April. It's this constant rollover that keeps the market humming along. Okay, so we've been focused on one farmer and his cotton. But now, let's pull the camera way, way back. Because this exact same principle of managing risk is the invisible engine that powers huge, huge parts of our modern economy. Because futures aren't just about crops anymore, not by a long shot. They are everywhere. You've got futures on stock indexes like the S&P 500, on interest rates, on currencies like the euro, and on massive commodities like crude oil and gold. All of these affect everything from our 401ks to what we pay for gas. And this is the big takeaway, right? The very same tool our farmer uses to guarantee a price for his cotton, well, an airline uses it to lock in the price of jet fuel, which helps keep your ticket prices stable. A giant global company uses it to protect against wild swings in currency values. It's all the same idea. Take a scary, unknown future price and make it a sure thing today. So we've seen how futures were born from a need to manage risk, to bring certainty to an uncertain world. But that leads to a huge kind of mind-bending question. For every farmer trying to get rid of risk, there has to be someone on the other side of that trade who's willing to take it on, hoping to make a profit. So what happens when this powerful tool for managing risk becomes a source of high-stakes risk itself? Well, that's a story for another time.
Welcome to The Explainer. All right, today we are diving headfirst into the world of futures markets. We're going to break down what they are, who's in the game, and maybe most importantly, why they actually matter to you. Okay, let's kick things off with a bit of a brain teaser. How on earth can you sell something that you don't even have yet? Sounds kind of impossible, right? Well, it's a puzzle that people like farmers, big manufacturers, even airlines have to solve every single day. And believe it or not, the answer is fundamental to how our whole global economy ticks.
So, to get our heads around this, we're not going to start with some crazy formula or a complicated chart. No. Let's start with something real. Let's talk about a big problem that a cotton farmer might face.
Okay, so picture this. It's April, and the price for cotton is just fantastic. I mean, it's a price that could make her entire year. But here's the catch. Her crop won't actually be ready to sell until November. And who knows what'll happen between April and November? The price could totally crash. So what does she do? Just sit there, cross her fingers, and hope for the best? That's a huge, huge risk to take.
And this is exactly where this really clever financial tool comes into the picture. It's the answer to our farmer's problem, and it's the very foundation of the futures market. So, what is it? It's a futures contract. Think of it as a rock-solid, legally binding promise. It lets our farmer sell the cotton she's going to have in November, but she sells it today at a price that's agreed upon today. It's this incredibly powerful way to just eliminate all that uncertainty about the future price. Now, you might be thinking, couldn't she just do a handshake deal with someone? Well, she could, but that's what we call a forward contract, and it's risky. I mean, what if the buyer just backs out? A futures contract is different. It's traded on a big official exchange. That means everything is standardized, the exchange itself guarantees the deal so no one can back out, and this is a big one. It's actually really easy to get out of the position if your plans change. Okay, so this market isn't just for farmers. It's this whole ecosystem. And for it to work, you really need two key types of players, and they both have completely different reasons for being there. First up, you've got the hedgers. These are the people and the businesses who are actually producing or using the thing, the cotton, the oil, the corn. They're in the market for one main reason, to protect themselves from prices moving against them. So like we've been saying, our cotton farmer is a hedger. She wants to lock in her selling price. But on the flip side, you've got, say, a t-shirt company. They're a hedger too. They want to lock in the price they buy the cotton at. Or think about an airline. They need to know what jet fuel is going to cost them in 6 months. All these businesses need some level of price stability just to operate. And then you have the other group, the traders, or as they're often called, speculators. Let's be clear. These folks have absolutely zero interest in getting a truckload of cotton delivered to their front door. They're in this game for a completely different reason. And what is that reason? It's simple. They're trying to make money by betting on which way the price will go. That's it. They are, in essence, professional risk takers. Okay, so this is the absolute key to understanding the whole thing. You've got hedgers who want to get rid of risk, and you've got traders who are more than happy to take on that risk because they think they can profit from it. So our farmer who's worried about prices falling basically transfers that risk to a trader who's betting that prices will actually go up. It's this transfer of risk that makes the entire market function.
All right, so now that we know who the players are, let's talk about the rules of the game. How does this all actually work in today's fast-paced, electronic world?
The secret sauce here, the thing that makes it all work so smoothly, is standardization. Every single contract for, say, December corn is exactly the same. We're talking 5,000 bushels of number 2 yellow corn every time. It means you're not haggling over the details. It's like buying a can of Coke. You know exactly what you're getting. And because every contract is identical, they can be traded millions of times a day, just instantly.
And get this might actually blow your mind. For all this talk about corn and cotton and oil, less than 3% of futures contracts ever end with the actual stuff being delivered. So, what happens to the other 97+%? Well, traders just close out their positions before it's time for delivery. It's simple. If you bought a contract to get into a trade, you just sell that same contract to get out. No one's showing up at your house with a tanker of crude oil. You just settle the difference in cash, whether it's a profit or a loss.
This chart is a perfect picture of how the market stays alive. Look at those volume bars down at the bottom. See how on the top chart, for the February gold contract, the trading activity just kind of dies down as it gets closer to expiring. And then, look at the bottom chart. At the exact same time, all that energy and volume picks right up in the April contract. That's traders rolling their positions from the old contract to the new one. It makes sure there's always a busy, active market for everyone.
Okay, so if you want to trade, you need to place an order. The most basic one is a market order. This is you screaming, "Get me in now," or "Get me out now." You don't care about the exact price, you just want it done immediately. Speed is everything here.
A limit order is pretty much the opposite. This is where you're the one in control of the price. You say, "I will not buy for a penny more than this," or "I refuse to sell for a penny less than that." So you get your price, but there's a catch. If the market never gets to your price, your order just sits there and never gets filled. And then there's the stop order. This is your safety net. It's an absolutely critical tool for managing risk. You place it at a price where you've decided, okay, if it goes this far against me, I'm out. If the market hits that price, it automatically triggers an order to close your position. Think of it like a pre-programmed eject button to limit the damage.
So, I know this can all sound pretty abstract, right? Like something that only matters to traders in Chicago or New York. But the truth is, what happens in these markets actually has a huge impact on all of us every single day.
I mean, the prices that are figured out in these markets, they ripple out and affect the cost of, well, almost everything. The corn in your breakfast cereal, the price you pay for gas at the pump, the cotton in the clothes you're wearing. It even influences things like the interest rate on a mortgage. Because businesses can manage their risks using futures, it helps keep prices for the rest of us just a little more stable and predictable.
And this quote just hits the nail on the head. It basically says that for a farmer or an airline, the real gamble, the true speculation, is doing nothing. In a world where prices are always bouncing around, choosing not to protect yourself, to just hope for the best, is the biggest risk you can take. Futures markets give them a way to manage that risk. So that leaves us with one final thought to chew on. At their core, these markets are all about balancing risk and reward. And when you think about it, we do the exact same thing in our own lives, right? Whether you're saving for retirement, thinking about buying a house, or even just making a monthly budget. So the question for you is, when it comes to your own financial life, are you playing the role of a hedger, trying to manage risk, or are you a speculator?
All right, let's get right into it. We're talking about one of the biggest, oldest, most heated arguments in the entire world of finance. The big one, fundamental versus technical analysis. You know, this isn't just some beginner question. It splits legends right down the middle. And today we're going to try and get to the bottom of it all. And trust me, these guys do not pull their punches. Just listen to this jab from the fundamentalist side from Burton Malkiel. He says, "I have since made a rule never to eat with a chartist. It's bad for digestion." Ouch. Right out of the gate, he's basically saying technical analysts, the chartists, are so off their rockers it'll literally make you sick to your stomach.
But oh, the technicians fire right back. Legendary trader Ed Sakota tells this amazing story about dropping a knife, and it lands point down right in his fundamentalist friend's shoe. And when he asks his friend why on earth he didn't move his foot, the friend just says, "I was waiting for it to come back up." It's just a brilliant, sharp way of saying that fundamentalists can get so caught up in their theories that they'll ignore the painful reality staring them right in the face. So who is right here? Is one side living in a fantasy world and the other completely out of touch with reality? Well, that's what we're here to unpack. We're going to kick things off with the great debate, then we'll meet the contenders, pit two absolute titans against each other, look at how these strategies have gone in and out of style, and then, finally, we'll get to the final answer. Okay, let's start with Section 1, the Great Debate. The reason this argument just never goes away is because it's not some simple textbook question. As we're about to see, some of the most successful traders on the planet are on completely opposite sides of this fence.
So, with the stage set, it's time to actually meet the contenders. And to really get this, you have to understand that these aren't just different techniques. We're talking about two radically different ways of seeing the world. This is the absolute core of the whole disagreement. And this slide just lays it out so perfectly. On one hand, you've got fundamental analysis. These guys are trying to predict prices by looking at real-world economic stuff. Production, income, supply, demand. They're all about asking why. Why should this market go up or down? But then you have technical analysis over on the other side. They could not care less about the why. They are only looking at the price chart itself, studying the patterns. All they ask is what? What is the market doing right now? Two totally different philosophies. So now let's see how these theories actually work in the real world. Because these aren't just ideas in a book. They are the core beliefs of some of the most successful traders who have ever lived. So let's get ready for the ultimate showdown. First up, in the fundamentalist corner, we have an absolute legend, Jim Rogers. And I mean, his resume is just mind-boggling. He co-founded the Quantum Fund with George Soros. Only one of the most successful funds in history. Then he went off on his own and had incredible success, calling huge market events like the collapse of the Japanese stock market and the long bear market in gold. This guy is a heavyweight, no question about it. So what does this titan of fundamental analysis think about the other side? Well, he puts it about as bluntly as you can. I haven't met a rich technician. Whoa. He's basically writing off the entire field, saying the only people making money with technicals are the ones selling books and seminars, not the ones actually trading. But then there's this guy, the challenger, a man who got incredibly rich doing the exact thing Rogers said couldn't be done. Marty Schwartz, the technical titan. And this is why this debate is so good. Just look at this number. For 10 straight years, Schwartz's audited track record showed an average return of 25%. Not per year, per month. Think about that. Over 120 months, he had only 2 months where he lost a tiny bit of money. I mean, that is just an unreal performance. So naturally, when you ask Schwartz about this debate, his answer sounds like a direct clap back to Rogers. He says, I used fundamentals for 9 years and got rich as a technician. To him, the idea that you can't get rich using charts isn't just wrong, it's arrogant, because, well, he's living proof. So, here we are, right? You've got two unbelievably successful traders. Their views are complete polar opposites. So, who do you believe? How can they both be right? Well, to find an answer, we have to zoom out a bit and look at history. It turns out neither of these strategies is always on top. Their popularity actually moves in these big, sweeping cycles. This timeline tells the whole story. You see, back in the 70s, it was all fundamental analysis. Technical stuff was seen as like voodoo or hocus pocus. But then, in the late 70s, you had these massive trends in commodities, and simple technical systems just crushed it. Suddenly, everybody wanted to be a technician. By the 80s, the whole world had flipped. But then, in the late 80s, the markets got all choppy and erratic. Those big trends disappeared, and technical systems started to struggle. And guess what? Fundamental analysis came roaring right back into fashion. The big takeaway here is that no single style works best forever. Its effectiveness can really depend on the kind of market we're in. So, after all of that back and forth, what is the final answer? Well, it turns out the question itself might be the problem. It's not actually about the strategy. Because here's the truth of it. There is no single best method. It's just not that simple. You can be wildly, unbelievably successful as a pure fundamentalist, a pure technician, or even a mix of the two. And that brings us to what's called the hybrid approach. And frankly, a ton of the world's best traders don't even pick a side. They use fundamental analysis to decide what to trade, to find a market with a really compelling story. And then they use technical analysis to decide when to pull the trigger, when to get in and when to get out. It's really the best of both worlds. But right here, on this slide, this is it. This is the most important thing to take away from all of this. The one thing that just about every great trader has in common isn't their specific strategy. It's that they found a method that perfectly fits their own personality.
Some people are just wired for that long-term, big-picture thinking of fundamentals. Others are built for the fast-paced, pattern-matching world of technicals. Some people are day traders. Some hold for years. Some love chaos. Others need calm. Success isn't about finding the one right way to trade. It's about finding the way that is right for you. So that brings the question right back to you. After hearing about these two clashing philosophies, the titans who champion them, and what might be the real secret to success, what kind of investor are you? A fundamentalist? A technician, or maybe a hybrid? Something to think about. So, here's the million-dollar question. Can a simple price chart actually predict the future? You know, it's one of the oldest, most passionate debates in all of finance. And to really get to the bottom of it, let's kick things off with a classic story about a trader who was just at the end of his rope. So picture this trader. He's tried everything, every complex strategy you can imagine, and he's failed at all of them. Then he hears about this legendary guru living way up in the Himalayas. So after this long, difficult journey, he finally gets to the top of the mountain. He asks the guru, "Oh, wise one, what is the secret to successful trading?" And the guru just stares at him for a moment and says one single cryptic word: Blash. Blash. I mean, what on earth could that possibly mean? The trader is just completely floored. He traveled halfway across the world, climbed a mountain for this one piece of wisdom, and that's what he gets? Could this one weird word really be the key to everything? All right, so what was this big secret? Well, as it turns out, it wasn't some ridiculously complex formula. It was actually something that sounds like pure, simple common sense. But, and this is the important part, this is what we call the common sense trap. And when it comes to trading, it can be a really dangerous one. That's it. That's the whole secret. Blash just stands for buy low and sell high. It's probably the very first thing anyone learns about the markets. It feels so natural, so obvious. I mean, of course, that's what you do. But this is exactly where the trouble begins. Let's think this through. What happens when a stock or a market is just soaring, hitting brand new highs every day? Well, that little blash voice in your head is screaming, "Sell, it's high, sell high." But a market that's making new highs is showing incredible strength, incredible momentum. Trying to sell high in that situation is like stepping in front of a freight train. It's one of the quickest ways to lose your shirt. And this whole idea brings us right to the heart of the great debate. It's a real clash of the titans. In one corner, you've got the academics, who are convinced that price moves are totally random. And in the other corner, you have the market practitioners, who believe they can see the patterns of human behavior playing out on the charts. So let's meet our two fighters. First up, let's call him Professor Coin. He represents the random walkers. And his argument is actually pretty simple, but it's powerful. He says market prices are just random events. What happened yesterday or 5 minutes ago has zero impact on what happens next. For him, trying to predict the market from a chart is as useless as trying to predict the next flip of a coin. But in the other corner, we have Miss Trend, the chartist. And she fires right back. She says, hold on a second. Prices aren't random numbers from a lottery machine. They're the direct result of human decisions. And those decisions are driven by timeless emotions like fear and greed. And since human nature doesn't really change, she argues, its patterns can and do repeat. So the past can be a guide for the future. So there you have it. That's the fundamental disagreement right there. The random walkers look at the market and see a giant math problem governed by statistics. The chartists look at the exact same market and see a story about human psychology, full of messy but repetitive behaviors. It's really a battle between probability and psychology. And Professor Coin comes out swinging with his best evidence. He points to literally thousands of academic studies that have tested simple trading rules based on charts. And what do they find over and over again? After you account for costs, these rules almost never beat a dead simple strategy, just buying something and holding on to it. But Ms. Trend has a really sharp counterpunch. She says those studies are missing the point entirely because they're testing overly simple mechanical rules. Real chart analysis, she argues, isn't a science, it's an art. It requires intuition, experience, and the ability to put a lot of different, sometimes conflicting pieces of information together. And that's something a rigid academic test just can't measure. Okay, that's enough theory. Let's get to the real world. Professor Coin's big claim is that price charts are basically the same as a random series of coin tosses. Well, let's take a look at a couple of actual charts, and you can be the judge. Take a look at this. This is the silver market back in 1980. You see this absolutely insane, meteoric rise, followed by a total catastrophic collapse. Now I ask you, does that look random? A chartist would look at this and say, that's not random at all. That's a perfect picture of a bubble driven by pure human emotion. And that's not a one-off. Here's a look at the coffee market in 1994. Again, a similar story, an explosive, powerful trend that really seems to defy the laws of pure chance. It's these kinds of dramatic, unforgettable moves that keep this whole debate raging. So if the charts look so compelling, you have to ask, why hasn't one side just won the argument already? Well, it's because, at its very core, this is a debate that can never actually be settled. There's a fundamental problem that makes the chartist case impossible to prove or disprove. And here's the issue. To test something scientifically, you need a very strict black and white definition for it. But chart analysis is completely subjective. What one trader sees as a clear topping pattern, another trader could look at and see as just a temporary pause in an uptrend. It's an art of interpretation, not a science of measurement. You know, just take something super simple like a trading range. Try to write a mathematical rule for that. As you can see, you immediately run into a ton of questions. How wide is the price band? How long does it have to last? What do you do about a quick spike that pops out and then comes right back in? I mean, if we can't even get everyone to agree on a universal definition for a simple box, just imagine trying to write a concrete formula for a complex pattern like a head and shoulders top. It's basically impossible. So, if we can't scientifically prove that charts can predict the future, does that make them totally useless? Not at all. In fact, far from it. This is where we get to the practical power of charts, which is huge, even if you're the world's biggest skeptic about fortune-telling. Because look, whether they predict the future or not, charts are indispensable tools. They give you a market's entire price history in one quick glance. You get a gut feeling for its volatility, which is just another word for risk. And they're not just for chart geeks. A fundamental analyst can use a chart to see exactly when and how a market reacted to a big news story. But most importantly, they are a fantastic money management tool. A chart lets you define, very clearly, the exact point where your trade idea is proven wrong. That lets you set a stop loss to control your risk, which is, without a doubt, the most important part of trading. And all of this leads us to our final conclusion. After the stories, the debates, the theories, how should we really think about charts? The big takeaway is this. A chart is not a crystal ball. Its real value isn't in predicting the future with 100% certainty. Its value is in giving you a clear, visual map for understanding market behavior. It's a tool for understanding the past and, more importantly, for managing your risk in the present. And in that sense, charts have something to offer everyone, from the biggest cynic to the truest believer. So I'll just leave you with this one final thought. Since markets are really just a reflection of collective human action, all of our hopes, fears, and greed all rolled into one price, maybe we've been asking the wrong question this whole time. Maybe the point of looking at a chart isn't to see the future. Maybe the real point is to see ourselves a little more clearly.
All right, let's talk about financial charts. You've seen them. They can look like this confusing mess of lines and bars, right? But they're actually telling a story about the market. And you know what? By the end of this, you're going to know exactly how to read it.
Now, Bob Dylan probably wasn't thinking about commodity futures when he wrote this, but the line is just perfect for what we're talking about. See, in the markets, just like in life, there are signals all around us. The real trick is learning how to see them, how to feel which way the wind is blowing.
So that's the million-dollar question, isn't it? Well, the answer is charts. Charts are our weather vanes. They take millions of little data points and turn them into a visual story that lets us spot trends, see what people are thinking, and maybe, just maybe, get a sense of where things are headed next.
Okay, let's start with the most basic building block of pretty much every financial chart you'll ever see, the simple price bar. It sounds simple, but it's actually a little masterpiece of data packing.
I mean, think about it for a second. If I just tell you that a stock closed at $100, what does that really tell you? Not much, right? Did it soar up to 100, or did it come crashing down to 100? You're missing all the context, all the drama of the day. And this is the brilliant solution. That whole vertical line, that shows you the entire trading range for the day, from the absolute low to the absolute high. Then you've got this little tick on the left, that's your opening price, and the little tick on the right, that's your closing price. So in one simple little mark, you get the four most important pieces of information: the open, the high, the low, and the close.
Now, let's see it in the wild.
This here is a daily chart for soybeans. Each one of those vertical bars, that's a whole day of trading. It's its own little story of the battle between buyers and sellers. And when you string a bunch of them together, well, that's when the bigger story of the market really starts to take shape. Okay, this next idea is huge. It's a really powerful way to think about charts. I want you to stop thinking of them as just a static record and start thinking of them like a camera with a really powerful telephoto lens.
What happens if we make each one of those bars represent not just a day, but an entire week, or even a whole month? All of a sudden, you're zooming out. The little day-to-day wiggles start to fade away, and the major, long-term trends, they become crystal clear. This telephoto effect is an absolute game changer for getting the big picture.
Okay, you have got to see this. On the left, we've got a daily chart of coffee prices. And man, the story it's telling is pretty bleak. It's trending down, it just broke through an important price level. Honestly, it looks like it's about to fall off a cliff. But what happens when we use our zoom lens? The chart on the right, it's the exact same market, but now we're looking at a weekly view over several years, and it tells a completely different story.
See that? On the weekly chart, you can see coffee wasn't just falling into a void. It was coming down to a massive, multi-year support level, a place where huge rallies had started before. So the short-term view was screaming, sell, but the long-term view was whispering, hey, get ready for a big turnaround. And guess what? A huge rally followed. This is why I say perspective is everything.
So bar charts are great. They're the workhorse, but they're not the only tool in the shed. Let's look at a few other types of charts. Think of them like different lenses for our camera, each one designed to highlight something different.
On the left, you've got our old friend, the bar chart for gold. On the right, we have a candlestick chart. Now, they use the exact same 4 data points, open, high, low, and close. But the candlestick adds that thick part in the middle called the real body. If it's white, the price closed higher than it opened. If it's black, it closed lower. It just makes it super easy to see, at a glance, who won the day, the bulls or the bears.
And then you've got the simplest chart of them all, the line chart. This one just throws out the high, the low, and the open. It only connects the closing prices. Now you might be thinking, why would I want less information? Well, because sometimes all that up and down movement during the day, it's just noise. A line chart filters all that out and gives you a super clean, simple view of the most important trend.
All right, now for something completely different. This is a point-and-figure chart, and its main idea is kind of genius. It basically ignores time. It only makes a new mark on the chart when the price moves by a certain significant amount. A column of X's means the price is rising, and a column of O's means it's falling. That's it.
And the power here is just incredible. Look at this one column of O's here. That single column represents 7 full days from the bar chart. For an entire week, the price just kind of chopped around without really going anywhere important. The point-and-figure chart just ignores all that noise, waiting for the real significant move to happen. It is the ultimate noise-canceling headphone for traders.
Okay, before we finish up, I've got to show you a super common trap. It's a visual illusion that can fool even seasoned pros if they're not careful.
Just look at this top chart for cattle futures. See that massive price jump right there? Looks like a 6% gain in 1 week. Awesome! Any trader would be ecstatic. Except, that price jump, it never actually happened. It's like a ghost in the chart.
So what on earth is going on here? Well, it's all about how the chart is built. The top one, the nearest futures chart, just staples different contracts together. When one expires, it just jumps to the next one, which can create these artificial gaps. The bottom one, the continuous chart, is smarter. It mathematically adjusts for those gaps. So while it might not show the exact historical price, it accurately shows you the swings a trader would have actually experienced. The lesson? Always know what kind of chart you're looking at.
Okay, we've covered a lot of ground here. We've looked at bars, candlesticks, lines, even some weird X's and O's. We've zoomed in, we've zoomed out, we've even found some ghosts. So, how do you pick the right one? So let's just quickly recap the big ideas. We learned that every single price bar packs a ton of information. We saw how changing your time frame from daily to weekly is like a superpower for gaining perspective. We know that different charts, candlesticks, line charts, are just different lenses for seeing the market. And of course, we know to watch out for those fake jumps in certain futures charts.
And this really brings us to the most important point. There is no single best chart. Period. The power isn't in the chart itself. It's in you choosing the right lens for the question you're asking. Are you trying to see the big, multi-year trend?
A weekly line chart is probably your friend. Are you trying to analyze the minute-by-minute action? A 5-minute candlestick chart is what you need. It's all about matching the tool to the task.
And that's the real power here. Charts are not crystal balls. They don't predict the future. What they do is give you perspective. Just think about that coffee chart. The daily view looked like a disaster, but the weekly view showed a massive opportunity. So the most valuable question you can ever ask yourself when you're looking at a market is the one on your screen right now. What perspective are you missing? Thanks for joining us.
You know, when you look at a financial chart, you probably think you're getting the whole story, right? Well, today, we're going to pull back the curtain on a hidden flaw in the data, one that can make two charts of the exact same market tell two completely different, even contradictory stories.
Okay, so let's just dive right in. Take a look at this chart for corn futures back in 2013. I'm guessing your eyes go to the same place mine do, that insane cliff right there in the middle. I mean, around July, it looks like the price just completely fell off a table. So you have to ask, what happened? Was there some kind of record-breaking harvest that nobody saw coming? Did demand suddenly just vanish overnight? What in the world could cause a 24% price collapse in a matter of days?
And the answer is absolutely nothing. Yeah, that catastrophic event, it never actually happened. It's what our source material calls a phantom price move. It's a complete illusion, a ghost in the machine created by the way the chart was built. And that is what this is all about.
To get to the bottom of this phantom crash, we first need to talk about a pretty fundamental problem with looking at futures contracts over a long period of time.
So take a look at this. This is a chart for just one single futures contract. And notice how all the real trading activity, all that volume, is really only packed into a few short months. That's because most futures contracts have these really short, liquid lives.
And that's the whole issue right there. If you want to see what a market's been doing for years, a single 3-month contract just isn't going to cut it. So you're forced to stitch them together, one after another, to create a long-term picture. But it's how you do that stitching, that's where everything can get really weird.
So, it turns out there are two main ways to link these contracts together, and each one comes with a huge trade-off. Let's meet the contenders.
First up, we've got nearest futures. Now, this is the simple way. When one contract is done, you just start plotting the price of the next one. It's easy for sure, but it creates a massive problem. You get these huge, totally artificial price gaps between contracts, and that's exactly what we saw in that first corn chart.
The second method is called continuous futures. This one's a little smarter. Instead of just jumping from one price to the next, it actually adjusts all the historical data to smooth out those gaps. The whole point here isn't to show you the exact price level from the past, but to preserve the real price moves, how much it actually went up or down.
Let's just quickly break down how that works, okay? So imagine June gold is trading at $1,200, and the next contract, December gold, is at $1,205. That's a $5 gap, right? Well, to make a continuous chart, you'd basically shift all of the past data down by $5. It's like you're mathematically pasting the charts together to make one seamless line.
And this, right here, brings us to the fundamental showdown. When you build a long-term futures chart, you have to make a choice. Do you want to preserve the actual price levels, or do you want to preserve the actual price moves? Because you can't have both.
I just love this quote from the source material. It nails the dilemma perfectly. A chart can show you what the price was, that's the level, or how much it changed, that's the move. But it can't do both at the same time. It's a coin toss, and you have to pick a side.
And here you can see the difference in black and white. On the left, that's our original corn chart with the huge 24% phantom crash. And on the right, the continuous chart of the exact same market during the exact same time. Poof, the crash is just gone. All that's left is a much smoother and, frankly, more realistic-looking downtrend.
Now, if you thought that was a big difference, check this out. This is lean hogs. The nearest futures chart on the left looks like pure chaos. It's got spikes, gaps, crazy volatility. You might think the market was having a total meltdown. But then you look at the continuous chart on the right, and it tells a totally different story. A clear, steady uptrend.
And that's not me being dramatic. As the author points out, if you took the labels off, you'd probably never guess that these two charts were showing the exact same market. The difference is just that profound.
So, case closed, right? Continuous charts are obviously the winner. Well, not so fast. Remember that mathematical adjustment process? By constantly shifting the historical data, you can end up with prices that are totally artificial or even impossible. Look at this gasoline chart. The historical prices actually go negative. Gasoline has never had a negative price. That's a ghost created by the adjustment.
So this all leads us to the analyst's dilemma, the big takeaway question: which chart are you supposed to use? And the answer, really, is that it depends completely on what you're trying to figure out.
Let's just break it down nice and simple. Nearest futures, the ones with the gaps, they preserve the actual price levels. So they're your go-to if you're trying to find real support and resistance zones. But if you're analyzing trends or backtesting a trading system, you need the accurate price moves you get from a continuous chart. They're just different tools for different jobs.
So the next time you pull up a long-term chart, you'll know to ask that crucial question: am I looking at real price levels or am I looking at real price moves? Because knowing the difference, well, that's the first step to finally seeing the true story the data is trying to tell you.
Welcome to The Explainer. All right, today we are diving deep into one of the biggest, most fundamental concepts in trading: market trends. You hear about them all the time, right? Well, we're going to break down what they actually are, why the way as most people spot them can be, well, kind of misleading, and then we'll check out a much more systematic way of looking at the whole thing.
You know, there's this great quote from the legendary trader Ed Seykota that just hits the nail on the head. He said, "The trend is your friend, except at the end when it bends." It's brilliant, right? It perfectly captures this double-edged sword. Trends are your best friend until they're not. And the real trick, the million-dollar question, is figuring out when that bend is coming.
Okay, so let's get down to brass tacks. How do you even know you're looking at a trend? What are the signs? Well, the most basic way, the way everyone starts, is by just looking at the shape of the chart, specifically the peaks and the valleys. You'll hear traders call these relative highs and relative lows.
So let's talk about an uptrend. Honestly, the easiest way to think about it is like a staircase going up. The price goes up, hits a new high, pulls back a little, but, and this is the key part, it doesn't fall as far as it did last time. Then it climbs again to an even higher high. Higher highs, higher lows. That's the rhythm, just like climbing stairs.
And here's a perfect example of what that looks like in the real world. This is the US dollar index. See those points labeled RH for relative high and RL for relative low? You can literally trace it with your finger. Each peak is higher than the last one, and each little dip, each RL, is higher than the one before it. It's a beautiful, clean uptrend that went on for almost a full year.
All right, so what about a downtrend? Well, you guessed it, it's the exact opposite. It's a staircase going down. The price tries to rally, but it just can't get back to its old high. That creates a lower high. Then it sells off and drops to a new low, a lower low. That's the pattern: lower highs and lower lows.
And you can see that pattern playing out right here with Euro futures. Every little bounce just runs into a wall that's lower than the previous one, and every time it drops, it carves out a new bottom. It's a textbook example of a market in a sustained downtrend.
Okay, so we've got the whole higher highs, lower lows thing down. But there's another way people try to spot trends, and it's probably the most famous tool in the entire technical analysis toolbox: drawing that simple, elegant trend line.
The theory here is super simple. You just connect the dots. If you think it's an uptrend, you draw a line connecting the lows. That line acts like a floor, or what traders call support. If it's a downtrend, you connect the highs, and that line acts like a ceiling, or resistance. The goal is to get this nice, clean visual boundary for the price.
I mean, look at these charts. On the left, you've got the NASDAQ just bouncing perfectly along that support line. And on the right, crude oil just keeps hitting its head on that resistance ceiling. It looks so neat, so predictable, right? Almost too good to be true. And, well, that's where the problems begin.
Which brings us to a huge, huge problem with trend lines: the problem of hindsight. See, anyone can be a genius when they're looking at a chart of the past. Drawing the perfect line is easy when you already know where the price is going. So let's put ourselves in the shoes of an analyst back in early 2013. You see the lows from November and December, you connect them with a nice, clean line, and you feel pretty good about it. The rule seems simple. As long as the price stays above my line, we're in an uptrend. Easy peasy.
But then, oops. Just 2 months later, the price crashes right through your perfect line. That should have been a massive sell signal, right? But what happened? The market just kept going up. So what does our analysts do? They just kind of shrug. All erase the old line and draw a new, flatter one that fits the new data. Problem solved, I guess.
And if you fast forward a year, you can see this keeps happening. The line gets broken, so you draw a new one. That one breaks, you draw another one. This is the core problem. It's what I meant by the hindsight bias. In real time, these lines are constantly failing, and you're always redrawing them to fit what just happened, not predict what's next.
So here's the bottom line. Trend lines are super subjective. You and I could look at the exact same chart and draw completely different lines. So it begs the question, is there a better way? Is there a more objective, more rules-based approach to this?
Well, it turns out an analyst named Thomas DeMark was so frustrated by this exact problem that he decided to build a completely different system from the ground up, one that takes the guesswork and the artistry out of it. So DeMark basically threw out the old rulebook. He said, forget about a subjective best fit line. His method is all about being objective and precise. Instead of trying to connect a bunch of points, his lines connect exactly 2 points. And here's the really wild part. He drew them from right to left, from today backwards into the past, because he believed recent price action was way more important.
His system is called TD lines, and it's designed to remove all the guesswork. First, you have to mathematically define what a peak or a valley even is. You do this with a parameter n. So, for example, you could decide that a true market low has to be a day that's lower than the 5 days before it and the 5 days after it. In that case, your n is 5. Once you have these clearly defined points, the rule is simple. Just connect the 2 most recent ones. No feelings, no art, just rules.
And what you get is this really cool dynamic process. Check out this chart. You see lines 1, 2, and 3? As the market creates new, qualified lows, the trend line just automatically redraws itself. The analyst's opinion about where the line ought to be is totally gone. The system does the work. So that's it, right? Problem solved? We've got an objective, rules-based system? Well, not so fast. It turns out that even this super systematic approach introduces a brand new, hidden variable. We fixed one problem, but we've stumbled right into another one.
Because that whole beautiful system, it all hinges on one tiny choice, that parameter, n, the number of days you choose to define what a high or a low is. And look what happens when you change it. This is the exact same chart. I want to repeat that. It's the same gasoline chart. On the left, we used an n of 10. The result? 3 nice, smooth, long-term lines. Looks pretty clear. But on the right, we just changed n to 2, and the chart just explodes into 21 different trend lines. It's capturing every tiny little wiggle. So think about what we've done. We got rid of the subjectivity of where to draw the line, but now we have a new subjective choice. How sensitive do we want our analysis to be? A big N gives you the big picture, a small n gives you all the noise. So which one is the right one? And this really gets to the heart of the matter. Whether you're drawing a line freehand or using a complex, rules-based system, you are making a choice. And that choice fundamentally changes what you see. It's a powerful reminder that these tools are lenses, not crystal balls. Which leads to the final fascinating question. When we draw these lines, are we really analyzing the market, or are we just analyzing the choices we ourselves have made?
Have you ever found yourself just staring at a chart, pulling your hair out because the market is just stuck? It's grinding sideways, going absolutely nowhere. Well, you are not alone. Today, we are diving deep into one of the most common and, frankly, most frustrating environments a trader can face, the trading range.
You know, this quote from Edwin Lefebvre it hits the nail right on the head. It perfectly captures the psychological trap that makes these sideways markets so incredibly dangerous. It's that little voice in your head, that nagging feeling that you have to be doing something, that you must be trading.
And it's that exact compulsion, that Wall Street folly, that leads so many traders into some really tough spots, especially when the market isn't giving us those big, obvious trends.
Okay, let's just get this out there. It's a simple and kind of brutal fact. Most of the time, markets are not in those huge, exciting trends we all love to see. Nope, they're chopping back and forth, going sideways. We call this a trading range, and this is the danger zone. This is precisely where most traders end up losing money.
All right, so let's get specific. Let's roll up our sleeves and really decode this thing. What exactly is a trading range?
So here's the textbook definition.
The easiest way to think about it is like a box drawn on your chart. The price keeps bumping its head on a ceiling, we call that resistance, and bouncing off a floor, which we call support. It just gets trapped inside this corridor, for a while anyway.
And that right there is the million-dollar question, isn't it? What in the world does an extended period actually mean? It's kind of vague because it can mean wildly different things. Let's look at two completely opposite examples to see what I'm talking about.
So on one hand, a range can feel like it lasts for an eternity. I mean, look at this weekly chart of silver. For pretty much the entire decade of the 1990s, the price was just stuck. It was bouncing around in this channel. Think about that, years of this sideways grind. Now let's flip the script completely. Check out this 15-minute chart of the euro. Here, the trading range lasted for just a few hours before the price absolutely exploded to the upside. And this shows us something so important. This pattern is what we call fractal. It shows up everywhere, on every single time frame, from years all the way down to minutes.
So this brings us to a really crucial point. If trading inside that frustrating, choppy range is a losing game for most people, then where's the real opportunity? Well, it's not in the sideways chop. It's in that moment the price finally breaks free.
This is the signal we're all waiting for. When the price finally escapes that horizontal box, it's a huge clue that a new trend might be kicking off. A break to the upside suggests we're going higher, and a break to the downside suggests we're headed lower.
Right, but here comes the really tricky part. Anyone who's been trading for more than 5 minutes has been burned by this, the false breakout. You know the one. The price just pokes its head out, convinces you to jump in, and then bam! It snaps right back inside the range, leaving you trapped. So how can we try to tell the difference? How do we stack the odds in our favor?
Well, according to our source material, not all breakouts are created equal. Far from it. There are 3 key characteristics we can look for that really help us figure out how reliable and, how significant a move might actually be.
And here they are, the big 3. Number 1 is duration. How long has the price been stuck? Number 2 is narrowness. How tight and quiet is the price action? And number 3, the trickiest one, is confirmation. Do we have actual proof that this move is for real? Let's break them down one by one.
First up, duration. The logic here is actually super simple, but it's really powerful. The longer a market goes sideways, the more energy, the more pressure is being built up. It's like a giant tug-of-war, where neither the bulls nor the bears can get an edge. The longer that battle rages, the more explosive the result's going to be when one side finally gives up.
And you can see it right here in these charts. On the left, you've got heating oil, stuck in a range for what felt like forever. And then, whoosh, a massive, sharp drop. Same story on the right with coffee, just in the other direction. It went sideways for months, building energy, before an absolutely huge upside breakout. The takeaway is clear. Long periods of quiet often lead to very loud moves.
Okay, on to our second key. How narrow is the range? The absolute best way to think about this is a coiled spring. The more you compress that spring, the more you squeeze it down, the more force it's going to have when you finally let it go. A super tight range means the market is quiet. It's almost too quiet. But when some new information hits, that quiet shatters and everybody sprints in the same direction at once.
Just look at these examples in the Japanese yen and the US dollar index. See how constricted the price is? How tight that coiling action is? So when the breakouts finally happened, they weren't small, hesitant moves. They were the start of really strong, powerful trends. That constriction led directly to expansion.
And finally, we have to talk about confirmation. Because honestly, this is where it gets really dicey. False breakouts are everywhere. It's so common for the price to just pop out of a range for a second, trigger a bunch of automated orders, and then snap right back inside. It's a classic trap, and it catches so many traders off guard.
And this leads us to a real strategic dilemma, a genuine trade-off that every single trader has to think about and decide on for themselves. There is no one-size-fits-all magic answer here.
So here's the trade-off, laid out plain and simple. You can act the second you see the breakout. The pro, you get a fantastic entry price if you're right. The con, you have a much higher risk of getting faked out. Or you can play it safer. You can wait for confirmation, maybe wait for the price to stay outside the range for a day or two. The pro there is you'll dodge a lot of those fake moves. But the con? Well, on the breakouts that are real, you're going to be late to the party, and you'll get a much worse price.
And that ultimately is the question you have to answer for your own trading style.
It all comes down to a personal balance of risk and reward, of aggression versus caution. So, when that coiled spring finally lets go, what kind of trader are you going to be? The one who acts first, or the one who waits for proof?
You know, when you first look at a price chart, it can honestly just look like a bunch of random squiggles, right? Just noise. But what if I told you it's not random at all? There's actually a hidden language in these charts, a structure of invisible floors and ceilings that price reacts to over and over again. And today, we're going to learn how to see them.
So here's our game plan. First, we'll break down the absolute basics. What are these floors and ceilings? Then we'll get into the fun part, which is how to actually spot them in sideways markets and around old highs and lows. After that, we'll cover what is probably the most powerful concept of all. What happens when these levels flip? And finally, we'll wrap it up with a pro tip on why you should be thinking in zones, not just single lines.
This quote from the absolute classic book, Reminiscences of a Stock Operator, just hits the nail on the head. It tells us that markets don't always run in one direction. A lot of the time, they're just stuck within boundaries. And our job? It's to figure out where those boundaries are.
Okay, first things first. We have to understand the foundational concept of floors and ceilings. This is really the heart of support and resistance, and you'll see it's actually a pretty simple and, intuitive way to look at how markets behave. So think about it like this. Support is basically a price floor. It's a level where buyers seem to collectively decide, okay, this is cheap enough, and they step in, stopping the price from falling anymore. Resistance, on the other hand, is a price ceiling. That's where sellers take over and say, nope, it's not getting any higher, and they halt a rally in its tracks. These levels are the key battlegrounds between buyers and sellers.
Right, so the million-dollar question is, where do these levels actually come from? Are they just magic lines we drawn on a chart? Not at all. They're created by the market's own history, really by the collective memory of every single person participating in it.
And that leads us perfectly into our next point, spotting trading ranges. Because one of the clearest places to see these battle lines being drawn is when a market just stops trending up or down and starts moving sideways for a while. It's literally like watching a game of tennis. The price is the ball, and it's just bouncing back and forth between two distinct lines. In a trading range, that upper boundary is a super clear ceiling, or resistance, and the lower boundary is a clear floor, or support.
Okay, now check this chart out. This shows a really key principle in action. See that trading range over on the left? The price is just bouncing around in there. Now watch what happens after the price finally breaks out above that range. It rallies, and then it pulls back. And where does it find support? Right at the top of that old range. The old ceiling has become the new floor.
So that's trading ranges, but it doesn't stop there. This idea of using history to find future battlegrounds goes even deeper. We can also find these levels by looking at major turning points from the past, the big peaks and valleys.
It's a super simple rule, but man, is it powerful. It's like the market has a memory. Traders, whether they realize it or not, remember these important price levels where things turned around in the past, and they tend to react when the price gets near them again.
And this weekly chart? Wow, this is just a perfect example. Look way back at that low from 2003. See how it acted as a solid floor for price declines in 04, 07, and again in 08? Now look at that peak from 2005. It became the exact ceiling that stopped the rally cold in 2009. These levels can stay important for years, even decades.
Okay, now we're getting to what I think might be the single most important, most reliable principle in all of chart analysis. And that's what happens when one of these powerful levels is finally and definitively broken.
So what on earth happens when a floor just gives way or a ceiling just shatters? Well, it's not just a technical thing on a chart. It signals a huge shift in the market psychology. The balance of power between buyers and sellers gets completely turned on its head. This is where the magic happens. It's called a role reversal. A broken resistance level, an old ceiling, transforms into a new support level, a new floor. And a broken support level does the exact opposite. Let's see it happen. All right, so here we have live cattle futures. Notice that peak back in 2012. Now, fast forward to 2013, the price rallies right back up to that same spot and bam, it hits a wall. That's our resistance ceiling in action. The buyers just can't push it through. But here's where it gets really cool. The market finally musters the strength to break through that ceiling. So what happens next? Well, look at the pullback in 2014. Where does it stop and find buyers? Right on that old resistance line.
The ceiling has now become the floor. It's an absolutely classic example. Okay, now let's look at the flip side of that coin. Here's a chart of silver. That horizontal line marks a major low that held as support for years. I mean, time and time again, buyers stepped in right around that level and held the line. It was a really strong floor.
And then the floor breaks. It finally gives out. The price collapses, but then it tries to rally back. And where does that rally stop dead in its tracks? Right at the old support level. The old floor has now become the new ceiling. This role reversal, this is the whole game, right here. It's one of the most reliable patterns you'll ever see.
All right, last big idea, and this one is super important for taking this stuff from theory into the real world. To be really effective with this, we've got to move beyond drawing simple lines and start thinking in terms of zones. Because markets are, well, they're rarely neat and tidy. You have to remember this. Please burn this into your brain. Treating these levels as exact, down to the penny numbers is a classic rookie mistake. The market is driven by human beings, by emotion. It's messy. It's not physics.
So instead of drawing these razor-thin lines, the more professional way to look at it is to identify zones. These are areas on the chart where price has reacted multiple times. A whole cluster of old highs and lows creates a much broader and, frankly, more realistic area of potential support or resistance.
And you can see it right here. It doesn't matter if you're looking at a currency like the Swiss franc on the left or a commodity like gasoline on the right. Notice how the price reacts multiple times within that shaded support zone. The principle is exactly the same across all markets. Prices react to these broader zones of historical activity, not just single precise lines.
All right, so let's tie this all together really quick. What did we learn? Number 1, support is a floor, resistance is a ceiling. Simple. Number 2, we find them in sideways trading ranges and around old, important market highs and lows. 3, and this is the big one, when they break, they often flip their roles. And finally, remember to think in zones, not exact lines.
By learning to see support and resistance, you're not just analyzing a chart anymore. You're starting to read the story of the market, the story of that constant battle between buyers and sellers. The question now is, what story are the charts telling you?
You know, we're always told to focus on the long term, the big picture. But what if a single day's price action could tell its own incredible story? Today, we're going to zoom way in and look at one-day chart patterns to see what they can really tell us about major market turning points.
Our guide for this analysis kicks things off with this brilliant quote. It's just a perfect reminder that, hey, anyone can look like a genius when prices are only going up, right? The real skill is in understanding the signals the market is sending you, especially when that trend is about to change.
And that really gets us to the heart of the matter. When you first look at a chart, it can honestly just seem like a bunch of random noise. But what if, hidden inside all that chaos, there are specific, repeating patterns, little clues that can tell us what might be coming next? Well, that's exactly what we're here to find out.
Okay, let's dive right in with our first pattern, the spike. You can think of these as the sudden, dramatic exclamation points on a chart. They are one of the most visually obvious signs that a market might be hitting an emotional and a financial peak.
So what is a spike, really? Well, from a psychological view, a spike high is like the final exhausted gasp of buying. All the buyers push prices up to this frantic new peak, and then they just run out of steam. A spike low is the exact mirror image. It's total capitulation, where sellers just throw in the towel in a wave of panic, right before the selling pressure totally dries up.
Now, not all spikes are created equal. There are 3 things that make a spike really significant. First, it has to pop right off the chart. The bigger the price difference from the days around it, the better. Second, for a spike high, the price has to close way down near the day's low. That shows a complete reversal of feeling within the same day. And third, a spike is most powerful when it comes at the end of a long, sustained price move. It's like the finale to the whole trend.
And wow, this chart just shows it perfectly. Take a look at this daily chart for cotton. I mean, you absolutely cannot miss that spike. It stands out like a mountain peak. And sure enough, it nailed the top almost perfectly before a massive drop. You could almost feel the moment that buying frenzy peaked and then just, poof, vanished. That's a climax captured in a single day.
All right, let's move on. Our next pattern, it kind of comes with a bit of a warning label. It's called a reversal day. And even though it's one of the most talked about patterns out there, it might also be one of the most deceptive.
So the standard definition sounds pretty good, right? In an uptrend, the market pushes up to a new high, but then it loses its nerve and closes below the previous day's close. That seems like a clear sign of weakness. But here's the problem. That condition is actually surprisingly easy to meet.
And this chart is the perfect example of why that's a problem. This is crude oil during a huge rally. Every single one of those Rs marks a standard reversal day. Just look at how many there are. They popped up constantly, and pretty much all of them were false alarms that would have made you sell out of a great trade way too early.
It's so unreliable, in fact, that the source material has this fantastic, dry sense of humor about it. It says reversal high days successfully call 100 out of every 1,000 highs. And no, that's not a typo. You get so many false signals that the pattern, by its normal definition, is basically just background noise.
So, the big question is, can we fix this? Well, the author suggests a really simple but powerful change. Instead of just closing below the prior day's close, a much stronger signal requires the day to close below the prior day's low. Why is this so much better? Because it means the sellers didn't just reverse one day's gains, they completely wiped out the entire previous day's progress too. It's a much more aggressive and meaningful signal.
And just to be super clear, spikes and reversals are not the same thing. A spike is all about its dramatic relationship to the days before and after it. A reversal day only cares about what happened the day before. So a single day could be a spike, a reversal, both or neither. But as you can probably guess, when you find a day that is both a spike and a strong reversal, well, that's a signal you should really pay attention to.
Okay, so we've looked at patterns that could signal a top or a bottom. But what about figuring out the health of a trend that's already happening? For that, we need a way to gauge the market's momentum, its conviction. And for this, we look at something called thrust days. The whole idea here is that the closing price is where the market puts its money where its mouth is for the day. So an upthrust is a day that closes above the previous day's high. It's the market saying, yep, we're confident and we're pushing higher. A downthrust is just the opposite, a sign of bearish conviction. One day on its own doesn't mean much, but a string of them tells a really powerful story.
And this slide just tells that story perfectly. On the left, you've got the S&P 500 in a bull market. See how those up arrows, the confident up thrust days, just completely outnumber the down arrows. Now look over at the euro in a bear market on the right. It's the total opposite. The balance of these thrust days gives you this really clear visual sense of the market's underlying strength. Okay, let's get to our final pattern, which is all about a sudden, dramatic change in personality. This is what happens when the market just explodes with volatility, and it can signal a really powerful and often violent reversal. This is called a wide-ranging day, and the definition is pretty simple. It's a day where the distance from the high to the low is just way bigger than usual, often like twice the average of the last few days. It's like the market was just mumbling along quietly, and then all of a sudden it starts shouting. That jolt of emotion, whether it's panic or euphoria, can totally change the tone of the market.
And when these things happen after a long, established trend, they can be incredibly significant. Just look at this silver chart. After this massive, steady climb, you get these huge, explosive days that close really weakly. It's like they slammed a door shut on the uptrend, not just once, but twice. This sudden explosion in volatility was a clear signal that control of the market had violently changed hands.
But here's a really important point about all these patterns. This stuff isn't black and white. What exactly counts as wide-ranging? Is it 2 times the average? Or is 1.9 close enough? You know, the source is really clear that there is an art to all of this. These definitions are just guides, not some kind of rigid, unbreakable law. It's about recognizing the pattern, not just plugging numbers into a formula.
So after looking at all these different one-day signals, what's the big takeaway here? Well, we have to be really clear about this. This is about reading probabilities and understanding market psychology. What we're talking about are patterns, not crystal balls.
So let's do a quick recap. Spikes can signal that emotional climax of buying or selling. Standard reversals are mostly just noise, but if you strengthen the definition, they can have real value. Thrusts help you take the temperature of the current trend, and wide-ranging days, those are the high volatility events that can signal a powerful emotional shift in control.
Which kind of leaves us with this one last thought. You can even create a mathematical formula to precisely define a spike, like the one you see here. And this brings up a really fascinating question. Is reading a chart a totally subjective art, a skill that you can only get through experience? Or can it all be broken down and defined by cold, hard math? Well, the truth, as it usually is probably somewhere right in the middle.
All right, let's get right into it. Is chart analysis dead?
I mean, is the whole idea of predicting where prices will go just by looking at a chart, is that a real strategy or is it basically just financial astrology?
Well, here's what the legendary trader Marty Schwartz had to say about that. He pretty much throws down the gauntlet, right? He's not just defending chart analysis, he's saying it's what made him rich, especially after trying the other way first. That's a pretty powerful comeback to the skeptics.
So who's right here? Is it the skeptics or is it the rich technician? That is the big question we're going to unpack, and to really get to the bottom of it, we've got to start by looking at why so many people think it's all just smoke and mirrors in the first place. I mean, let's be real. From the outside looking in, watching someone draw lines on a screen and then make huge financial bets, yeah, it could definitely look a little like voodoo. So let's just tackle those criticisms head on.
And you know what? These are some pretty fair points. The critics will ask, how can something so simple actually work in today's crazy complex markets? And what about manipulation? If everybody knows where the key support and resistance levels are, can't the big fish just push the price around to trigger everyone's stop-loss orders? Plus, if every beginner's trading book has these patterns, how can there possibly be an edge left?
But here's the thing, while those criticisms have some weight, they're usually aimed at a super basic Charting 101 version of this stuff. The way the pros actually use charts, well, it's a whole different ballgame. It's way more nuanced and less about some magic formula and more about a really disciplined framework.
So, what's the first secret rule the pros follow? Honestly, this one is a total game changer, and it completely flips what most people think about trading on its head. Get this, you don't have to be right most of the time to make a ton of money. I know, that sounds crazy, right? But it's true, and it all boils down to one single idea.
And that idea is money management. It's really simple when you think about it. Your success isn't about your win-loss ratio. It's not about being right 80% of the time. It's all about how much you win when you're right compared to how little you lose when you're wrong. So you can have a strategy that loses a lot, but if you keep those losses tiny and then catch a few monster wins, you can still be wildly profitable.
Okay, let's make this real. Take a look at this euro-dollar chart. So a trader sees the prices stuck in a range and decides to trade breakouts. First, the price breaks down, so they go short. But nope, it snaps right back. They get stopped out for a small loss. Okay, fine. A little later, it breaks out to the upside. They go long, and same thing happens. It reverses, and they take another small loss.
So, 2 trades, 2 losses. The scorecard is not looking good. You'd think, this strategy is garbage, right? That's what most people would say. But then, look what happens on the 3rd try. Another buy signal comes along. The trader sticks to the plan, gets in, and this time, boom, the market takes off. And it doesn't just go up a little bit, it launches into this massive rally that just keeps on running, completely wiping out those 2 little losses from before, and then some. And that, right there, is the magic of money management. Think about it, a 33% win rate. 2 out of 3 trades were losers. But because the losses were cut short and that one winner was allowed to become a monster, the result was a huge net profit. That's the principle in action. All right, on to the next big secret of the pros. They don't just jump on every little blip or signal they see on a chart. No way. They use filters. They need to see more evidence before they're willing to put their money on the line. It's kind of like a detective, you know? They're not going to arrest someone based on just one clue. A chart signal is just that, a clue. It's not the whole story. A pro is going to wait for some backup, some confirmation, before they make their move.
So what does a filter look like? Here's a super simple example. Let's say you see a buy signal. Instead of jumping in right away, you set a rule, wait 3 days. You only pull the trigger if the price closes above the high of those 3 days. Just that little bit of patience can save you from a ton of false breakouts. Those times the market fakes you out and then reverses.
But filters aren't just about waiting a few days. Another huge one is context. You've got to zoom out. A pattern on a short-term chart might be telling you one thing, but it could be totally misleading if you don't see what the larger trend is doing.
This is a perfect example. Look at the chart on the left. That's the daily chart for natural gas. It's just a total mess, right? It's choppy, with signals going both ways, a recipe for getting chopped to pieces. But now, look at the weekly chart on the right. It's the same market, just zoomed out. And suddenly all that noise just disappears. All you see is one big, clear, powerful downtrend. A pro looks at that and knows instantly, okay, I'm only looking for reasons to sell. I'm ignoring all these little buy signals on the daily chart.
Okay, and this brings us to the final and maybe the most important piece of the puzzle.
This really answers that question of, if everyone knows this, why does it still work? The answer is because it's not just a science, it's an art, it's a skill.
Think about it. Two traders can stare at the exact same chart and see completely different things. One person sees random noise, the other sees a clear pattern. One gets fixated on a tiny move, while the other sees the big picture context. And that subjectivity, that room for interpretation, that's actually a feature, not a flaw. It's what keeps it from being perfectly solved by a computer program.
I absolutely love this analogy. Anybody can go out and buy a violin, but that doesn't mean they can play it, right? Chart analysis is the exact same thing. Just because you can pull up a chart doesn't make you a skilled analyst. All the beginners who try it hit a bunch of sour notes and lose money. That doesn't mean the violin is broken. It just means they haven't learned how to play it yet.
So let's tie this all together. At the end of the day, chart analysis isn't some magic 8-ball that predicts the future. That's not what the pros are doing. They're using it as a disciplined tool to find situations where the odds are tipped in their favor, and then they wrap that in a layer of strict money management so that when they're wrong, and they will be wrong, it doesn't blow them up.
And this really changes the whole debate, doesn't it? The question isn't, does charting work? That might be the wrong question entirely. It's like asking if a violin works. Of course it does, in the right hands. So maybe the real question we should be asking is, have you practiced enough to make it work?
If you've ever tried to make sense of a trading chart, you know exactly what I'm talking about. It's just this chaotic mess of lines and waves and graphs. It can be so confusing. Well, that's the world of technical indicators. And today, we're going to cut right through all that noise to find a really simple, powerful secret that's hiding underneath it all.
And that's exactly what we're going to do. Instead of adding more complexity, more lines, more confusion, we're going to do the opposite. We're going to strip it all away and find the simple, core ideas that power this whole universe of indicators.
I mean, just think about how complex it's gotten. A new trader, you're immediately hit with over 100 different technical indicators. You've got things called stochastic oscillators, MACD, Bollinger Bands. It's no wonder it's so easy to feel completely and totally overwhelmed.
You know, this feeling actually has a name. It's called the indicator overload problem. It's this belief that every single one of these dozens and dozens of tools is unique, that each one has some special secret purpose, which of course makes trying to learn them all feel pretty much impossible.
So, what are these things even supposed to do? Well, the goal is actually pretty simple. They're designed to take market data, like price, run it through some math formula, and hopefully, just hopefully, tell you something about where the market might be heading next. Okay, but this is where it gets really interesting. What if I told you that this entire complex universe of indicators, what if it's all just built from a tiny handful of really simple ideas? Let's dive in and see what's really going on. The big secret is that almost every single technical indicator out there is just a variation of 5. Just 5 simple calculations. You can think of them like the primary colors of technical analysis. And that's it. Seriously, this is the whole list. These are the 5 building blocks. First, you can smooth out the price with a moving average, just to reduce all the noise. Second, you can compare the price right now to a price in the past. That gives you a sense of momentum. Third, see how today's price stacks up against an average price. Fourth, compare 2 different averages, like a short-term one and a long-term one. And last, number 5, you can see where the current price falls within a recent high to low range. Pretty much every indicator you've ever heard of is just a slight twist on one of these 5 concepts. Now, you don't have to just take my word for it. When you actually see them side by side, the similarities are absolutely shocking. Let's look at the proof.
Okay, take a look at the 2 graphs down at the bottom here. The top one is super simple. It's just today's closing price minus the price from 10 days ago. The one below it is today's price minus the 10-day average price. So 2 different calculations, right? But just look at them. They are practically identical. They're moving in perfect lockstep.
And this slide, wow, this really drives the point home. What we have here are 5 really popular indicators that you probably heard of: momentum, stochastic, CCI, RSI, and money flow. All with different names, all with supposedly different purposes. But when you plot them on the same chart, look at that. They move in almost perfect sync. They're all telling you the exact same story, just with a slightly different accent. And the hard data backs up what our eyes are telling us. So in statistics, a correlation of 1.0 means 2 things are identical. Now look at stochastic versus CCI, a correlation of 0.94. For all practical purposes, they are the same thing.
These are not independent tools giving you a second opinion, they're just echoes of each other.
So, now that we know the secret that most indicators are basically telling you the same thing, we can use this knowledge to debunk some of the most common and frankly most dangerous myths in trading.
Let's start with a classic. Myth number 1. You've probably heard this a million times. You should use 2 or even 3 indicators to confirm a trading signal. I mean, it sounds smart, it sounds safe, right?
But here's the thing. It's an illusion. Since these indicators are so similar, getting a buy signal from both the RSI and the stochastic isn't actually confirmation. It's really just like asking your echo for a second opinion. You're just hearing the same information twice.
All right, now for the big one, divergence. This is the idea that when the price of something hits a new low, but your indicator makes a higher low, it's supposed to be this super powerful signal that the market is about to turn around and shoot upwards. Well, this chart shows you just how dangerous that myth can be. Every single one of these arrows marks a divergence buy signal on crude oil. These signals were flashing over and over and over again for 6 straight months, all while the price just kept falling off a cliff, dropping by more than $50 a barrel.
So here's the crucial takeaway. These divergent signals happen all the time, but during a strong, extended market trend, they can give you one false alarm after another. Relying on them can be an absolute disaster for your account.
So, this brings up a huge question. If it's not the fancy formula that makes these indicators different, what is it? What is the one thing, the single most important factor that actually matters?
Okay, look very closely at this chart. The top and the middle indicators, they use totally different formulas, but they look very similar. Why? Because they're both measuring a short-term 10-day trend. Now, compare the middle and the bottom indicators. They use the exact same calculation, but they look completely different. And why is that? Because one is measuring a 10-day period and the other is measuring a 100-day period. And that right there is the single biggest takeaway from all of this. The complex, fancy formula you choose is way less important than the time period, the look-back period, you apply it to. That is what really, truly determines what the indicator is going to show you.
So when we strip away all that complexity, the hundreds of indicators and the confusing formulas, we find this one simple truth right at the very core. And it really makes you wonder, doesn't it? In a world that seems to get more and more complex every single day, where else might we be overlooking a simple, powerful answer that's been hiding in plain sight all along?
All right, let's just jump right into it. We have all been there, right? A market is just taking off, it's soaring, or maybe it's plunging, and you're just sitting there on the sidelines kicking yourself because you feel like you've totally missed the boat. It's probably one of the most frustrating things for any trader, and today we're going to break down exactly how to tackle it. But first, let's get one thing straight. And this quote from the legendary Edwin Lefebvre really says it all. The goal is not perfection. You simply can't catch every twist and turn. Trying to nail the exact bottom or the perfect top, that's a recipe for disaster. The real skill is learning how to jump into a trend that's already moving. And that leads us right to the big question, doesn't it? It's as much a mental game as it is a technical one. How do you actually bring yourself to click the button when every part of your brain is just screaming, "It's too late, you missed it"? Well, that's the exact problem we're here to solve today. So this brings us to what I call the too late trap. It's this mental block, this mindset that just causes you to hesitate and a lot of the time leads to complete paralysis. It stops you from acting even when you're pretty sure which way the market is headed. It's this exact feeling, isn't it? Why even bother now? This becomes the biggest enemy of your trading. It's not really about the price on the chart. It's this feeling of regret, like you should have been paying attention earlier or been smarter. And that emotion, it's powerful. It can stop you dead in your tracks and prevent you from making what could still be a fantastic trade. And look, this hesitation usually comes from a few really common places. Maybe you just weren't even watching that market when the trend kicked off. Or, and this one's a killer, you were trying to be disciplined, waiting for that perfect little dip to buy, but the market just kept running away from you. Or maybe you were just a skeptic at first, and now the evidence is just, well, it's undeniable. All of those roads lead to this same paralyzing spot. Okay, to really see why this mindset is so costly, let's dig into an incredible real-world example. We're going to look at the coffee market back in 2014. Trust me, it's the perfect cautionary tale.
So, picture this. It's the middle of February 2014. Coffee prices have already exploded higher by over 37%. I mean, technically, everything looks bullish. You've got a breakout, new highs, a classic pattern. But mentally, most traders are looking at that 37% gain and thinking, no way, that thing has gone way too far, way too fast, I'm not chasing that. And wow, this just shows you how wrong that thinking was. On the left, you see that chart from mid-February that already looked like it had made a massive run. And on the right, that's what happened next. That initial jump was literally just the warm-up act for a truly historic move. Now get this, here is the absolute kicker. At that moment in mid-February, when almost everyone was convinced they were too late, the coffee rally had only completed about 35% of its entire move. Think about that. 2/3 of the trend was still to come. And this brings us right back to another piece of wisdom from Lefebvre. It's such a powerful reminder that our own ideas of what's high or low can be our worst enemy. A strong trend, it doesn't care if a price feels high, it just keeps on going. Okay, so if we know we can't just throw in the towel on a big trend, how do we actually get on board? Well, that brings us to the good stuff, the actionable toolkit. We're going to walk through 4 specific, concrete strategies you can use to enter a market that's already in motion. And let's be crystal clear about something. This is not about just closing your eyes and recklessly chasing the price. The goals here are exactly the same as any trade you'd ever take. Find a good entry point, and most importantly, have a rock-solid plan for controlling your risk. These strategies are all designed to help you do just that. All right, strategy number 1 is called percent retracement. The logic here is super simple. Markets rarely move in a perfectly straight line. So in a strong uptrend, you just wait for a natural dip, a little pullback, and you can define that dip as a specific percentage, like, say, a 50% pullback of the most recent upward surge. And this chart of the S&P Mid-Cap 400 shows this perfectly. You can see how after each big push higher, the market takes a breather and pulls back. These horizontal lines here mark that 50% retracement level. And look, they provided several disciplined, lower-risk chances to get into that existing uptrend. Strategy number 2 is the reversal of a minor reaction. So here, instead of waiting for a specific number or percentage, you're actually watching the price action itself. You wait for a pullback to kind of run out of steam, and then you jump in as soon as the price starts moving back in the direction of that main trend. Take a look at this Australian dollar chart. You see those points marked RD? That just stands for reaction day. It's basically a sign of a small pullback against the trend. The strategy is to wait for that reaction to happen, and then when the price shows strength again, that's your trigger. And what's so important is that each entry has a very clear spot for your stop loss, right below the low of that little pullback. Next up, we've got a total classic, the continuation pattern breakout. You see, even the strongest trends need to pause and catch their breath before they make the next big move. These pauses often form shapes on the chart that we can recognize, things like flags or just simple sideways boxes. Your entry signal is when the price breaks out of that pause in the direction of the trend. This also works great on the downside. Just look at this chart of crude oil during a powerful downtrend. Notice how the price doesn't just fall off a cliff. It drops, then it pauses and goes sideways in one of these little consolidation boxes, and then it breaks down all over again. Every single one of those breakdowns was a fresh opportunity to get in short or add to your position. And our 4th and final strategy uses a tool I'm sure you've seen before, a moving average. In a really healthy, sustained trend, a long-term moving average often acts like a moving floor of support. So you can use any pullback to that moving average as a potential zone to look for an entry. Just look at this S&P 500 chart with a 40-day moving average plotted on it. During this really strong uptrend, it's amazing. Almost every single time the price dipped down to kiss that moving average, it turned out to be a fantastic buying opportunity right before the next leg higher. It gives you a consistent, repeatable place to look for your shot. Now here's what's really cool. These 4 techniques aren't just for getting into a brand new trade. They're also the exact key to one of the most powerful concepts in all of trading: adding to a winning position. This is also known as pyramiding. So here's the big aha moment. The problem of how to add to a trade that's already in the money is the exact same problem as entering mid-trend. You're trying to get more exposure to a move that's already happening. So guess what? You can use the exact same 4 strategies we just covered: pullbacks, reactions, breakouts, or moving average chests to time your additions. But, and this is a huge but, Pyramiding has to be done with super strict risk management. So there are 3 non-negotiable rules. First, you never add to a losing trade. Ever. We're trying to press our winners, not average down on a mistake. Second, you have to protect your existing profit. Your stop loss on the new shares has to be placed so that even if you get stopped out, your whole combined trade is still a winner or at least break even. And third, control your size. Your add-on positions should never be larger than your first one so you don't get top-heavy and over-leveraged right at the end of a move.
Phew, okay, we've gone over a ton of ground here. So let's boil it all down to the single most important idea, the one thing you should walk away with from all of this.
Here it is. Forget about trying to be a psychic. Stop trying to predict the perfect top or the absolute bottom. It's impossible. Truly successful trading is all about having a repeatable, disciplined process, a system for engaging with what the market is actually doing, and a plan for managing your risk along the way.
So I'll just leave you with this question. You now have a practical framework for beating that too late trap. You have 4 concrete strategies you can use to get in on a trend that's already moving. So the next time you see a market just taking off, instead of feeling that familiar frustration, how are you going to use this toolkit to engage with it?
All right, let's talk about the single most important tool in any trader's toolkit, the stop loss. And look, it's way more than just an order type. Think of it as a shield. It's what protects your capital, sure, but it also protects your mind from the emotional chaos of the markets. So let's break down how to really master it.
You know, this quote from the absolute classic Reminiscences of a Stock Operator just hits the nail on the head. The biggest danger you face as a trader, it's not some crazy market crash. It's that little voice inside your own head, the one that whispers, just hold on a little longer, it'll come back. That hope, when you let it run wild, is exactly what turns a small, manageable paper cut into a catastrophic wound.
Because really, the core problem isn't the market itself, it's how we're wired to react to it. We humans just hate being wrong. And closing a trade for a loss, man, that feels like admitting failure. It's this internal battle, this fight against our own ego, that can make us hold on way too long and turn a disciplined little loss into an account-crippling disaster.
So what's the solution? You have to take that emotional, in-the-moment decision completely off the table. A stop loss isn't just an order, it's a principle. It's a pre-planned commitment you make to yourself with a cool, rational mind before a single dollar is on the line. You're defining ahead of time the exact point where you say, okay, my idea for this trade was wrong, and you get out.
Okay, so where do we put this thing? How do we find that point where our trade idea is officially busted? Well, the best way is to let the market itself tell you. So let's open up the playbook and look at a few practical, chart-based strategies for setting your stops at logical technical levels.
First up, one of the most common things you'll see on a chart, the trading range. This is just when a market is chopping sideways, right? It's building a really clear floor, we call that support, and a ceiling, which is resistance. These boundaries are like natural lines in the sand that the market has drawn for you.
In this natural gas chart is a perfect example. So let's say a trader goes short. They bet on prices falling right after the price breaks below that range. So where does the stop go? Well, the most logical place is just above the top of that old range. Why there? Because think about it. If the price rallies all the way back up and breaks through that old ceiling, the whole reason you got into the trade, that downside breakout, has completely failed. It's time to go.
Next up, we can use these great little short-term patterns called flags and pennants. The best way to think of these is like brief pit stops or resting periods inside a really strong trend. And what's great is they create these super clean, well-defined levels that are just perfect for placing a stop.
Check out this gasoline chart. The market forms a little flag pattern, and then it breaks down again. Now, a trader who shorts that breakdown would put their stop right above the high of that little flag. And look what happened. The market bounced, it came right up and tagged that exact stop level, and then it just ripped higher. The stop did its job perfectly. It told you, hey, that downward move was a fake out, get out now.
You know, sometimes the market gives you a major clue not over several days, but in one single powerful trading session. We call these wide-ranging days, and their highs and lows often act like these powerful magnets that the market tends to remember and revisit later on. And this chart really shows that market memory in action. You see this huge down day, right? A clear sign of just intense selling pressure. A short seller stop would logically go just a tick above the high of that powerful day. So when the market eventually did rally and broke above that high, it was a massive signal that the sellers had totally lost control, and it paved the way for that huge advance.
And finally, we've got the most classic technical stop of them all, putting it just beyond the most recent major swing high or low. And the logic is super simple. In a healthy uptrend, prices should be making higher highs and higher lows. The second a market breaks below a previous low, that's a huge red flag. The integrity of that entire trend is now in question.
This corn chart shows a really powerful upside breakout, so a trader buying this move has a couple of really logical spots for their sell stop. They could put it below the May low, or if they want to keep it a bit tighter, below the more recent June low. The key is, if the price were to suddenly reverse and take out either of those levels, it's a strong signal that the upward momentum that got you into the trade in the first place has probably fizzled out.
But here's a really critical, real-world question. What do you do when the technically correct stop is just way too far away? When putting your stop at the logical spot on the chart means you'd have to risk an amount of money that honestly just makes you feel sick.
And this number right here, this isn't just some theory. Back in July of 2008, crude oil had a massive, massive drop. If you wanted to short it, the closest technically correct place to put your stop was way, way up at the contract high. And that meant risking $17,850 per contract. For most traders, that is just insane. That's not a viable risk.
And this chart just shows you the dilemma perfectly. I mean, the price absolutely fell off a cliff. But placing a stop all the way back up at that recent high is completely unrealistic for pretty much any normal trader. Your risk management plan just wouldn't allow for it. So when the technical stop is just too expensive, you need a different tool in your toolbox.
And this is where the money stop comes into play. Think of this as your ultimate financial safety net. It has absolutely nothing to do with chart patterns and everything to do with one thing: protecting your capital. You simply decide on the maximum dollar amount you are willing to lose on any single trade, and you place your stop there, period. The health of your account always comes first.
Okay, so far we've been talking all about defense, right? Limiting our downside. But stops can also be a really powerful offensive weapon. You can use them to lock in your profits as a trade moves in your favor. And this is the job of the trailing stop.
And the logic here is just beautifully simple. As the market moves your way and you start to show a profit, you manually move your stop up behind it, usually just below the most recent swing low. You're systematically locking in a piece of your gains, turning those paper profits into protected profits, all while still giving the trade plenty of room to keep running.
And this chart is just an incredible real-world example of a trailing stop in action. Get this single trade lasted for 2 years. And by methodically raising the stop 11 different times as the market kept pushing higher, this trader was able to ride a massive, massive trend, capturing a huge profit while making sure they never gave too much of it back.
So we've covered the psychology, we've covered the technicals of setting stops, but I'm telling you, none of this matters, none of it, if you don't follow the single most important rule in all of risk management.
Your stop has to be GTC, that's good till canceled. You set it and you walk away. The absolute cardinal sin of trading is letting it become a CIC, cancel if closed. And you know that moment. It's that feeling of panic when you see the price getting closer and closer to your exit, and you get scared, and you move it further away, just praying for a rebound. That single act of hope completely negates the entire purpose of this tool. So the one unbreakable rule is this: you never, ever move a stop to increase your risk.
So there you have it, the whole framework. A stop loss isn't just some technical order you place. It's a firm commitment you make to yourself, a commitment to be disciplined. It's the decision to protect your capital and your sanity from the crazy whims of the market. And this, more than any fancy indicator or strategy, is what separates the amateurs from the professionals. You've got the playbook now. The only question left is, are you going to use it?
All right, let's talk about it. It's probably one of the hardest questions in all of trading. You're in a winning trade, you're seeing green, life is good, but then that little voice starts, right? When do I sell? How do you actually know when to cash in and take your profits?
You know, the legendary trader Edwin Lefevre had this famous line about how the big money was made by sitting tight. It sounds so simple, right? Just sit there. But as anyone who's tried it knows, it's often an agonizing experience. And it's a great quote for sure, but it's not the full picture. Because this is the million-dollar question, isn't it? Where is that line between being a patient, disciplined trader and just being greedy? How do you stop yourself from riding a beautiful winner all the way back down to break even, or even worse? And that brings us to what I like to call the profitable problem. Think about it. When you're losing, the decision is, well, it's painful, but it's simple. Your stop loss gets hit, you're out. End of story. But when you're winning, oh, that's a whole different kind of torture. It's a great problem to have, for sure, but it can be absolutely paralyzing. You know, there's an old saying that getting into a trade is easy, but getting out is the hard part. And it is so true. Finding a good setup, that's one skill. But knowing how to exit with your profits intact, that's the real game. It's all about having a plan before the emotions kick in. Okay, so a plan is everything. Let's dive into some of the most common ways to build one, starting with clues that are hiding in plain sight right on the chart itself. We're going to be measuring the market's moves. All right, first up is something called a measured move. The idea here is actually pretty cool. It's based on the observation that markets kind of have a memory or a rhythm. The moves aren't random. They often repeat in size. So the theory is you can take the last big swing and use it like a ruler to measure out where the next one might end. And check this out. This is what it looks like in practice. It's almost shockingly simple. You literally take that first big rally from that first low to the first high, you measure it. Then you just kind of copy-paste that same distance starting from the next major low. And boom, look where that target lands. It's pretty darn close to the actual top, isn't it? It's a great way to set a logical target. Okay, another classic chart-based approach is using support and resistance. I like to think of these as historical battlegrounds on the price chart. You've got support, that's the floor where buyers stepped in before. And you've got resistance, the ceiling where sellers took control. The key is that these old floors and ceilings often become really important levels in the future. And these two charts show it perfectly. On the left, if you were short, where would you look to take profit? Well, that old support level where price has bounced twice before is a super logical spot. And on the right, if you're long, you're looking up at that old resistance, that ceiling, and thinking, that's probably a good place to sell before we hit our heads again. It's just common sense, really. All right, so we've looked at the visual stuff. Now, let's get a little more mathematical. We're moving on to rules, ratios, and indicators, the quest to find a formula for the perfect exit. Now, this one is pretty interesting. It's called the Rule of 7. It's a bit more complex. You take the very first leg of a new trend and you multiply its size by a specific set of ratios. The idea is to project not just one target, but a whole series of potential places where the trend might run out of gas. And just look at how well this can work. This soy meal chart is a fantastic example. Based on that first move up, the formula spit out these targets, Objective 2 and Objective 3. And it's kind of spooky how well they nailed those tops, right? It gave the trader a really clear, data-driven reason to get out near the high. But here's the catch with a lot of these mathematical indicators, especially the ones that try to tell you when a market is overbought. They can be a real double-edged sword. In a market that's just bouncing around sideways, they're fantastic. But in a powerful, runaway trend, they'll have you selling way too early over and over again. This chart of the US dollar is the perfect, and I mean perfect, illustration of that problem. Look at that massive uptrend on the left. This indicator screamed sell 10 different times on the way up. 10. Can you imagine how frustrating that would be? You'd miss the entire move. But then, look over on the right. Once the market calmed down and went sideways, suddenly the indicator started working like a charm. Context is everything. So, to try and solve this problem, some people go deep into the rabbit hole with super complex systems. We're talking about things that go way beyond just momentum. They'll literally count the bars on the chart, looking for very specific patterns and sequences, all in an effort to pinpoint the exact moment of trend exhaustion. Okay, that was a lot of math and complexity. Let's take a deep breath and come back to earth. Because sometimes the best exits are the simplest. This is the art of simplicity. Common sense exits. First up, the trailing stop. This is less about predicting the future and more about managing your risk and your profit. The mindset is totally different. You're not trying to pick the top. You're just telling the market, hey, you can go as high as you want, but I'm moving my safety net up behind you. It lets you ride the trend while mechanically locking in gains. It's beautiful. And then there's maybe the purest method of all, the change of market opinion. It's dead simple. You ask yourself, why did I get into this trade? If the answer is still true, you stay in. If you bought because of a beautiful uptrend, you don't sell until that uptrend is clearly broken. No magic numbers, no fancy indicators. You just let the market tell you when the party's over.
Okay, so we've looked at a bunch of different ways to get out of a winning trade, right? From drawing lines on charts to complex math. Now, let's pull it all together and talk about your exit strategy, building a plan. The big takeaway here is that there's no single magic bullet. All these methods, measured moves, support and resistance, trailing stops, they're all just tools in a trader's toolbox. The key isn't which one you pick. The key is that you pick one before you even place the trade. Pro traders don't guess. They have a plan and they stick to it, period. That's what separates them from the rest. And that really leaves us with one final, crucial question you have to ask yourself. What game are you actually playing? Are you trying to be a fortune teller, trying to perfectly predict the future and nail the absolute highest tick of a move? Or are you a strategist, focused on having a solid plan that consistently protects your capital and your profits? Because trust me, the answer to that makes all the difference.
So what if I told you that the most important rule in chart analysis has nothing to do with what happens and everything to do with what doesn't happen? We're about to dive into this really powerful, kind of counterintuitive idea that flips a lot of conventional trading wisdom completely on its head. You know, this quote from Wayne H. Wagner just nails it. The market is always changing, always mutating. Just when you think you've got it all figured out, it zigs when you expect it to zag. But here's a thought. What if those unexpected moves, those zigs, are actually the real signals we should be paying attention to?
And that brings us to what I like to call the ultimate head fake. We're going to uncover a secret that isn't about what the market does, but what it fails to do. It's a game changer.
Okay, take a look at this chart of crude oil. You can see this trading range between July and August, right? Then, in early September, boom, the price breaks out above it. Now that is a textbook signal to buy. You'd expect it to just keep on soaring. But instead, it completely falls apart. It just collapses. This is the exact mystery we're here to solve.
So this leads us to this really core, kind of mind-bending question. What if the most powerful signals in the market aren't generated when a pattern works out perfectly, but when it spectacularly fails?
Let's put a name on it. We'll call it a failed signal. And here's the key thing to get. This isn't a mistake in your analysis. It is the analysis. The market's failure to follow through on a promise is often the most powerful sign of a huge move coming in the other direction.
All right, so the most famous, the most common type of failed signal is what traders call a trap. Let's break down these classic market illusions, the bull and bear traps.
It's actually pretty simple when you see it laid out. In a bull trap, the market pokes its head up to a new high, right? It convinces all the buyers to jump in, and then it slams the door shut, trapping them as prices tumble. A bear trap is just the mirror image. The market dips to a new low, it lures in all the sellers, only to rocket straight up, trapping them on the wrong side of the trade.
Check this out. This chart of wholesale gasoline futures from 2015 is just a perfect illustration. So the price rallies up, it consolidates for a bit, and then in June, it breaks out to new highs. That's a classic buy-the-book buy signal, but it was dead wrong. The market immediately reverses, and that failed breakout, that becomes the starting gun for a massive downtrend that lasted for months.
Okay, now let's flip it and look at the mirror image, a bear trap. Here we have the US dollar index back in 2014, and it breaks below a long-standing trading range. Sellers pile in, right? They're thinking the dollar is toast. But just 2 days later, it reverses course. That bear trap marked the exact bottom right before the dollar went on its largest rally in over a decade. Incredible.
Now, this whole principle doesn't just apply to these neat, horizontal trading ranges. Oh no. Even something as fundamental as a trend line can lie to you, leading to what we call a false breakout.
And here's the part that might kind of break your brain a little bit. A false trendline breakout is often a much more powerful, much more reliable signal than a successful one. The failure itself, that is the message.
So let's look at this chart of 10-year Treasury notes. We see a really clear uptrend line. Then in September, the price snaps and it breaks below it. Looks like a clear sell signal, right? But look what happens next. It quickly rallies right back above the line. That failure to stay down, that was the real signal that, hey, this uptrend is still very, very much alive.
Okay, so right about now, you might be thinking, All right, I get it. But how do I know if it's a real failure or if it's just, random market noise? And that is a fantastic question. Traders actually look for specific signs of confirmation to feel more confident that a trap has really been sprung.
So there are 3 simple signs to look for. First, you have initial confirmation. That's when the price just gets back to the midpoint of that old range. Then you have strong confirmation, which is when it goes all the way to the opposite side. And finally, time confirmation is basically when a certain amount of time passes, say 4 weeks, and the market just fails to even try to get back to that breakout point. Each one of these just builds more and more confidence.
All right, let's go back to our first example, that WTI crude oil chart. On the left, there's the bull trap we first saw. But now, look at the chart on the right. We can see it get confirmed. See that initial confirmation as the price falls back to the midpoint? And then the strong confirmation as it crashes right through the bottom of the range. This is where the whole concept really clicks.
And just to really hammer this home, let's do the same thing with the US dollar bear trap. On the left, there's that initial breakdown. And on the right, you can see those confirmation points getting hit one by one as the price rallied back up. Each one of those was another piece of the puzzle, another piece of evidence that the failed signal was the real deal, and a powerful new trend was just getting started.
So let's bring this all together. If there's one single rule you take away from all this, it's how important it is to embrace this idea of the failed signal.
I mean, this quote just says it all, doesn't it? A failed signal is among the most reliable of all chart signals. This isn't some niche little trick. This is a core principle of how markets actually work.
And really, this goes so much deeper than just lines on a screen. It's about understanding crowd psychology. See, these traps work because they catch the absolute maximum number of people on the wrong side of the market. And that powerful reversal that follows, that's fueled by all those trapped traders scrambling for the exit at the exact same time.
So what's the big takeaway here? It's a really powerful mental model you can apply to almost anything. Sometimes, the most important piece of information isn't what happens, but what was supposed to happen and didn't. Think about it. If an apple didn't fall from a tree, that would be a far more interesting event to analyze, wouldn't it?
All right, today we're going to dive deep and decode the logic behind technical trading systems. You know, those automated rule sets that some traders live and die by to make their buy and sell decisions.
So let's kick things off with a question that probably hits close to home for a lot of people. Why is it that when you're paper trading, just practicing, it feels so easy to make money? But the second real cash is on the line, it suddenly gets so much harder.
Well, according to the legendary trader Jack Schwager, the answer is actually really simple, but it's also incredibly powerful. It all comes down to one single thing: emotion. Yep, good old-fashioned fear, greed, and hope. They're the things that can take a perfectly good strategy and just completely derail it.
And that right there leads us to the classic solution that people came up with: mechanical trading systems. See, the entire point of building a system with a bunch of predefined rules is to try and take that messy human emotion right out of the equation. It's all about forcing pure, objective discipline.
Now, if you can pull it off, a mechanical system gives you 3 huge benefits. First, and most obviously, it helps eliminate those emotional decisions. Second, it ensures consistency. You have to follow the plan every single time, no exceptions. And third, it gives you some serious risk control, with built-in rules designed to stop any one bad trade from totally blowing up your account.
Okay, so what do these systems actually look like in the wild? Well, there are a ton of variations out there, but they pretty much all fall into one of 3 basic categories.
So you've got your trend-following systems, which are basically designed to bet that a price move is going to keep going. Then you have counter-trend systems, which do the opposite. They bet on a reversal. And finally, there's pattern recognition, which is looking for more complex, specific chart setups. Now, for this explainer, we're going to focus on the big one, the most popular type, trend following.
So let's pop the hood and get into the mechanics. The goal of a trend-following system sounds pretty simple, right? Just identify a trend and then ride it for all it's worth. But the challenge, the real problem, is how you do that. And that introduces a fundamental conflict that every system has to deal with.
And this slide, man, it just lays out that core trade-off perfectly. On one side, you've got a fast system. Think of it like a race car. It gets you into trends super early, which is great. But the downside is it also creates a ton of noise and false alarms. On the other side, you've got a slow system. It's more like a freight train. It filters out all that noise, but you're going to be late to the party and miss a huge chunk of the move. There's just no free lunch here.
So to make this a little more concrete, let's look at one of the most common building blocks for these systems, the good old moving average. All that is just the average price of something over a set period of time. Simple as that.
Okay, here's a chart with a fast 12-day moving average. See all those little arrows? Those are all buy and sell signals. The system is super responsive. It's jumping on every little move. But look how often it's wrong. It's constantly flipping back and forth, back and forth. It's too much noise. It's chaos.
Now, let's look at that same chart, but this time with a slow 48-day moving average. Much smoother, right? It totally avoids all that frantic noise. But, and this is a huge but, look how late the signals are. The big trend is often already well underway before this system finally gives you the green light to get in.
So what's the solution? Well, you combine them. This is the classic crossover system. A signal only happens when the fast, twitchy line actually crosses over the slow, steady line. And as you can see, this one little trick filters out the vast majority of the noise. You get way fewer signals, but the ones you do get tend to be much higher quality.
Okay, so you might be thinking, great, problem solved. But not so fast, because even this much improved system isn't perfect. In fact, pretty much all trend-following systems share a whole set of common and often really frustrating built-in problems.
And here's what we're talking about, the dark side of these systems. They get absolutely chopped to pieces in sideways markets. They can give back a huge percentage of your profits before they signal an exit. And the most painful one of all, sometimes the system looks amazing in testing, but then just completely bombs when you try to use it with real money. Let's zero in on the biggest nemesis of any trend follower, the whipsaw. Just look at this chart. The market is just grinding sideways. It's not really going anywhere. But the system, it doesn't know that. It sees a tiny move up and screams buy. Then the price falls a bit and it screams sell. Buy, sell, all while you're just racking up a series of small, aggravating losses. It's death by 1,000 cuts.
So, if these systems have such big, obvious flaws, what's the point? Are they just useless? Well, no. The key is to add some extra layers of logic, to turn a simple, kind of dumb mechanical tool into a much more intelligent one. Let's see how that works.
The first technique is adding something called a confirmation condition. Think of it like a second opinion. The system generates a signal, but you don't just blindly jump on it. Instead, you wait for something else to happen that confirms, okay, yeah, this looks like the real deal and not just random market noise.
Let's look at a real example in the coffee market. Here's a basic system at work. See all those signals labeled with a B for buy? In this one period, it generated 6 buy signals, and every single one of them was a loser. It was just a brutal string of false alarms.
But now, watch what happens when we add just one simple confirmation rule. In this case, we'll say we won't buy unless the price moves a little bit past the signal price. And boom, just like that, 5 of those 6 losing trades completely vanish. They're never even taken. The system becomes way more selective and a whole lot smarter. Now, a similar idea, but a little different, is a filter. A filter is a rule that you apply at the exact moment of the signal. It's not about waiting for confirmation later. It's about immediately asking, hey, does this trade even meet our basic criteria for what a good setup looks like?
And here's a perfect example on this crude oil chart. The simple system is firing off signals left and right. But what if we add a filter? What if we say we'll only take buy signals if the big picture, long-term trend is also pointing up? Well, look at that. The filter just screens out all that counter-trend noise, and only the really valid signals, the ones in the circles, actually get through. It's so much cleaner.
So the crucial takeaway here is this. A basic system is kind of a blunt instrument. It just follows one simple rule, no matter what. But by adding these extra layers of logic, these confirmations and filters, you can transform that blunt tool into a much sharper, more intelligent instrument for navigating the markets.
Which, of course, brings us to our final question. We started all this by saying emotion is the enemy and a system is the solution. But as we've just seen, building a good system, a robust one, requires a ton of thought and careful judgment. So, while a system might remove emotion from those split-second decisions, can it ever truly replace the human judgment that's needed to build it, to maintain it, and most importantly, to know when to trust it? That's definitely something to think about.
Have you ever been staring at a chart, you see a pattern, and you just think to yourself, hey, I bet I could trade that? Well, if that's you, you're in exactly the right place. Today, we're going to break down how you can take those gut feelings, those observations, and turn them into a concrete mechanical trading system. But first, let's start with a really important idea from the man himself, Adam Smith. Nothing works at all times in all kinds of markets. So the goal here isn't to find some magic, foolproof formula that never loses. It's about building a disciplined, rules-based approach that gives you an edge over time. So, what are we really trying to accomplish here? Simple. We're building a framework. We're going to take some common chart patterns, things you probably already recognize, and I'm going to show you step by step how to transform them into a set of fully mechanical trading rules. No guesswork allowed. All right, here's the game plan. We're going to start with a system based on volatility, and then we're going to peel back the layers and look at the hidden power of its parameters. After that, we'll dive into 2 different systems based on momentum. And finally, we'll wrap everything up with the big lessons you can take away from all this. Sound good? Let's jump in. Okay, time to get our hands dirty with our very first case study. This system is all about identifying those big, explosive market moves. It's built on volatility. And to see how it works, we're going to look at a real-world example in copper futures. So the absolute heart of this first system is something called a wide-ranging day. What is it? It's just a day where the price swings way, way more than it has recently. This sudden explosion of activity basically draws a new line in the sand. It creates a really important price range for us to keep an eye on. And the rules, you gotta love this, they're incredibly simple. Step 1, you spot one of those wide-ranging days. Step 2, you use that day to define your price range. And step 3, you either buy if the market closes above that range or you sell short if it closes below it. It is a classic, pure breakout strategy. And here it is, right on the chart. You see that thick black bar there in early December? That's our wide-ranging day. That sets the upper and lower boundaries of our trigger range. Then, just a few days later, the price closes above that high, and boom, that's our buy signal, right there at the B. It's clean, it's simple, and it's 100% objective. Okay, now hold on, because this is where it gets really, really interesting. We're about to make what seems like a tiny little tweak to our rules. And at first glance, it's going to seem like we're making this system worse. But you'll see it has a massive impact on our results. So I want you to really think about this for a second. If a new set of rules gives you a consistently worse entry price, why on earth would you ever choose to use it? I mean, it sounds crazy, right? But the answer to that question is really the secret sauce to building a robust, long-lasting trading system. Okay, so here's the fundamental trade-off. On one hand, you've got the sensitive system. It reacts fast, it gets you in at a better price, but it gets faked out a lot. It's prone to all that market noise. On the other hand, we have the restrictive system. It's slower. Yeah, you get a worse entry price, but it has a superpower. It is amazing at filtering out bad trades. Now just look at this chart. It tells the whole story. The sensitive system got whipsawed. It jumped in on 3 different buy signals, and all 3 of them were losers. But the restrictive system, it just sat there patiently. It completely ignored all those false signals, saving itself from a string of losses. So what was the final tally from all those fakeouts? Well, the sensitive system ended up losing almost $9,500. It just got chewed up and spit out by that choppy market. And the restrictive system, the one with the worse entries, it made over $12,000. This is such a huge lesson. Avoiding the bad trades is often way more profitable than getting the absolute perfect entry on the good ones. All right, let's build on that powerful idea as we move into our second system. This one's a little different. We're shifting away from volatility and focusing instead on momentum. We're going to use something called run days to spot potential reversals in the trend. So what in the world is a run day? It's really just a simple way to identify a day with strong directional force. An up run day is one that makes a new high compared to the days immediately before and after it. And a down run day, you guessed it, makes a new low. It's just a clean, objective way to flag those really powerful trending days. Now here's the really cool, kind of counterintuitive part of this system. It's all about the reversal logic. To get a buy signal, you don't just jump on the bandwagon with more up days. You actually wait for the price to break above the highs of the last few down run days. It's a really clever way to spot when a downtrend might be exhausted and ready to flip. And here is a textbook example of this system nailing a huge move. Back in 2014, crude oil was in a monster uptrend. You can see it with all those blue up run day arrows. But then, the price broke below the lows of those recent up days. That triggered a sell signal right before the price completely fell off a cliff. I mean, talk about incredible timing. Now, for our third and final system, we're going to take that run day concept and push it one step further. We're going to evolve it. Instead of looking at specific price levels, this system is all about something much simpler: counting. It's a surprisingly powerful way to trade the persistence of momentum. Okay, here's how it works. After the system generates a sell signal, it immediately starts a buy count. Every time an uprun day appears, it adds 1 to the count. But, and this is the key, if even a single down run day shows up, the count gets reset all the way back to 0. It's looking for a consistent, uninterrupted streak. So the rule is dead simple. Once the system is short, it starts counting those up run days. As soon as it hits our target number, let's say 3 in a row, it immediately reverses the position and goes long. And the exact same logic, just flipped, applies for generating the sell signals. Let's look at it on this soybean chart. The market had been trending up. Then, suddenly, we got 1, 2, 3 down run days in a row with no up days to interrupt the sequence. That was the trigger. That 3-day count generated our sell signal, and the system got short right as a big downtrend was just getting started. Simple, clean, and incredibly effective. So, we've walked through 3 totally different systems. Each one was built from a simple market observation, each with its own unique logic. So, what are the big lessons here? What should you really be taking away from all of this? Well, first and foremost, the whole point of this exercise is to make your trading objective. You take what you think you see on a chart and you turn it into hard, testable rules. Second, always remember that critical trade-off between being sensitive and being restrictive. Filtering out the noise is often the real secret to profitability. And finally, and this is so important, remember that no system is perfect. This isn't some get-rich-quick scheme. This is about building a framework for thinking and a disciplined approach to the markets. So that leaves one final question, and this one is for you. We've just looked at 3 different systems built from 2 simple concepts: volatility and momentum. What about you? What patterns do you see day in and day out in the markets that you follow? And how could you start turning those unique observations into a trading system of your very own?
If you're a futures trader, you know this story. You've got what feels like a brilliant new strategy, but before you risk a single dollar, you've got to test it. You need to know if it would have worked in the past. But here's the catch. Unlike stocks, futures don't have one long, clean price history. They're born, they live, and then they expire. And that simple fact creates a massive challenge that honestly can completely wreck your entire system before you even start.
So let's just start with this absolute classic. Because when it comes to backtesting a trading strategy, this isn't just a saying, it's the law. You could have the most amazing, sophisticated system in the world, but if you feed it bad data, you're going to get completely worthless, or even worse, dangerously misleading results. The price data you use isn't just some minor detail, it's the entire foundation of your analysis. Get it wrong, and everything built on top of it crumbles.
And this lays out the problem perfectly. You look at a stock, it's easy, right? You get one single price history from day one. But the futures market, it's a totally different beast. You've got this chain of individual contracts, March corn, then May corn, then July corn, each with its own little lifespan. So the big question is, how in the world do you stitch all those little pieces together to create one long history that you can actually test your ideas on?
That brings us to what I like to call the futures data puzzle. And believe me, getting this puzzle wrong isn't just some academic mistake. It can trick you into thinking a losing strategy is a hidden gem, and that's a mistake that costs people real money. So today, we are going to solve this puzzle piece by piece.
I mean, this is really the heart of it, isn't it? Let's say your system needs to look back 200 days to calculate a moving average or something, but the current contract you're trading, it's only been really active and liquid for maybe 90 days. So what do? The very data your system needs to make a decision literally keeps expiring and disappearing from right under your feet.
So to find the right answer, we first have to investigate the wrong ones. And there are a few common ways traders try to solve this problem. So let's line up the usual suspects, the popular but deeply, deeply flawed methods people use.
All right, first up is the one that seems like the most straightforward and honest approach. Just use the raw data from each individual contract. No fancy math, no adjustments, just the pure, unadulterated price series. Seems logical, right? Well, this suspect has a couple of major problems.
First off, it's just a nightmare to manage.
For a decent 15-year test, you might have to juggle 60, 70, maybe even 90 separate data files. But the real deal breaker, the thing that makes this a non-starter, is liquidity. Any given contract is really only actively traded for a few months. So if your strategy needs to look back, say a year, the data for a single contract just doesn't go back that far. So for most systems, this approach is simply impossible.
Okay, on to suspect number 2, the nearest futures series. Now this one is really popular. The idea is you just take the front month contract, follow its price right up until it expires, and then you just tack on the price history of the next contract in line. It creates a chart that looks nice and continuous, but it is hiding a truly fatal flaw. And here is that fatal flaw. When you switch from one contract to the next, their prices are almost never the same. There's a gap. And this method pretends that gap was a real, one-day price move. It wasn't. It's a completely artificial jump, and it will absolutely destroy the validity of any backtest you run. It makes the data worthless.
And check out this real-world example. It's wild. So imagine the July corn contract expires, and the very next day, the new contract, September corn, actually rallies by 12 cents. If you were long, you made money. It was a winning day. But because of the price difference between those two contracts, this nearest futures method would have recorded a massive 38-cent loss for that day. Your backtest is now living in a fantasy land, a completely different reality from what actually happened in the market.
Now for our final suspect. And this one is the most dangerous because it sounds so professional, so advanced. It's called the constant forward, or sometimes the perpetual series. A lot of data vendors will actually sell you this stuff, telling you it's the best way to do it. They are wrong. It is a sophisticated-sounding trap.
So what is it exactly? Well, it's a synthetic price. It's not real. It's created by taking two different contracts, say March and June, and then blending them together with some math, a weighted average, to create this theoretical price for a contract that is always exactly, say, 90 days from expiration.
The math behind it is basically a form of interpolation. But you don't need to worry about the formula. The key thing to understand is that this price is a ghost. It is a mathematical construct. It never, ever actually existed on any exchange. You could not have bought or sold at the prices you see in a perpetual series.
And that leads us to its critical, fatal flaws. First, as we said, you can't trade it. But even worse, it completely ignores a crucial part of how futures work. In the real world, as a contract gets closer to expiration, its price naturally gets pulled toward the spot price. The perpetual series, because it's always looking at a fixed time in the future, is totally blind to this, and because of that, it can completely hide the true trend of the market.
Get a load of this example. It's just incredible. Imagine the price of actual physical gold stays totally flat for a whole year. This perpetual series would also show a flat line, and your backtest would say, hey, break-even trade, no big deal. But in the real world, because of carrying costs and other factors, a trader who just bought and held a long futures position would have steadily bled money, to the tune of over $7,000 per contract. The data series said no trend, when in reality there was a massive money-losing downtrend. That's not just wrong, it's dangerous. Okay, we've investigated the suspects, we've exposed the imposters. Now it's time to reveal the hero of our story, the one and only mathematically correct method for building a continuous futures history that you can actually trust.
And here it is. This is the single most important idea you need to burn into your brain. To test a trading system, you have to stop worrying about absolute price levels. The only thing that makes you money or loses you money is the price change from one day to the next. Our goal is not to replicate historical price levels, it's to perfectly replicate historical price moves.
So, how do we do it? Think of it like you're cutting and pasting charts together. You start with today's contract, the most recent one. You go back in time until you hit a rollover date. Then you measure the price gap between that contract and the one that came before it. Then, and this is the magic trick, you adjust every single price from that older contract by the amount of that gap. Then you paste it onto the timeline. And you just keep repeating that process, going further and further back in time, accumulating the adjustments as you go.
And here's what that looks like with real numbers. So on June 29th, the old contract closes at about 15.12. The very next day, the new contract is trading way down at 14.38. Now, the nearest futures method would see that as a huge loss, but our method sees the 85-cent gap. It adds an 85-cent adjustment, And the result? The continuous price series registers a gain of 9.75 cents, which is exactly what a real trader would have experienced. The profit and loss is perfectly preserved. That's the key.
Now, when you do this correctly, it leads to a result that, I'm going to be honest, can look a little strange at first. But this weirdness is actually the proof that you're looking at accurate, reliable data. Let's take a look. Yep, you are seeing that right. That is a chart of soybean prices where the price back in 2004 is literally negative. And I know what you're thinking, that seems completely insane, but it's the unavoidable and mathematically correct result of the process. See, over decades, the total adjustments needed to accurately reflect all the true price gains in soybeans were so huge that when you subtract them from the old historical prices, you actually push them into negative territory. And that's okay, because remember, we don't care about the level, we only care about the move.
And this really is the bottom line. You might hear people in the industry, so-called experts, argue for those other methods. But as the source material for this explainer makes crystal clear, this isn't a debate. It's not a matter of style or preference. It is pure mathematics. There is one way to build a data series that accurately reflects the profit and loss of holding a futures position over time, and this is it, period.
So, at the end of the day, it all comes down to this simple choice. What is your goal? If you just want a pretty picture to get a rough visual of historical prices, sure, a nearest futures chart is fine. But if your goal is to accurately test a trading system to find out if it would have actually made or lost real money, then you have to track the price moves. And for that job, the continuous spread-adjusted series is the only tool that works.
And that leaves us with one last question, a question for you to think about. Now that you know the difference between a real, testable price history and a convenient but dangerous forgery, take a hard look at the data you're using for your own testing. Is it telling you the truth about how your strategy would have performed? Or is it just telling you a nice story?
You know that dream, right? The one where you find the perfect automated trading system, a set of simple rules that just prints money. It's an incredibly tempting idea, but honestly, it's also one of the biggest and most dangerous traps a trader could fall into. Today, we're going to dig into exactly why that is.
In this quote from George J. Church, man, it just nails it, doesn't it? It's this exact belief, this idea that the past is a perfect roadmap for the future, that becomes the shaky foundation for thousands of busted trading systems. And as you're about to see, it's a bias that can cost you a whole lot of money.
All right, to really get this, I want you to put yourself in the scene. Just picture it. You're in some hotel ballroom. You've just dropped almost $900 on a ticket. You're surrounded by all these other people, and everyone is buzzing, just hoping to finally learn that one big secret to getting rich. The air is practically electric. And then, the speaker hits the stage and pulls the curtain back on the super razzle-dazzle system. And the promises? Oh man, they are just incredible. Every single trade is a winner, your account balance does nothing but go up, and the best part, it only takes 10 minutes a day with math a kid could do. I mean, it sounds like the perfect money machine, doesn't it?
But here comes the reality check. Because those flawless can't-lose money machines, well, they have this really nasty habit of just completely falling apart the second they touch the real world. That fantasy you paid for in the seminar, it's about to collide head-on with the facts. So let's look at a real-life example from our source material. There was this magazine article pushing a simple moving average system. It's a pretty standard trend-following idea, and they used its performance on the Swiss franc in 1980 as their proof. The promise, a mind-blowing 287% annual gain. But here's the reality. When that exact same system was tested across 25 different markets over a longer period, it actually lost money in 19 of them. That one perfect year wasn't genius. It was just a total fluke, a complete outlier. And you think that's bad? It gets so much worse. When they tested that very same system on a portfolio of markets in a more recent 10-year period, this was the result. That's a total loss of almost $1 million. The money machine was actually a money incinerator.
So what's going on here? What's the fatal flaw that leads to these kinds of spectacular train wrecks? Well, it all comes down to a concept that sounds really smart and scientific, but in reality, it's often just a way to fool yourself. It's called the optimization myth.
Okay, the thing you got to understand here is that optimization is really just a fancy word for curve fitting. You're basically just tweaking the settings on your system again and again and again using old data until you find that one magical combination that gives you that perfect, beautiful, upward-sloping equity curve. The problem is, All you've done is design a system that was perfect for a past that's never going to happen again. You've completely ignored that markets are always changing.
Which, brings us to the million-dollar question, literally. Is that core assumption that what works best before is going to work best again, is that even true? Let's see what the data actually says.
Wow. Okay. This slide is where the myth just completely falls apart. In a study that ran 30 different tests, the #1 top-performing system from the past only managed to stay at the top 4 times. But get this, it became the absolute worst performer 5 times. Just let that sink in. The best of the past was actually more likely to become the worst of the future.
So, if optimizing to find that one best result is just a trap, what's the right way to go about this? Well, it's all about changing your mindset, from trying to fit a system to the past to actually testing if it's strong enough for the future. So here's the first solid method. It's called blind simulation. It's simple. You chop your data into 2 chunks. You do all your tinkering and optimizing on the older data. Then, once you find your best settings, you lock them in and apply them to the more recent data the system has never seen before. This is a real test because you're seeing how your system performs on a new, unknown data set, which is exactly what happens in real life.
Here's another approach, and honestly, it's incredibly powerful. Instead of running hundreds of tests and just cherry-picking that one superstar result, you look at the average performance across all of the different settings you tried. If that average number is still positive, then you might really have something solid on your hands. But if it's not, then that one great result was probably just dumb luck.
And this right here, this picture shows why another piece of the puzzle is so critical. Your tests have to be realistic. A perfect simulation might pretend you can sell at yesterday's closing price. But in the real world, as you can see in this corn chart, markets can gap down hard overnight. That difference between the price you thought you get and the price you actually got is called slippage. And it can turn a simulated profit into a very, very real loss. Just like that.
So as we've seen, it's actually remarkably easy to cook up a simulation that looks amazing on paper, but is completely disconnected from reality. These simulations aren't just flawed, a lot of the time they're basically designed to lie to you.
Jack Schwager, the author of our source material, has this awesome twist on an old economic idea, Gresham's law. He says, bad simulations drive out good. What he means is that the crazy, unrealistic simulations that promise 500% returns, they get all the eyeballs. They get all the attention, and they make a system with a realistic, modest, but actually achievable return look pathetic in comparison, even if it's the only one that actually works.
All right, so what's the big takeaway for you? Well, here's your red flag checklist. If you see a system being sold with just one amazing, cherry-picked example, if they ignore real-world costs like commissions and slippage, or if the entire sales pitch is just based on this idea of optimization, you need to be very, very skeptical.
And that really brings us to the final, most important question you have to ask yourself every single time. When you're looking at some system's amazing track record, are you looking at the results of a real, tough, honest test? Or are you just being sold a perfectly crafted story that was designed to fit the past? Because knowing the difference, well, that could be the difference between a long trading career and a very, very empty account. We all chase those high returns, right? It's the big headline number, the one we love to brag about. But what if I told you that focusing only on returns is, well, one of the biggest mistakes you can make as an investor? Today, we're going to bust that high return myth wide open and really dig into how you're supposed to measure investment performance.
Okay, to kick things off, let's try a quick puzzle. Imagine you're booking a hotel in London. You find the exact same room on 2 different websites. Site A says it's $300, Site B says it's $250. So, which one's the better deal? I mean, it seems pretty obvious, doesn't it? But of course, there's a catch. I left out a really crucial piece of information, the currency. What if that $300 is in US dollars, but the $250 is in British pounds? Whoa. Suddenly, that cheaper option is actually way, way more expensive. See, the number itself is totally meaningless without its denomination. And that right there, that's the whole point of this explainer. Investors make this exact same mistake all the time. They just look at the return number without ever asking about the currency. And in investing, risk is the currency. Let me say that again. Risk is the denomination of return.
So here's our game plan. First, we'll talk about the high return trap. Then we'll see how leverage completely changes everything.
After that, we're going to expose a huge blind spot in the famous Sharpe ratio, and finally, we'll get you set up with some much smarter ways to measure performance.
All right, first up, the high return trap. Let's look at why our natural instinct to just chase the biggest number can get us into a whole lot of trouble.
Okay, check out these two managers. You've got Manager A, who gives you a 10% return for 5% risk. And by risk, we just mean volatility, how much the value bounces around. Then there's Manager B, offering a huge 25% return, but with a whopping 25% risk. Now, be honest, a lot of people would just jump at Manager B, right? They'd think, hey, I'll take on more risk for that much more return. But is that really the smartest play?
And that right there, that's the trap. To really understand why it's a trap, we need to talk about something incredibly powerful. And that brings us to our next section. Leverage changes everything. This is where you're going to see the real magic of that return-to-risk ratio.
Here's a really cool way to think about this. Imagine risk is a big hole in the ground and your return is a pile of sand right next to it. Leverage is just a shovel. It lets you take some of that risk out of the hole and pile it onto your return pile. You get more return, sure, but the hole gets deeper, riskier. The key thing here is that a better manager starts you off with a much smaller hole for the same size pile of sand.
Okay, so let's go back to our two managers. Manager B is still sitting there with that 1-to-1 risk/return ratio. But now let's take Manager A, remember, the one with the much better 2-to-1 ratio, and let's give him a shovel. We'll apply some leverage, and just look at what happens. By tripling our exposure, Manager A is now kicking out a 30% return for only 15% risk. Think about that. That's a higher return than Manager B for lower risk. I mean, the choice is an absolute no-brainer now.
Let's make this even more real. Take a look at this chart. You've got Manager C and Manager D. Now, Manager C ends up with more money in the end, but man, look at that ride. It's a total roller coaster with some nasty drops. Manager D, on the other hand, is a much smoother, less heart attack-inducing journey, even if the final number is a bit lower. So at first glance, you might think, it's a toss-up. Depends on how much stress I can handle.
But hold on. We know better now, don't we? What happens if we take our shovel, our leverage, and just double our bet on the safer Manager D? Boom! Just like that, the whole debate is over. The leveraged Manager D doesn't just beat Manager C, it crushes it. It gives you a way higher return and still has less gut-wrenching drops. Better return, less risk. It proves the manager with the better risk-adjusted profile was the right choice from the very beginning.
So here's the bottom line for this section. Looking at return by itself is a totally broken way to measure things. It tells you the destination, but it tells you absolutely nothing about the crazy bumpy road you took to get there, or if there was a smoother, faster highway available. The return-to-risk ratio, that's what really matters.
Okay, so if we need a good return-to-risk ratio, the financial world has a famous hero for the job, right? It's called the Sharpe ratio. It's everywhere. But as we're about to see, this supposed hero has a pretty serious and kind of weird blind spot.
So the Sharpe ratio is, without a doubt, the most common tool out there for this. All it really does is take your return, subtract a super safe return like you'd get from a government bond, and then divide that by how volatile your investment was. Simple enough. And the rule is, the higher the Sharpe ratio, the better.
All right, let's put our hero to the test. Here are two new managers, A and B. They both end up with the exact same final return. But just use your eyes for a second. Look at the two lines on this chart. Which one feels riskier to you?
I'm going to guess you picked Manager A, right? I mean, look at it. It is these three horrible stomach-churning drops of over 20%. Manager B's worst dip is only 11%. But the Sharpe ratio says that Manager B is riskier. Wait, what? That makes no sense. It completely goes against what our own eyes are telling us. So what on earth is going on?
Well, it turns out the Sharpe ratio has two major flaws. First, it uses average return, which, believe it or not, can be really different from the actual compounded return that shows up in your account. But the really big problem, the one that causes this weird result, is that it punishes all volatility. You see those giant upward spikes for Manager B? The Sharpe ratio sees that as risky and actually lowers its score. It's crazy. I mean, have you ever complained that your investment went up too much in 1 month?
So if the most popular tool in the entire industry can get things this backwards, what are we supposed to use instead? Well, that brings us to our final section. It's time to build a better toolkit with some much smarter ways to measure this stuff.
And here it is. This is the aha moment. We ran the numbers for our two managers, A and B, using a whole bunch of different metrics. And just look at this table. The Sharpe ratio is the lone wolf over there, shouting that manager A is better. Meanwhile, every single other metric, the Sortino, the MAR, the tail ratio, you name it, they all agree with our intuition. They all say manager B is the clear winner, and sometimes by a massive amount.
So why do all these other tools get it right when the Sharpe gets it so wrong? Well, it's because they define risk in a way that actually makes sense to a human being. Take the Sortino ratio. It only cares about downside volatility, the bad kind. It completely ignores those awesome months where you make a ton of money. Others, like the MAR ratio, care about losses being close together, because we all know that a bunch of down months in a row feels way scarier. And something like the tail ratio is super simple. It just looks at how your best gains compare to your worst losses.
And this all leads to a really powerful idea. There is no single best way to measure performance. The right tool for the job really depends on what the word risk means to you. What scares you more? A single, huge, catastrophic loss, or a long, slow grind of losing money month after month? Your personal answer to that question tells you which tool from this new toolkit you should be paying the most attention to.
So let's wrap this up. We've seen that just chasing the highest return is a total trap. We've also seen that the industry's favorite tool for measuring risk can be seriously flawed. But now you're armed with a much smarter way to look at things. So the next time you see some investment with a massive headline-grabbing return, you'll know exactly what to do. You'll know that the first and most important question isn't how high was the return. It's, yeah, but at what risk?
We've all been there. You have a winning idea, a trade that feels like a sure thing, and somehow it turns into a loss. It is one of the most frustrating paradoxes in trading for sure. So today, we're going to break down exactly why that happens and uncover the common mental traps that can sink even the most solid analysis.
So you do all the research, right? The logic is totally sound, you're confident in your analysis, and then the market does the exact opposite of what you predicted. So what's going on here? What is the missing piece when a seemingly perfect setup just completely falls apart? Okay, think about this classic scenario. A big agriculture report is about to come out. You're expecting it to show this massive increase in hog production, super bearish news. The report drops, and guess what? You are right. The numbers are up 8%. So you go short, betting that prices are about to tank. But instead, the market rallies and you're left holding a loss. Ugh. Or how about this one? You're long corn. You're betting on a price increase. Rumors are flying about a huge sale, and then bam, it's officially announced. I mean, this should be a home run. You're already counting the profits in your head, but then you just watch them completely evaporate as the market, for some reason, drops right after the good news hits.
And then there's the one that just seems to defy all logic. A commodity, let's say sugar, is trading below what it even costs to produce it. I mean, it has to go up, right? That's just simple economics. But it doesn't. It just keeps falling, and you're left completely baffled. It's the kind of thing that makes you want to just throw fundamental analysis out the window entirely.
But here's the key. The problem isn't that the fundamentals are useless. No way. The problem is how we're applying them. See, the fault isn't in the fundamentals themselves. It's in our method. It's not the market that's being irrational. It's our approach that really needs a tune-up.
And here's the hard truth of it. A lot of what people call fundamental analysis is, well, either incomplete or just plain wrong. And using flawed analysis, that's actually more dangerous than using no analysis at all. So let's break down some of the most common traps people fall into.
So the first major trap is a complete failure to see the big picture. We get so laser-focused on one single piece of data that we treat it like it's the absolute truth, totally forgetting that context can completely change what it means. Let's see how this plays out.
We're so often asking the wrong question. It shouldn't just be, are the fundamentals bearish? The real question, the one that actually matters, is are they bearish relative to the current price? Think about it. A huge supply surplus might sound bearish at, say, 30 cents, but what if the price has already crashed all the way down to 5 cents? Well, that same surplus might already be priced in. It might even look kind of bullish at that point.
Here is a great example of missing context. A headline flashes across your screen, 10,000 cattle lost in a major storm. Wow, that sounds like a huge deal, right? A really significant loss of supply. Your first instinct is probably to go long, yeah?
But then you zoom out. You get the full picture. That 10,000 is out of a total U.S. cattle population of about 90 million. All of a sudden, it's just a drop in the bucket. The context completely changes the story.
and it makes that headline pretty much irrelevant.
And that leads us right into our second trap, timing. Because listen, even if your fundamental analysis is absolutely perfect, if you get the timing wrong, a winning idea still becomes a losing trade. Every time.
This is one of the most common and most costly mistakes you can make in trading. Thinking that a news story or a research report is some kind of immediate buy now or sell now signal is it's ludicrous. Fundamentals can help you figure out what a fair price might be, but they tell you almost nothing about when the market is going to get there.
Let me ask you a question that really drives this timing problem home. True or false? Higher grain prices lead to higher meat prices. I mean, it sounds logical, right? If it costs more to feed the cattle, then steak should cost more. Makes sense.
Well, the answer actually depends entirely on your time frame. In the short term, the exact opposite happens. When grain prices spike, ranchers who can't afford the feed are forced to sell off their herds. This floods the market, which increases supply and pushes meat prices down. The logical effect you were expecting, higher prices from a smaller herd, that doesn't actually hit the market for 2.5 years, or maybe even longer.
And that brings us to our third and final trap, data deceptions. This is what happens when the very numbers we're relying on don't actually tell the whole story, and they lead us to draw completely wrong conclusions.
See, it's not enough just to have the data. You have to know what you're not seeing. The most important piece of the puzzle can be hidden right beneath the surface. And making a big decision based only on what's visible, well, that can be a catastrophe.
So take a look at this real-world example from the cattle market. Back in late '97, the official cattle on feed report showed a slight decrease, which suggests supply is getting tighter. But at the exact same time, the actual slaughter numbers shot up by over 12%. I mean, how is that even possible?
Well, here was the hidden variable. The cattle on feed data only tracks cattle in feedlots. It completely ignores the growing number of grass-fed cattle. And during this period, there was a major shift toward grass feeding. So while the official data looked bullish, the actual total supply was surging. Anyone trading just based on that headline number would have been totally wrong.
Okay, so now that we've laid out all these traps, the big question is, how do we avoid them? Let's get to the fundamental truth of how to use this kind of analysis to trade a whole lot smarter.
You know, it really comes down to 3 core principles. First, always ask relative to what? Is this news significant relative to the price right now? Is this number big relative to the total supply? Second, you have to separate your analysis from your timing. Use fundamentals to form your big picture view, your thesis, but do not use them to pull the trigger. And third, look beyond the headline. You have to be a detective. Always ask, what is this data not telling me?
At the end of the day, the market isn't irrational, and fundamentals aren't useless. The real challenge, the real work, isn't how we interpret and apply them. That paradox of a good idea turning into a bad trade, it isn't a failure of the market. It's a flaw in our own process. And mastering that process, well, that's the key to the whole game. Thanks for joining me for this one.
All right, today we're going to unpack a concept that trips up even seasoned pros and honestly leads to some major misreads of the economy. We're talking about the critical difference between demand and consumption. Getting this right is absolutely key to understanding where markets are really headed.
So, picture this. You see a headline saying, people are buying more of something. More cars, more pork, whatever it is. Your first thought is probably, wow, demand must be booming, right? It seems totally logical. But what if I told you that's not always the case? What if, sometimes, it actually means the exact opposite?
And look, this isn't just some dusty textbook detail. Getting this one distinction wrong can lead to some seriously costly mistakes, whether you're an analyst, an investor, or just someone trying to make sense of the financial news.
To solve this puzzle, we've got to go back to basics for a second. Just a quick refresh on the simple ground rules of supply and demand. It'll all make sense, I promise.
Okay, first up, the supply curve. It slopes upward, and the logic is super simple, right? When the price for a product is high, producers are way more motivated to make and sell it. Why? Because it's more profitable, so they'll offer more of it to the market.
Then you've got the flip side, the demand curve, which, as you can see, slopes downward. This is something we all get instinctively as shoppers. The cheaper something is, the more of it we're willing to buy. Simple as that. Now this is where the magic happens. When you put those two forces together, the market finds its happy place, its balance. We call it equilibrium, right where those two curves cross. And that one single point is so important because it determines both the market price and the actual quantity that gets bought and sold.
All right, with those fundamentals down, let's get to the real heart of the matter. We're about to see precisely why that quantity that gets bought and sold, the thing we call consumption, is fundamentally different from demand.
Okay, this slide right here, this is the whole ballgame. Demand isn't one number. It's the entire relationship, the whole curve of how much people would buy at a full range of different prices. It's driven by big picture stuff, like how much income people have or what's trendy. But consumption is way simpler. It's just that one specific number, the amount that is actually bought at today's market price.
And here's the real chain of command. This flowchart lays it out perfectly. You've got factors that influence supply and factors that influence demand. Those two big forces meet in the middle and they determine the price. And only then does that price determine how much is actually consumed. It's a one-way street, you guys.
So, if there's one thing you take away today, let it be this. Consumption does not determine the price. It is a result of the price. It's the consequence, the aftermath, of that epic tug-of-war between supply and demand. Consumption is the effect, not the cause.
Let's make this real. Let's talk about pork. In the short term, the supply of pork is pretty much fixed. I mean, you can't just snap your fingers and create more pigs, right? That's why the supply line on this graph is a straight vertical line. The quantity is set. So no matter where that demand curve moves, the amount consumed is locked in by what was produced. What does that mean? It means if pork consumption suddenly jumps, it's not a signal of stronger demand. It just means more pork hit the shelves, which could actually be a negative or bearish signal for prices.
Okay, enough with the theory. Let's see how this common mistake played out in the real world with a fascinating, kind of weird puzzle from the copper market back in the early 1980s.
So this is where things get really strange. Between 1980 and 1982, the price of copper, that's the black line, absolutely cratered. It just fell off a cliff. But at the exact same time, the white line, which is the stock-to-consumption ratio, was also falling. Now that ratio is basically a measure of how much inventory you have versus how much is being used. A low ratio means inventory is tight, which should push prices up, not down.
So, how is that even possible? I mean, come on, right? Every conventional metric was screaming that the market was tight. Supply was low, and yet prices were in an absolute free fall. What on earth was everyone missing?
The answer was the ghost in the machine. It was the invisible variable, demand. The models that were just focused on supply stats and consumption numbers were completely blind to a massive, gut-wrenching downward shift in the entire demand curve, which was being caused by a nasty recession and sky-high interest rates back then.
And here's the crazy part. The clues were hiding in plain sight if you just knew where to look. Check out these charts. They show that activity in the big copper-using industries, things like new home construction and car sales, had started to tank before the price crash. This was the true signal that actual real demand was collapsing, no matter what the supply stats seemed to be saying.
Okay, so if demand is this invisible yet incredibly powerful force, how in the world are professional analysts even supposed to track it? Let's take a little peek inside their toolkit.
Well, since you can't just look up demand on a screen, analysts have a few clever workarounds. For some really stable markets, they might just assume demand is constant and focus on supply. Or they might just model a simple, steady growth pattern, like say 3% a year. But a much sharper way to do it is what we just saw with copper. You track other things that influence demand, like those housing starts or auto sales. And then, only in really rare cases, like when demand is what they call inelastic, meaning it doesn't change much with price, they might use consumption as a rough stand-in.
But all those tools kind of rely on demand being tied to something real, something tangible like industrial activity. So what happens when a market isn't driven by tangible use at all? Well, that brings us to our final case study, a market that defies almost all traditional analysis, the fundamental analyst's nightmare, the gold market.
So why is gold so darn tough to figure out? Well, for starters, its demand isn't driven by industrial use like copper is. It's driven almost purely by human psychology. It reacts to this chaotic mix of things like fear about inflation, changes in interest rates, political drama. And get this, even the supply is erratic. It's not just about what comes out of the mines. It's also about when millions of people all over the world decide to either hoard the gold they already have or suddenly sell it.
It's summed up perfectly by the legendary market analyst Jack Schwager, who said, "The combination of highly erratic, intangible supply and demand curves makes the gold market a fundamental analyst's nightmare." He even called trying to analyze it based on mining stats true folly.
And that really leaves us with a huge, kind of mind-bending question, doesn't it? If a market is driven primarily by human psychology, by our collective fear and greed, can it ever be truly predicted with data alone? It's a powerful reminder that behind all the charts and models, economics is, at its heart, really just a study of human behavior.
Have you ever just stared at a market chart and thought, how could anyone possibly predict what happens next? It can look like pure chaos, right? Well, today, we're going to peel back the curtain on that chaos. We're going on a journey through fundamental analysis, from a veteran's gut feeling all the way to some seriously complex data models. So let's jump right in.
You know, this quote from Lord Kelvin really gets to the heart of the matter. Is analyzing a market an art form, something based on a gut feeling you get after decades of experience? Or is it a science, something you can break down into cold, hard numbers? Well, as you're about to see, the real answer is a little bit of both.
And that really is the million-dollar question, isn't it? How do you find the signal inside all of that noise? You know, over the years, analysts have come up with a whole toolkit of different methods, each with its own unique flavor. So let's meet our cast of characters, so to speak.
Our first stop is with an analyst we're going to call the artist. Now, this approach isn't about spreadsheets or fancy algorithms. No, this is all about experience, intuition, and what some people might even call a sixth sense for the market.
See, the old hand lives and breathes their market. They're constantly talking to people, getting a feel for the market's tone, and judging how it reacts to news. So in a way, the analyst becomes the computer, processing tons of non-numerical clues. You know, the conversations, the sentiment, the overall mood, and it's all based on pure, hard-won experience. And that's the real trade-off here, right? A really experienced old hand can sometimes run circles around the most complicated computer models. But that magic, it's tied to one person. It's not a system you can write down in a book and teach someone. It's a skill you only earn after years and years in the trenches.
Okay, so now let's add a little bit of structure to all this. Our next analyst, who we'll call the accountant, isn't satisfied with just a feel for the market. No, they want to see the numbers. They want to see it all in black and white. They want to balance the books.
And the accountant's main tool is the balance table. The easiest way to think about it is like an income statement, but for a commodity. It just systematically organizes all the key supply and demand statistics to find that one crucial bottom line. How much is actually left over at the end of the season?
And what's great about this is how simple and powerful it is. You start with the total supply. That's everything that's available. Then you subtract the total disappearance, which is just a fancy way of saying everything that got used up. And whatever is left over, that's your ending stocks. And believe me, that is the key number everybody is watching. But, you know, just looking at the raw number for ending stocks doesn't tell you the whole story. The real magic happens when you look at that number as a percentage of how much was actually used. For the 91-92 season, that number was 20%. And that single percentage tells you if the market is tight, with a really thin cushion, or if it's just flush with supply.
All right, next up, let's meet the historian. Now, this type of analyst lives by the old saying, history doesn't repeat itself, but it sure does rhyme. And their whole job is to find those rhymes in past market data to figure out what's happening right now.
So the way they do this is with something called the analogous season method. They basically go on a treasure hunt through the past, looking for years where the fundamental setup, you know, things like production, usage, stock levels, looked a whole lot like the situation we're in today. Those past seasons then become a potential roadmap for what might happen next.
And it's a really methodical process. First, you've got to identify those similar seasons. Second, you analyze their key price turning points, like the low point at harvest or the high point after. Third, you calculate the timing and size of those price swings. And finally, you use all that historical data to project a range of possibilities for the current season.
Okay, for our final stop, we're heading into the lab to meet the scientist. This is where we go all in on Lord Kelvin's idea. It's all about measurement, all about the numbers. The scientist isn't happy with just roadmaps or snapshots. They want to build an actual predictive machine.
And here's the big puzzle they're always trying to crack. In any real market, you've got dozens of factors all pushing and pulling on the price at the same time. You know, maybe hog slaughter is down, but cattle slaughter is up. So how on earth do you weigh all those competing forces to come up with a single price forecast that you can actually defend?
Well, one of the most powerful tools in their toolkit is something called regression analysis. It's this really cool statistical technique that takes all your different inputs and figures out the precise mathematical relationship between them and the final price. It literally builds a formula for you.
Yeah, think of it like a price recipe. Regression analysis figures out the precise amount of each ingredient, like hog slaughter or broiler slaughter, that goes into the final price. It actually assigns a weight to each factor, telling you exactly how important each one is in the final mix.
But what if you have way too many ingredients for a single recipe? What happens when you're tracking dozens and dozens of economic indicators, monetary policy, inflation stats, the whole shebang? Well, that's where index models come into play. They are built for exactly that kind of data overload.
And when I say overload, I really mean it. It's not uncommon for these models to include 50 or even more different variables. Now, trying to cram all of that into one of those price recipe equations, it just wouldn't work. The stats would completely fall apart. An index model gives you a way to distill it all.
But the way it works is actually pretty clever and surprisingly simple. You take each indicator and you score it. Is its trend bullish, meaning good for prices? That gets a +1. Or is it bearish, meaning bad for prices? That gets a -1. Then you just add up all those scores. Finally, you normalize that sum to a nice, clean scale, usually from -100 to +100. And boom, you've got one single, clear number that tells you the market's overall health.
So there you have it. We've gone all the way from the gut feeling of our old hand to the complex computer models of the scientist. But the most important thing to remember here isn't that one is better than another. It's that they all form one big, powerful toolkit.
So you've got the old hand with that pure intuition, the balance table for that quick snapshot of supply and demand, analogous seasons, which uses history as your roadmap. You've got regression analysis, your price recipe for a few key factors, and index models for when you need to boil down tons of factors into one simple score. A truly great analyst knows how to pull the right tool from the kit for the right job.
And that brings us to our final question, and this one's for you to think about. When you look at a complex problem, where do your instincts take you? Are you drawn to the art of experience, the clean clarity of a balance sheet, the patterns you see in history, or the beautiful precision of a formula? Understanding your own approach, well, that's the first step to mastering any kind of analysis.
You know, when it comes to analyzing markets, we're all about the data, right? We want the most accurate, final, revised numbers to tell us what really happened. But here's a wild thought. What if the real story isn't in that final data at all? What if the most powerful force in the market is actually what people thought was going to happen, even if they were completely wrong? And that is where things get really interesting.
Turns out, the 19th century British Prime Minister Benjamin Disraeli kind of nailed a fundamental truth about markets. It's not just about what is, it's all about what we anticipate. That collective expectation, it's like this massive gravitational force, It's pulling the present towards a future that, well, might not even happen.
And that idea leads us right into something I like to call the perfect data trap. It's a super common mistake. And honestly, we've probably all made it when trying to figure out why a market did what it did.
So let me ask you this. Let's say you're trying to build a model. You want to understand why prices went haywire last year. What's the data you reach for?
I mean, the answer seems pretty obvious, doesn't it? You're going to want the final corrected stats, the numbers that have been double-checked, triple-checked, and polished to perfection to show the absolute truth. It's a total no-brainer. Or is it?
Okay, let's make this real. Think about something like U.S. corn production. All through the growing season, the government puts out these estimates. But that's just what they are. Estimates. They get revised and then revised again. And the final, actual number? We don't get that until way, way after the season's over. And believe me, those early guesses can be miles off from the final count.
So this whole thing sets up this huge conflict for anyone trying to make sense of the market. It's this epic battle, really. Expectations versus reality.
And this is the absolute key. Just picture it. The farmers, the traders, the big buyers, they're all making massive decisions in the heat of the moment. Did they have those perfect final numbers? No way. So, what data were they actually looking at?
And this slide just lays it all out, perfectly. On one side, you've got the actual truth, the hard facts, the perfect data we only get with the benefit of hindsight. But on the other side, you've got the perceived truth, That's the messy, incomplete data that was the only thing anyone had to go on at the time. The market wasn't trading on reality. It was trading on a story, a shared perception of what they thought reality was.
And this is the takeaway, right here. When you're trying to explain why prices moved, what the market believed to be true is so much more important than what the final, revised facts said later on. Prices are just a reaction to the story people are telling themselves with the info they've got.
But wait, it gets even crazier. See, it's not just about what people believe is true right now. The market is always being pulled forward by what it expects for the future.
So what does this look like in the real world? How do we model it? Well, check out these 4 approaches. Step 1 is the basic model. You just use the final actual stats. Simple enough. Step 2 is a little better. It uses the estimated data, the stuff people were actually seeing at the time. But the really powerful models, that's where you get to steps 3 and 4. They go a step further and start plugging in expectations for the next season.
And here's the real kicker. So often, especially late in the season when we kind of know the current supply situation, the market's wild guesses about the next season can have a way bigger impact on today's price than today's actual numbers. It's like the future is literally reaching back through time to mess with the present. Okay, how is that even possible? It really just boils down to some pretty simple supply and demand psychology. Think about it. If everyone, and I mean everyone, expects prices to be higher next year, what do they do today? Well, sellers are going to hold back their product, right? They want to sell it for more later. And buyers, they're going to try to stock up now before prices shoot up. What's the result? Both of those actions shrink the available supply and jack up demand right now. And boom, current prices go higher. And all of this leads to this absolutely fascinating, totally counterintuitive result. It's what you could call a bullish paradox, where good news about the future creates this really weird effect on today's data. I know, it sounds kind of impossible, doesn't it? How on earth can being optimistic about the future make the current data look, well, bad, fundamentally bearish? Okay, so this diagram here shows the chain reaction that is the very heart of this paradox. It's a sequence of events that seems to fly in the face of logic, but trust me, this is exactly how it plays out in the market. Let's break it down step by step.
Okay, so it all starts here. The market gets super bullish, super optimistic about the new crop season. Everyone's thinking high demand, tight supply, whatever, prices are going up in the future. And like we just talked about, that expectation immediately starts pushing up prices in the current or old crop season.
All right, so what happens when today's prices go up? It's Econ 101, right? Demand goes down, people start using less, and international buyers start looking elsewhere. So consumption and exports of the current crop start to drop.
And if less of that old crop is getting used up, what happens? Well, more of it gets left over. The amount of inventory, the stocks, starts to pile up. Now, if you were only looking at that one data point, rising inventory, you'd think, wow, things look pretty bearish.
So you end up in this totally bizarre situation. You've got a market where prices are high, they're still rising, but the hard data, those leftover stocks, is screaming bearish. It looks, for all the world, inexplicably overpriced. The only way it makes sense is when you realize the price isn't being driven by today's data, it's being driven by tomorrow's expectation.
So, after all that, what is the big takeaway here? I think it fundamentally changes the way we have to think about analyzing any market.
And here is why this is so important. See, real market analysis, it's not just about crunching the final perfect numbers. It's more like being a historian and maybe a bit of a psychologist. Your job isn't really to analyze the data. It's to analyze the story the market was telling itself with the flawed, incomplete data it had at the time. If you can understand that story, you can decode why prices moved, even when the final numbers say they never should have. And that leaves us with one last question to chew on. The next time you're looking at a historical chart and you see a price move that makes absolutely no sense based on the final data, just stop and ask yourself, are you seeing a record of what was, or are you seeing the ghost of a future that everyone simply thought would be?
Have you ever looked at a price chart from, say, 20 years ago and thought, wow, things were so cheap back then? Well, today we're going to pull back the curtain on a powerful economic illusion that completely messes with our perception of value. And honestly, getting this right might just change the way you see prices forever.
Okay, let's dive right in with a real-world example from the commodity markets. Now, on the surface, this looks like an amazing 17-year-long winning streak for investors. But as you're about to see, not everything is as it seems. So, Take a look at this chart for live cattle. That solid line, that's the price you would have seen on the market. From 1995 all the way to 2011, the price looks like it's on an absolute rocket ship to the moon. I mean, it seems like an undeniable, super powerful bull market. You'd think anybody who invested in this made an absolute fortune, right?
But what if I told you that this entire 17-year climb was basically a mirage? That the real value of that investment had barely moved an inch?
You see, the secret culprit behind this whole illusion is a force that hits all of us every single day: inflation. So to really understand what's going on, we need to learn how to see two completely different kinds of prices.
First up, you've got the nominal price. This one's super simple. It's the number you see on the price tag at the store or the price you see on a trading screen. It's just the price in that day's dollars. Easy enough.
But then there's the real price. And this is where it gets really interesting. The real price is the price after you adjust it for inflation. It tells you what something is actually worth in terms of purchasing power, because it gets that a dollar today isn't the same as a dollar from 20 years ago.
And wow, this quote from analyst Jack Schwager just hits the nail on the head. He says, comparing nominal prices over a long time is like comparing a price in US dollars to a price in euros. I mean, you just can't do it, right? They're both called money, but they represent totally different values.
So let's go back to our live cattle chart. Now, look at that dashed line. That is the real inflation-adjusted price. And over that exact same 17-year period, it was basically flat. That whole rocket ship ride we saw before, poof, it was just inflation. The illusion is totally busted. And here's the thing. This isn't just some weird one-off fluke in the cattle market. No way. Once you know what to look for, you start seeing this illusion absolutely everywhere. Just take a look at these two markets. On the left, we've got lumber. What looked like a record high price in 2004 was, in real terms, actually lower than previous peaks. And on the right, it's the exact same story for soybeans. A so-called record price in 2004 was actually weaker than the high that was set way back in 1997, once you factor in inflation. And here we go again with the copper market. You see that huge run-up in the nominal price, that solid line? But when you look at the real, inflation-adjusted price, that's the dashed line, the price at the end of the period was pretty much unchanged from where it started. It's the same illusion, just playing out in a different market.
Okay, so you're probably thinking, how do we fight this illusion? How can I see the real price for myself? Well, good news. The methods that analysts use are actually pretty straightforward. So there are basically two main ways to do this. First, you can deflate prices. All that means is you take an old price and you divide it by an inflation index, something like the producer price index. This just puts everything on a level playing field. Or the second way is just to do the reverse. You take all the past prices and you convert them into today's dollars using a multiplier.
Let's make this real. This table for corn prices shows you exactly how this works. Look at the nominal price in 1995. It was $325. By 2014, it was almost $358. So that looks like a price increase, right? But nope. When we convert both of those prices to $2015, you see that the 1995 price was actually worth over $480 in today's money. Way, way higher than the 2014 price. See? Without this simple adjustment, you'd get the story completely backward.
Now, just when you think you've got this all figured out, the economy loves to throw a curveball. Believe it or not, there was actually a period where ignoring inflation might have accidentally led to better predictions. I mean, how is that even possible?
It's a total paradox. The source material points out that for a little while, these simple, kind of naive models that didn't even account for inflation actually worked better. This seems to contradict everything we've just learned. So what on earth was going on? Well, the answer is in the really unique economy of the early 1980s. See, after 1979, we had both crazy high inflation and incredibly high interest rates. So think about it. If it costs you a ton of money to borrow, you're not going to keep a giant warehouse full of stuff you haven't sold yet, right? It's just too expensive. So businesses everywhere started keeping way less inventory. This created a massive sustained drop in demand for raw materials, which pushed prices down. For a while, this huge downward pressure on prices was so strong that it basically canceled out the upward push from inflation. It was like two giant forces pushing against each other to a complete standstill. Wild, right? So after all that, what's the bottom line? What's the one critical thing you need to remember from all of this? It all boils down to this. You have to look past the sticker price. Nominal prices can be incredibly misleading because the value of the dollar itself, our measuring stick, is always changing. To see the true story of any price over time, whether we're talking about cattle or cars or anything else, you have to look at the real inflation-adjusted price. And that's really the power of this knowledge. You now have a tool to see through one of the most common economic illusions in the world. So my question to you is, the next time you see a headline about record high prices, are you going to see the full picture? What other illusions are you going to start to uncover? All right, let's jump right in. You've probably heard those old market sayings, right? Sell in May and go away. Or, that heating oil always spikes in the winter. Well, these ideas all come from something called seasonal analysis. It's this belief that you can predict market moves just by looking at the calendar. But here's the big question. Is this some kind of secret code to making a fortune? Or is it basically just fool's gold? So, do markets really tick along with the calendar? I mean, it kind of feels like they should. Our whole world runs on seasons. But when it comes to trading, what looks obvious on the surface, well, that's often a trap. We're going to unpack exactly why, using some amazing insights from trading expert Jack Schwager. At first glance, this stuff makes perfect sense. Of course, corn prices would be at their lowest when farmers are flooding the market with supply during harvest. And it just feels intuitive that heating oil would get expensive when everyone's cranking the heat in the middle of winter. This simple, common sense logic is what makes seasonality so appealing. And yeah, that simple logic is exactly why the idea of seasonal trading is so tempting. It feels like it's grounded in the real world, like there's a predictable rhythm you can latch onto in the middle of all that market chaos. So, just to be super clear, this is what we're talking about. Seasonal analysis is the whole idea of studying these predictable biases. It's built on the assumption that because of real-world things like harvests, weather, or even boring stuff like end-of-year financial reporting, prices are just more likely to go one way over another during certain times of the year. But here's our first big plot twist. The market isn't just reacting to what's happening right now. No, it's a giant forward-looking machine, constantly trying to guess the future. And that changes everything. This quote from our source material really just nails it. Traders don't sit around waiting for the first snowflake to buy heating oil. Come on, they know winter's on its way, so the market discounts it. It prices in those expected events way ahead of time. And check this out. This chart of the seasonal index for heating oil proves the point perfectly. You'd think the price would peak in, December, January? Right when it's coldest? But nope, look closer. The peak is actually way back in September and October. So why is that? It's because that's when traders are anticipating winter demand and buying up front. By the time you and I are actually cranking up the heat, that whole predictable event, it's already baked into the market price. This brings us to an even deeper, more fundamental question. Even when we do find a pattern that seems to work, how do we know it's a real, repeatable thing and not just, pure random luck? Our brains are incredible pattern-matching machines. It's what we do. We see faces in clouds, we see animals in the wood grain of a table, and we definitely see profitable trading patterns in totally random market data. The danger is that randomness itself can create these incredibly convincing illusions of order. Okay, to really get this, our source suggests a simple thought experiment. Let's just pretend a market's weekly move is a coin toss. Heads, the price goes up, tails, it goes down, a perfect 50-50 shot. Now, for any given week of the year, we're going to flip that coin 10 times, one for each of the past 10 years, to see what kind of pattern we get. So if you do this for all 52 weeks of the year, what do you think the odds are that you'll find at least one week where the coin landed on heads or tails 9 out of 10 times? The answer is a shocking 75%. Think about that. In a single, completely random market, you have a 3 in 4 chance of finding what looks like a super reliable seasonal pattern. Okay, but hold on, because it gets even crazier. What if you're not just looking at one market? What if you scan, say, 25 different markets? Well, the chances of you finding a bunch of these so-called 9 out of 10 patterns, it becomes a virtual certainty. I'm talking 99.999%. So the takeaway here is absolutely critical. Just finding a pattern in old data, while on its own, it means almost nothing. So, the big lesson here is that you will find these patterns if you go looking for them.
even where no real market edge exists. It's just a mathematical certainty. The more data you crunch, the more of these statistical ghosts you're going to dig up. And that's exactly why we have to be so careful. All right, so now that we're all properly skeptical, let's take a quick look at how these seasonal charts, or indexes, are actually put together. Because if you understand how the tool is built, you can better understand its limits. So how do they make these charts? Turns out there are two main recipes. The first one, the average percentage method, is super simple. It just averages prices over a bunch of years. The problem? It gets totally distorted by a market's long-term trend. The second method, the link relative method, is way more complex, but its whole goal is to surgically remove that trend so you can get a purer look at just the seasonal effect. This heating oil chart shows the difference perfectly. See the solid line? It's getting pulled up and up over the course of the year. That's because, over decades, the price of oil has generally gone up. That's the long-term trend messing with the data. But the dotted line? That one has had the trend taken out. And what you're left with is a much clearer peak and valley shape, which is way closer to the pure seasonal influence we're trying to find. So after all this, what are we left with? If patterns can just be random noise and the charts are distorted by trends, what's even the point? Well, the point is this. We have to see seasonal analysis for what it is. It's a tool in the toolbox, not a crystal ball. And honestly, our source material could not be any clearer on this. This is the final word from the author. Seasonal tendencies are, at best, a gentle breeze pushing the market. A powerful storm, like some big fundamental news or a huge technical breakdown, can completely overwhelm it. So here's our final verdict. Think of seasonal analysis as a piece of context, maybe one more layer you add to your research, but it should never, ever be the only reason you make a trade. It's a potential tailwind, sure, but it is not your navigation system.
And that really leaves us with the one critical question you should ask yourself from now on. The next time you see some chart that shows a market going up in the same month 8 of the last 10 years, just remember this explainer and ask yourself, am I looking at a real secret signal from the market, or am I just seeing a face in the clouds? Thanks for tuning in.
You've seen it happen a million times. Some huge economic report drops, the market just explodes higher, and suddenly all the headlines are screaming, bull market. But here's the thing. Is that initial knee-jerk reaction a real signal, or is it something else? Today, we're going to dig into a framework for reading the market's mind, for figuring out what it's really trying to tell us after all the noise and chaos of a big news event. And you know, this quote from the legendary trader Jesse Livermore just nails it. It's the perfect way to kick things off. It's a reminder that it doesn't matter what you or I think the news means. Our opinion on whether something is good or bad is, frankly, irrelevant. The only thing that counts is the market's final verdict, which is the price. Our job is just to learn how to read that verdict correctly. So that brings us right to the core question, the big mystery we're trying to solve here. When you see that massive, instant surge on what seems like great news, can you trust it? Is that the start of a real, sustainable trend? Or is it just a trap, a flash in the pan that's going to reverse and burn everyone who jumped in late? Okay, so to get past the guesswork, we need a real process, right? The source material gives us a pretty simple 3-step method to actually test the market's initial move and see if it has any power to predict what's coming next. This is all about getting away from gut feelings and starting to look at the cold, hard data. And the method itself is actually super straightforward. First, you pick a recurring important event. Something like the monthly U.S. jobs report is perfect because it happens all the time and we get a ton of data points. Step 2, you look at what happens right after the report comes out, and then you compare it to how the market actually behaves over the next few days or weeks. And then step 3, you hunt for patterns. You look for consistent, repeatable behavior in all that data. That's where the insights are hiding. All right, let's put this theory into practice. For our first case study, we're starting with a big one, U.S. 10-year Treasury note futures. This is one of the most important markets on the planet. The analysis here looked at how this market reacted to the jobs report for a full decade, from 2006 to 2015. So we've got a really solid chunk of data to work with. But first, we need to set some rules. What do we even mean by a strong reaction? Well, for this study, a bullish response was simple. A day when T-note futures closed up by 0.5 point or more. And a bearish response was just the opposite, a closing loss of 0.5 point or more. This gives us a really clear, objective way to filter our data. No opinions, just numbers. And this is where it gets really interesting. Look at the chart on the left. This shows what happened after one of those big bullish report days. See that solid black line? That's the average return. It almost immediately goes negative. The market, on average, actually went down after an initial pop. Now look to the right. After a big bearish drop on report day, the market tended to rally. That black line shows a clear move up. It's totally the opposite of what you'd expect. A perfect example of a market head fake.
Let's just put a number on that because this is pretty wild. 2 days after a supposedly bullish jobs report, T-notes were on average down by 0.205 points. In fact, they closed lower 73% of the time over that 2-day stretch. That big, strong open wasn't a signal of strength at all. It was actually a sign of coming weakness. So, what's the takeaway? In the Treasury market, at least during this period, that big, bullish jump on Newsday was basically like a quarterback faking a throw. It got everybody looking in one direction, but the real play, the actual move, was going the other way. It was a classic trap for anyone who chased that initial burst of excitement.
Okay, but that's the bond market, right? It can be a weird animal. What about the stock market? Does the S&P 500 play by the same rules after a jobs report? Or does it have a totally different personality? Let's take a look. And what's fascinating here is that we see a completely different pattern. For the S&P 500, what happened after a bullish day was kind of random. There wasn't a clear signal. But after a bearish day, and the study defined this as a close in the bottom 25% of the day's range, well, that weakness tended to stick around. You can see it in the chart. The average performance stayed negative for the next 5 trading days. So here, weakness actually led to more weakness. It's a momentum pattern totally different from the reversal we saw in bonds.
So far, we've looked at scheduled events, things that happen every month. But what about those huge, out-of-the-blue shocks to the system? You know, the big geopolitical moments. Because sometimes the loudest message the market can send isn't what it does, it's what it fails to do when everyone expects it.
This chart tells an incredible story. It's January 1991. U.S. airstrikes begin against Iraq. The entire world is on edge. And what's the one asset everyone expects to go to the moon? Gold, right? The ultimate safe haven. It did spike higher overnight, but then the strangest thing happened. It just collapsed. It completely fell apart. By the time the U.S. markets opened, it was in a freefall. The fact that gold couldn't rally on what should have been the most bullish news imaginable was a giant red flag, and it correctly signaled that the metal was fundamentally weak for months. Classic, buy the rumor, sell the news.
Now, this is all fascinating stuff, but we need to pump the brakes for a second and have a reality check. It is so important to understand that this kind of analysis is a fantastic tool for thinking about the market, but it is not, I repeat, not a magic formula for making money. There are some really crucial limits you have to keep in mind.
So, here are the 3 big ones. First, your results can change dramatically based on how you set up the test. If we had defined a bullish day a little differently, we might have gotten totally different results. Second, you need a lot of data. If you only have a few examples, your findings might just be random noise, not a real pattern. And third, and this is probably the most important one, market patterns change. They can shift, they can fade, they can disappear completely. What worked for the last 10 years is never ever a guarantee that it'll work for the next 10.
So you really have to see this for what it is. This is not some mechanical trading system that you can just turn on and let run. It's an analytical framework. It's a lens that helps you better understand market psychology and figure out if that initial pop or drop is based on real conviction or if it's just a temporary burst of emotion. And really, that's what it all comes down to. This whole process forces us to change the question we ask. We need to stop asking, what's the news, and start asking the much, much smarter question. How is the market reacting to the news? Because that reaction, with all its head fakes, its follow-throughs, and its surprising failures, that's where the real story is usually hiding.
Hey everyone, and welcome. Today, we are going to pull back the curtain on how the pros really build models to forecast commodity markets. Look, this is not about crystal balls or just having a hunch. It's a real, systematic process. It's about turning a mountain of information into a real predictive edge. So let's dive in. And this quote from Milton Friedman, it just sets the perfect tone. Forecasting isn't magic, it's a science. It's about building a body of knowledge so that when things change, and they always do, you can make an educated prediction about what happens next. It's a fantastic question, right? I mean, think about it.
We have these unbelievably complex models for predicting the weather. So why can't we just create one for the markets? Plug in a few variables and boom, get a perfect forecast for corn or oil or gold. Well, the answer to that question is really the key to this entire process.
And here's that answer. The word is heterogeneous. See, unlike the atmosphere, which follows the same laws of physics pretty much everywhere, every single commodity market is its own little universe. It has its own rules, its own quirks. You simply cannot use a map of the corn market to find your way through the copper market. Each one is a totally unique puzzle.
And these are just a few of the things that make each puzzle so different. Just think about storability for a second. You can store gold pretty much forever, right? But live cattle? Not so much. Or think about what moves the price. Oil prices can swing wildly based on geopolitics, while sugar prices might depend almost entirely on government subsidies in one or two countries. So a one-size-fits-all model? It's just guaranteed to fail.
So here's our game plan for today. We're going to start with a really important choice that every trader has to make. Then we'll walk through the three main phases of building a model. First, laying the foundation, then actually constructing the thing, and finally checking it against the real world. And to wrap it all up, we'll see how you take all that analysis and turn it into an actual trade.
All right, Section 2, 3 paths for traders. Now, because this kind of deep analysis takes an enormous amount of time, every trader has to make a big choice right at the very beginning. You just can't be an expert in everything.
So practically speaking, you have 3 alternatives, 3 different ways to approach fundamental analysis, and the path you choose is absolutely critical.
So here are your 3 paths. First up is the superficial approach. Just a quick glance at the headlines, the key stats, across a whole bunch of different markets. The source material is really clear on this one. Avoid this path. The second option is the in-depth approach. You become a genuine expert, but only in 1 or 2 markets. This is the one we recommend. And finally, there's relying on published research from other people. Now that can be a great supplement, for sure, but it should never be a replacement for doing your own homework.
And this quote right here is exactly why that first path is so dangerous. The idea is so powerful. If you're totally ignorant, you're probably going to be cautious. But if you have just a little bit of knowledge, that can create a false sense of confidence, and that's what leads to the really big mistakes. The takeaway is simple. Go deep, not wide. Okay, on to Section 3, Phase 1, laying the foundations. So let's say you've picked your market, you're committed to that in-depth path. Now it's time to start the 13-step process, and we begin with Phase 1, building a solid foundation. You just can't build a strong analytical house on shaky ground.
These first 3 steps are totally non-negotiable. First, you've got to read everything you can get your hands on. You have to understand the story of your market. Second, you gather all the important statistics. This is the raw material you'll be working with. And third, and this is a huge one people often skip, you have to adjust all your historical price data for inflation.
And when we say gather statistics, we're talking about getting hard data from serious sources. For anything agricultural, for example, the USDA is the absolute gold standard. The CRB Commodity Yearbook is another fantastic resource for a ton of markets. Honestly, the background reading you do in Step 1 will point you to exactly where the best data is for your specific market.
So why is adjusting for inflation so critical? Well, think about it. $1 back in 1985 is not the same thing as $1 today. So comparing the price of soybeans from 40 years ago to today's price is, well, it's meaningless. By adjusting for inflation, you create what's called a real price history. It lets you make legitimate apples-to-apples comparisons across time.
Next up, Section 4. Phase 2, building your model. Okay, our foundation is set. Now we get to the heart of the project, taking all that background knowledge, all that raw data, and actually building a forecasting model. This is where the art and the science of it really come together.
So this phase has 5 key steps. You start by building an initial model that tries to explain past prices using your data. Then, and this is key, you modify it. You look for the years where it failed, and you try to figure out why. Third, you can try to bring in market expectations, like what other analysts are forecasting, to see if that helps. Fourth, you estimate what your key variables will be for the next year. And finally, you use all that to generate not just a single price point, but a probable price range, because let's be honest, no forecast is ever perfect.
Now hang on, let's pause on that 5th step for a really critical warning. It is so tempting to see a year where your model just completely blew up and just delete it, to make your results look better. You cannot do that. Unless something truly insane and unrepeatable happened, like a government price freeze, that outlier year is trying to teach you something important about your market.
Deleting it isn't analysis. It's just hiding from the truth. Okay, Section 5, Phase 3, Real-World Checks. So you've built this beautiful, statistically sound model. That's fantastic, but it is not enough. Phase 3 is all about taking that model out of the clean, theoretical world of your spreadsheet and pressure testing it against the messy, unpredictable factors of the real world.
And there are three main reality checks here. First, are there any government programs or regulations that could just completely override the market forces your model relies on? Second, what are the normal, seasonal price patterns for this market? And third, how does this market usually react to big news and reports? That behavior can give you some amazing clues.
And this right here, this is a real pro-level insight. It's not just about knowing the typical seasonal pattern, like, say, corn prices usually go down during harvest. What's even more powerful is spotting when the market violates that pattern. If corn prices are actually rallying hard in the middle of harvest, whoa, that's a huge signal of underlying strength that your model might be missing.
And that brings us to Section 6, from analysis to action. All right, we have done the reading, we've built the model, we've checked it against reality. Now we get to the final and, let's face it, the most important part, turning all of this hard work into an actual actionable trading decision.
This really is the moment of truth. You've got this carefully constructed forecast for where the price should be. So now what? How do you actually bridge that gap between your analysis and clicking the buy or sell button?
Well, it comes down to these last two steps. First, you have to assess if there's even an opportunity to begin with. Just because you have a forecast doesn't mean you have a trade. And second, and this is everything, you have to time the entry. Remember, fundamentals are great at telling you what should happen, but they're often terrible at telling you when it will happen.
Here's the best way to think about Step 12. A real opportunity only exists when the current market price is outside of your projected fair value range. So if your model says oil's fair value is somewhere between $80 and $90 a barrel, and it's trading at 85, there's no edge there. The opportunity only shows up when the market price deviates in a big way, like if it's trading down at 70 or way up at 100.
So, as we wrap this up, I want to leave you with this one last thought. After going through this whole rigorous process, what have you really created? It's not a crystal ball. It doesn't give you perfect certainty. What you've built is a compass. It's a tool that's designed to give you a directional edge, a guide to what value looks like, and a framework for making smarter decisions in a world that is full of uncertainty.
Hey, welcome to The Explainer. This is where we take big, complex ideas and, we break them down by looking right at the source material.
I love starting with this thought from T.S. Eliot. It's so perfect for what we're talking about today. We're going to dive into a really popular market strategy, one that can be, well, deceptively dangerous.
So let me ask you this. What if being 100% right about the market could actually lead you straight to disaster? I know, it sounds like a total paradox, right? But it's a very, very real trap that a lot of people fall into, especially when they rely on a method called fundamental analysis. All right, let's get into it.
Okay, so let's start by digging into the core problem here, the real trap when you're using only fundamental analysis to make your market decisions.
Okay, so what's the real difference here? Well, think about it like this. A technical trader, they're all about price. They follow the charts, so if they're wrong, the chart itself will eventually scream at them, hey, you're wrong, time to get out. It's kind of self-correcting. But a fundamental trader, they're focused on this idea of a correct or intrinsic value. So when the market moves against them, something funny happens. Instead of thinking they're wrong, they often become more convinced they're right. They just think, wow, it's an even bigger bargain now. And you can see how that can be a complete recipe for disaster.
Yeah, and that experience, it can be so painful. Mark Twain's quote here really hits the nail on the head. You get burnt once, and you never want to go near that stove again, right? A lot of people just completely abandon fundamental analysis after a bad experience. But here's the thing. The problem isn't the tool itself. The problem is not understanding its limitations.
All right, so let's break this down. There are 3 major pitfalls you can fall into, even if you think your fundamental model is absolutely perfect.
Okay, pitfall number 1. This is the one you can't see it coming. It's the classic black swan event. Something happens that just completely rewrites the rulebook for the market overnight. Take this, for example, an unexpected freeze. You could have done months, literally months, of careful supply and demand analysis on orange juice, and then bam, One cold night and all of that work is completely worthless. The price just goes vertical. And weather, I mean, that's the classic example, right? It's this huge, unpredictable factor that no financial model can ever truly forecast. Just one bad season, one drought like this one, and the entire landscape for a commodity like corn can be turned on its head. And sometimes it's a massive natural disaster, something that makes every single economic prediction that came before it totally irrelevant. And it happens in a matter of hours, not weeks or months. So that's the first pitfall. Now for the second one. This is when your model is missing a crucial piece of the puzzle, mainly because that piece didn't even exist when you built the model. Think about a sudden, unexpected wave of inflation or a dramatic spike in interest rates. Something that fundamentally changes how investors think and behave across every single market. But, the most common, and I'd argue the most dangerous pitfall of all, is simply getting the timing wrong. Even when your analysis is absolutely 100% spot on. Yeah, pitfall #3, poor timing. And for this one, there's no better case study, and a really painful one at that, than the 2008 financial crisis. It's just a perfect example of this dangerous timing lag. Just look at this chart. It's incredible. An analyst could see home prices, that's the bottom line there, clearly peaking way back in the middle of 2006. I mean, the fundamental writing was on the wall for everyone to see. And yet, the stock market, that top line, it just kept on climbing for another year and a half. And this is what's really wild. The market was just completely ignoring these massive danger signs. You can see the subprime delinquencies, that lower line, just shooting straight up. They were doubling. And the S&P 500, it just kept powering higher. It was like the party was never going to end. So here's the bottom line, the really crucial point. An analyst who saw this coming, who was ultimately proven spectacularly correct, could have been completely wiped out, down 20%, long before the market ever turned in their favor. And that's the lesson. Being right too early is, for all practical purposes, the exact same thing as being wrong. Okay, so if using fundamental analysis all by itself is so dangerous, what's the answer? Do we just throw it out? No, not at all. The solution isn't to abandon it, but to build a much more complete, a more robust approach. So here it is. The answer is to combine these three pillars. Use fundamental analysis to figure out if a market is mispriced, to find the opportunity. Then you use technical analysis to help you with the timing, to tell you when the market agrees with you. And finally, and this is maybe the most important part, you use good money management to make sure that if you're wrong, you live to trade another day. And this right here, this is maybe the single most important rule to take away from all of this. You can never, ever hold a fundamental opinion with complete rigidity. You have to be willing to listen to the market. The price action is the ultimate judge and jury, no matter how good your spreadsheet looks. So you might be thinking, okay, if it's not a great timing tool, then why even bother with fundamental analysis at all? And that's a great question, because this is where we get to its true power. See, fundamentals, they give you the why behind the moves. They're the context. They help you tell the difference between just a little bit of noise, a temporary blip, and a real major shift in the market. And maybe most importantly, they give you the conviction, the confidence to stay with a winning trade instead of getting shaken out by all the day-to-day noise. And this chart, wow, this is a brilliant illustration of maybe the most sophisticated way to use fundamentals. It's not about the news itself. It's about watching how the market reacts to the news. So look here, right at the arrow. The cotton market got some incredibly bullish news about exports. You'd expect the price to soar, right? But look what happened. It got a tiny little pop, and then it just fizzled out. It completely failed to rally. That weak response, that was the real signal. It was a massive warning sign that the bulls were exhausted and the trend was done. And that brings us to this key rule. When you see a bullish development, great news, but the price just kind of yawns and gives a weak response, you should actually see that as a bearish signal. It's the market's way of telling you that all the good news is already baked into the price. There are no more buyers left. And so that leaves us with one last kind of deep question to ponder, right? Is it the news that actually moves the market? Or does the market just move and then we humans rush around to find a news story that fits the narrative? Maybe, just maybe, the real value of fundamental analysis isn't about predicting the future at all. Maybe it's about understanding the market's present state of mind. Have you ever felt like you're just guessing which way the market is going to go, up, down, it can feel like a total coin flip. But what if I told you there's a way to trade that's less about predicting the future and a whole lot more about managing the present? Well, today, we're going to pull back the curtain on spread trading. It's a really powerful tool that can help you trade smarter, not just harder. Okay, this little limerick, it's not just a silly rhyme, you know? It's a genuine warning. Spread trading is kind of like having a safety net. It can make you feel a little too brave. It's an absolutely fantastic tool, but just like any sharp instrument, you have to know how to use it or you're going to get hurt. So let's learn how to wield this thing with some real confidence and precision. You know, it's funny. A lot of new traders see the word spreads and they just run the other way. They think it's some super complicated strategy that's only for the Wall Street pros. But the irony is, spreads can be an incredibly useful way to manage your risk, especially if you're someone who doesn't want to take on the massive exposure of a straight-up buy or sell position. All right, so what is this mysterious spread we keep talking about? Let's peel back the layers and get right to the heart of it. Honestly, you might be surprised by how simple the core idea really is. So here's the official definition. But the magic word, the one you really got to focus on, is simultaneous. You're buying one futures contract and selling another one at the exact same time, all in a single transaction. And these contracts are related. That could mean the same commodity in different months or two different but connected commodities. This whole thing creates a single position that's all about the relationship between those two contracts. This slide right here, this gets to the absolute core of why spread trading is so different. When you make a regular trade, you're basically asking one question. Is the price going to go up or down? But with a spread, you're asking a much more subtle question. You're asking, is the gap between these two prices going to get bigger or smaller? And all of a sudden, the overall direction of the market isn't the only thing that matters anymore. It's a total shift in perspective. Okay, so we know what it is, but why? Why would you actually do it? What are the real, tangible advantages of taking this more nuanced approach to the market? So why even bother with spreads? Well, the advantages are huge. First off, they act like a shock absorber in really bumpy, volatile markets, which can seriously smooth out the ride. They can also give you a better bang for your buck, offering some really attractive reward-to-risk ratios. Think of spreads as your shield against those terrifying overnight price swings that can just blow up an account. And as a cool bonus, they can actually give you clues about where the outright market might be heading next. Look at this chart. This picture says it all. The crazy, jagged line at the top, that's the price of coffee back in 2014. It was an absolute roller coaster. Now, look at the bottom line. That's the spread. See how much smoother that is? A trader could have used this bear spread to profit from those falling coffee prices without all the stress and sleepless nights that came with trying to trade that wild top line. Now that you get the why, let's dive into the how. Spreads basically come in three main flavors, and each one has its own unique personality. First up, and this is the most common one, is the intra-market spread. You can think of this as a bet on time. You're trading the exact same commodity, let's say corn, but in different delivery months. So if you buy December corn and sell March corn, you're making a bet on how the supply and demand for corn is going to change over those next 3 months. Next, we've got inter-commodity spreads. This is where you're basically playing matchmaker, or maybe setting up a rivalry, between two different but related commodities. Think of it like a tug-of-war between wheat and corn. If you think wheat is a real bargain compared to corn right now, you can buy the wheat and sell the corn, betting that the price gap between them is going to stretch out in your favor. And finally, there are intermarket spreads. These are a bit like being a globe-trotting bargain hunter. You're buying the exact same product, like cocoa, but in two different places, say on the New York Exchange and the London Exchange. You're profiting from the tiny price differences between them. It's all about finding and exploiting those little inefficiencies in the global market. Now, for a lot of those intra-market spreads we talked about, there's a pattern, a kind of general rule that can help traders get a sense of how they might behave based on what the overall market is doing. Okay, so here's a super handy rule of thumb. For stuff you can store, like grains or sugar, when the market is hot, a bull market, people want it now. So the price for the nearby delivery month tends to go up faster than the later months. But, and this is a big but, this is not a one-size-fits-all rule. For precious metals like gold, the opposite is often true. And for things you can't really store, like live cattle, there's no predictable pattern at all. The key takeaway here, you've got to know your market. Hey, remember our friend Fred from the Limerick at the beginning? Yeah, he learned the hard way that even a safety net can have some serious holes in it. Spreads are a fantastic way to manage risk, but they are absolutely not foolproof. So let's talk about the common pitfalls that can turn a really smart strategy into a very costly mistake.
All right, here are the big don'ts of spread trading. Number one, don't get greedy. That was Fred's big mistake, right? The lower risk can be really seductive, but look, a small loss on a huge position is still a huge loss. Also, don't try to be a hero and leg out of your trades one side at a time. Always close both sides at once. And of course, the basics still apply. Do your homework, make sure there's enough trading activity so you can get out when you want to, and always, always have a plan to limit your losses.
So, at the end of the day, is spread trading some kind of holy grail? Not exactly. It's a powerful, sophisticated tool, but it is not a substitute for discipline and for knowledge. The real question this leaves us with is, can you handle that power? Because lower risk is only an advantage if you use it wisely. If it just gives you a license to be reckless, well, then you might be better off sticking to the basics.
All right, let's dive into something wild today. We're going to look at a fascinating puzzle from the world of trading. A scenario where you can be totally right about the market, you nail the prediction, and you still end up losing thousands of dollars. How on earth is that possible? Well, let's find out.
And this quote right here, it's going to be our guiding star for this whole thing. It really gets to the heart of it. The huge difference between just glancing at something on the surface versus really, truly analyzing it. In trading, just like in life, what you see at first glance is almost never the full story. You've got to weigh the details.
So let's just get right to it. Can you actually be right? Nail the market's direction and still watch your account go down? The answer, which is kind of shocking, is a big yes. And it usually happens because of a super common, really intuitive, but also very dangerous mistake.
Okay, so let's break this down. First up, the one-to-one trap. This is where we'll look at a textbook example of how a brilliant idea can somehow turn into a losing trade.
The trap itself, it starts with something that sounds totally reasonable, right? If you're trading a spread, betting on the price difference between two related things, you just buy one and you sell one. Long one contract, short one contract. Seems simple, it seems balanced, but as we're about to see, that simple logic is deeply flawed.
Okay, so here's the setup. Picture this trader. They've got a great thesis. They think the price of lower quality Robusta coffee, which trades in London, is going to fall away more than the higher quality Arabica coffee that trades in New York. So to make that bet, they short 5 contracts of London coffee and they go long 5 contracts of New York coffee. A perfect, classic one-to-one spread.
But right here, this is the first clue that something's off. It's one of those details that's staring you right in the face, but it's so easy to overlook. The contract sizes, they're not even close. A New York contract is for 37,500 pounds of coffee. A London contract, just over 22,000 pounds. They are not the same thing at all.
And this is where it gets crazy. The trader's prediction? It was perfect. Spot on. The London coffee they were short, it dropped by 15 cents a pound. The New York coffee they were long, it only dropped by 10 cents. The spread did exactly what they thought it would do. This has to be a win, right?
Wrong. So wrong. The trade was a total loser. That 10-cent loss on the New York side got applied to those much bigger contracts, leading to a loss of over $18,000. That completely wiped out the $16,000 gain from the smaller London contracts. So, the final tally? A shocking loss of over $2,000, all because the trade wasn't balanced properly.
So what on earth happened? And more importantly, how do we fix this mess? That brings us to our next step, the first fix, which is all about equalizing the units.
Okay, so the first fix is pretty intuitive. If the contracts aren't the same size, well, then don't match the number of contracts. Instead, you should match the total amount of the stuff you're actually trading. The goal is to be long the exact same number of pounds of coffee as you are short.
And the math here is super straightforward. You just divide the big contract size by the small one, and you get a ratio of about 1.7. So that tells us for every 1 New York contract, you need about 1.7 London contracts. So the closest you can get with whole numbers is trading 3 New York contracts against 5 London contracts. That gets the total weight on both sides of the trade almost perfectly matched up.
And check this out. When we run the numbers with this new 3-to-5 ratio, boom, that losing trade is suddenly a winner, pulling in a profit of over $5,000. That is a massive improvement. But Here's the thing. This still isn't the perfect fix.
Because, even this better approach has a deeper, more hidden flaw. And that brings us to the problem of value.
See, equalizing the weight is great. But what if the price of the two things is just worlds apart? A 10-cent move in something that's cheap is a totally different ballgame than a 10-cent move in something that's super expensive.
And this gets to a really, really important idea. The equal unit spread protects you if both things move by the same dollar amount. But that's not really how markets work, is it? It's much more likely they'll move by a similar percentage. I mean, a 1% move on a $100 stock is $1. A 1% move on a $1,000 stock is $10. That percentage relationship is what really matters.
To really hammer this home, just think about a gold versus silver spread. To get the same number of ounces on both sides, you'd have to trade something insane, like 50 contracts of gold for every one silver contract. I mean, come on, that's not a spread, that's just a massive lopsided bet on gold, all because gold is so much more expensive per ounce.
And all of this, it leads us to the real aha moment. The ultimate solution. The one that handles differences in both the size and the price. It's the equal dollar value solution.
So here it is, the big idea. You set up the trade so the total dollar value on your long side is exactly the same as the total dollar value on your short side. That's the goal. When you do that, your spread is now neutral to equal percentage moves, which, again, is how the world actually works.
Now, don't worry, we're not going to do a full math lecture here. But the key is you're multiplying the size of the contract by its price for both New York and London coffee. And when we do that for our trade, we get a totally new ratio. It turns out the truly balanced spread is 1 New York contract for every 3 London contracts. Not 1-to-1, not even 3-to-5, it's 1-to-3.
And just look at what happens. We apply this new correct 1-to-3 ratio to the exact same trade, and the result is just staggering. That original $2,000 loss doesn't just become a profit, it becomes an $18,000 gain. That is the difference between just seeing the market and really weighing the value. Okay, I know, that was a ton of numbers. So let's actually look at why this works. We've got some visual proof that it's all about tracking the ratio, not the simple difference.
So on the left, this is the simple price difference between wheat and corn, just one minus the other. But look at the chart on the right. This is their price ratio. They're telling two completely different stories, right? The one on the left looks like it's in a downtrend, but the one on the right looks like it's just chopping around sideways.
Okay, now for the real magic. On the left, there's that price ratio chart again. And on the right, you see that? That's the actual P&L, the profit and loss, of a correctly weighted equal dollar value spread between wheat and corn. Look at them. They're basically identical. This is the proof. A properly built spread doesn't track the simple price difference at all. It tracks the price ratio.
So, let's just wrap this all up. We started with the naive approach, just seeing the trade and going one for one, which we saw can be a disaster. Then we got smarter and started to weigh the units, which is a lot better. But the best way, the real way, is to weigh the value and make sure your dollar exposure is perfectly balanced. That's what lets you track the true relationship.
And that really brings us to the big takeaway here. This whole thing isn't just about trading coffee. It's about looking past what seems obvious. So I'll leave you with this question. What are the obvious one-to-one assumptions you're making in your own world, in your own work? What deeper truths might you find if you stopped just seeing and really started to weigh?
All right, let's dive into a really fascinating corner of the markets, stock index futures spreads. Now, this isn't your typical bet on whether the market's going to go up or down. No. This is a much more sophisticated strategy, one that's all about trading the relationship between different prices. So, let's break down how it all really works. Here's how we're going to tackle this. We'll kick things off with a basic concept, betting on the difference. Then, we'll get into the secret sauce, the dividend twist. After that, we'll look at spreads between totally different markets, figure out how to actually structure these trades using ratios, and then wrap it all up by looking at what the historical charts have to say about all this. So, here's the big question that gets us started. Let's say you've got a hunch. You think tech stocks are about to crush it and outperform industrial stocks, but you have absolutely no idea if the entire market is about to rally or tank. So how do you trade just that one specific idea? Well, that's exactly where spread trading comes in.
Okay, let's start with the absolute basics. Section 1. When we talk about trading a spread, what are we even talking about? What are you actually betting on?
It's all about something called relative value. You honestly don't care if the S&P 500 is at 4,000 or 5,000. What you care about is the difference between, say, the December S&P contract and the March S&P contract. Your profit or your loss comes from that gap, that spread, getting wider or narrower.
You know, to make this easier to grasp, let's use a simpler example, like gold. The price difference between two gold futures contracts is pretty much just about one thing: the cost of financing, basically the interest you'd pay to hold that gold over time. Stock index spreads are kind of like that, but they've got this one extra twist, a twist that changes the whole game.
And that critical difference, that one little variable that makes stock index spreads so incredibly unique, well, it all comes down to dividends. Okay, I know what you're thinking when you see this. A formula. But hang on, don't let your eyes glaze over. I promise, this thing is telling a very simple story about the forces that shape the price of a spread. Let's just pull it apart, piece by piece. So here's the breakdown. P2 minus P1, that's just the spread itself, the thing we're trying to figure out. And its price is basically decided by a constant tug of war between two things: the interest rate, which is the cost of holding all those stocks, and the dividend yield, which is the income you get from holding them. It's just cost versus income. And here's how that tug of war plays out. If the interest rate, that cost to hold, is higher than the dividend income you're getting, well, the future price has to be higher to make up for that cost. That's what we call trading at a premium. But if the dividend income is higher than the interest costs, the future price can actually be lower. That's called trading at a discount. Simple as that. Okay, so what we've been talking about so far are spreads on the same index, but with different expiration dates. That's cool. But now let's level up and look at something even more powerful: spreading two completely different stock indexes against each other. This is where you can get really creative and put a very specific market opinion into action. Instead of trading on time, you're trading a relationship. So you could, for example, go long the tech-heavy NASDAQ 100 and short the more industrial Dow Jones. You're betting that tech is going to win out no matter which way the overall market tide is going. And the most popular place to do this is with the 4 major U.S. stock index futures. You've got the S&P, the NASDAQ, the Dow, and the Russell. If you pair them up, you get 6 possible spreads you can trade, and each one tells a different story, like large companies versus small companies, or the tech sector versus the entire market. But wait a minute, how do you actually build one of these trades? I mean, it's not as simple as just buying one contract and selling another one. You got to get the size of your bet right. And this is the absolute key takeaway. You have to remember this. You see, because these indexes all trade at different prices and have different contract sizes, trading them one for one would be totally unbalanced. You have to think in ratios to make sure the dollar value on both sides of your trade is the same. Let's make this real with a quick example. First, you figure out the total dollar value of one contract of each index. So, one NASDAQ contract is worth 86 grand, one Russell is 115 grand. Step 2, you find the ratio between them. Then, for the final step, you flip that ratio upside down to figure out how many contracts you need on each side to be dollar neutral. So the math might say for every one Russell contract, you need 1.3 NASDAQ contracts. Now, of course, you can't trade a fraction of a contract, so in the real world, you'd round that to something like trading 3 Russells against 4 NASDAQs to get the dollar values as close as you can. So why do we do all this math? What's the point? The whole goal is to create a trade that doesn't really care about what the broad market is doing. If both indexes jump up by 5%, your overall position shouldn't really change much. You only make or lose money if one index moves more or less than the other on a percentage basis. You've basically isolated the thing you actually want to bet on, their relative performance. All right, now for the really fun part. Enough with the theory. Let's pull up some charts from 2002 to 2015 and see how these relationships actually behaved out in the wild. First, just a quick confirmation that our thinking is on the right track. On the left, you see the contract value ratio for the S&P versus the Dow. On the right, it's just the simple price ratio. Look at that. The patterns are exactly the same. So this is just great visual proof that we can just track the simple price ratio to analyze these spreads. Now things start to get really interesting. This chart here shows the ratio of the Dow, the big established companies, to the Russell 2000, which is all about smaller companies. And would you look at that? There's a super clear inverse relationship. When the overall market was going up, the ratio went down. What did that mean? It means the smaller stocks in the Russell were outperforming the bigger stocks in the Dow. But, and this is what makes markets so fascinating, it's not always an inverse thing. Here's the S&P 500 versus the Dow. Now, they're both large-cap indexes, but the S&P is a bit broader. And here, the ratio tended to go up and down with the market. It just goes to show you that every single pair has its own unique personality. So, if you had to boil down the general vibe from this whole 14-year period, a pretty clear theme shows up. When the market was bullish and climbing, investors wanted growth, so they piled into smaller stocks. And those indexes did better. But when things got scary and the market fell, investors ran for the perceived safety of the big established companies, so those indexes didn't fall as much. And all of this leads us to one last really provocative question. If you look really closely at some of those charts, you'll see moments where the ratio seems to change direction just before the whole market does. So could tracking these relationships, the relative strength, the big stocks versus small stocks, could that actually give us a heads up about where the entire market is going next? Now that's some food for thought.
So let's talk about a really powerful strategy called spread trading. Imagine you've got a strong opinion. Say you think the Japanese economy is going to outperform Europe's, but you have no idea what the US dollar is going to do. Well, spread trading is how you can make that specific bet, Japan versus Europe, without having to worry about the US dollar at all. It's a way to isolate your idea and, potentially cut down your risk. Let's break down exactly how it works.
And we should start here, with this quote from John Maynard Keynes. It really gets to the heart of it, doesn't it? Currencies are, they're the lifeblood of an economy. Their value against each other is a huge deal. And today, we're diving into how traders try to navigate and profit from those constant shifts in value.
All right, here's our game plan. First, we're going to talk about the massive role of the US dollar. Then, we'll get into the fun part, how to pit two different currencies directly against each other. After that, we'll get even more advanced and look at how you can trade the same currency across different time horizons. And finally, we'll wrap it all up with the big takeaways you can actually use.
Okay, so before we can really get spreads, we have to start with a basic concept about currency futures. Those agreements to buy or sell a currency at a set price down the road. It turns out almost every single one of these trades has a silent partner.
So when you hear a trader say they're long the Japanese yen, what does that actually mean? They're not just betting it'll go up into thin air. No, what they're really saying is they are long the yen versus the US dollar. In pretty much every standard currency futures trade, the USD is the other side of the bet. It's the default opponent. Your profit, your loss, it all hinges on how the yen moves against the dollar specifically. And right there, that leads us to the big question, the whole reason we're here. What if your research tells you Japan's economy is set to boom, while Europe's might stumble, but you think the US dollar is a total wild card? How do you make that pure yen versus euro bet and just leave the dollar out of the equation?
Well, this is where our first kind of spread trade comes into play. It's called an intercurrency spread, and it's designed to do exactly that, let you pit two foreign currencies directly against one another, head to head.
The way an intercurrency spread works is you are simultaneously buying one currency's futures contract and selling another one's. So you're long one, betting it goes up, and short the other, betting it goes down. The whole point is to try and cancel out the influence of the US dollar, creating a direct contest between the two currencies you actually care about. And this comparison here just makes it crystal clear. On the left, you have your standard trade. It's a bet on the yen versus the dollar. But look at the spread trade on the right. Now, it's a pure bet on the yen strength relative to the euro. See what happened? We've completely changed the opponent in the ring.
But it's not quite as simple as just buying one contract and selling another. If you're not careful, you can accidentally bring back the exact risk you were trying to get rid of. There's a hidden trap here.
Let's look at this real-world example of that trap. A trader went long 4 Swiss franc contracts and short 4 euro contracts. Now here's the key part. The exchange rate between the franc and the euro. It didn't move at all. And yet, the position still lost a shocking $12,500. How is that even possible?
This is the million-dollar question, right? Or I guess, in this case, the $12,500 question. If your entire bet was on the Swiss franc versus the euro, and that relationship stayed flat, where in the world did that loss come from?
And here's the culprit. The trade wasn't balanced by its dollar value. Even though the number of contracts was the same, 4 and 4, their total worth in US dollars was way off.
The trader was long $500,000 of Swiss francs, but short $625,000 of euros. That imbalance created a secret, unintentional bet against the US dollar.
So how do you fix it? Well, you've got to balance the dollar values, not just the number of contracts. The proper way to do this trade, as you see here, would have been to go long 5 Swiss franc contracts versus short 4 euro contracts. Now, the dollar value on both sides is roughly equal, about $625,000 on each side. With that setup, if the franc and euro move in lockstep, your net profit or loss is zero. The unwanted dollar risk is gone.
And the great news is, traders don't have to eyeball this stuff. There's a specific formula for it, called the equal dollar spread ratio. You just plug in the numbers, and it tells you the exact number of contracts you need on each side to make sure those dollar values are perfectly matched. This is how you create a pure bet.
Okay, so now we're going to kick it up a notch. We've talked about pitting 2 different currencies against each other, but what if you could trade the same currency against itself, just at different points in time?
This is what's known as an intra-currency spread. Here, for example, you might trade the June euro contract against the December euro contract. It's the same currency, but the delivery dates are 6 months apart. So what are you really betting on here?
And this is the big reveal, the real aha moment. An intra-currency spread isn't really about guessing where the euro is headed. It is a really clever and surprisingly direct way to place a bet on the future difference between US and European interest rates.
Okay, so how on earth does the price difference between a June euro and a December euro tell us anything about interest rates? Well, it all boils down to a fundamental law of finance. There's no such thing as a free lunch.
Let's just walk through the logic here. Imagine you've got 2 choices for your money. Option A is simple. You stick $1 in a US bank account and earn US interest. Option B is a little more complex. You convert your dollar to euros, earn European interest, and then use a futures contract to lock in the exact rate you'll use to switch it back to dollars later. Now here's the key. In an efficient market, both of these paths have to give you the exact same amount of money in the end.
So why do they have to be equal? Because if one path was even a tiny bit more profitable, traders, called arbitrageurs, would pounce on it. These are folks whose entire job is to find tiny, risk-free price differences. They would instantly flood that trade with billions of dollars, and their own actions would immediately push the prices back into perfect alignment. Think of them like the market's police force, making sure no free lunch sticks around for more than a nanosecond. This whole powerful idea actually has a name. It's called the interest rate parity theorem, and it's basically a cornerstone of international finance. It says that the difference between a currency's price today and its price in the future is directly and mathematically linked to the difference in interest rates between the 2 countries.
Phew, okay. We've covered a lot of the theory. Now, let's pull it all together. How does a real trader turn all these concepts into an actual, actionable strategy?
This table right here is pretty much the ultimate cheat sheet. It connects what you think is going to happen to the trade you should make. Look at that first row. If you expect US interest rates to climb faster than, say, Japan's, the play is to buy the forward yen contract and sell the nearby one. Or check out the third row. If you think euro rates are going to gain on yen rates, you can actually combine 2 different spreads to isolate that very specific opinion. For every forecast, there's a spread trade.
You know, the biggest thing to take away from all this is that market prices are so much more than just numbers on a screen. The tiny spread between 2 futures contracts is literally a forecast for international interest rates, baked right in. And that just leaves us with a final, bigger question. What other powerful economic predictions are hiding in plain sight, embedded in the prices we all see every single day?
All right, let's dive into something really interesting today. Options on futures. Now, I know they can sound complicated, but they're an incredibly powerful tool. And over the next few minutes, we're going to pull back the curtain and show you exactly how they work. Nice and simple. So, let me ask you this. What if you were pretty sure a market was about to take off like a rocket? And what if you could hop on for the ride with all of that upside, but know exactly how much you'd lose if you were wrong? To the penny. Well, that's the fundamental promise of an option. It's what makes them such a fascinating tool.
So, here's our game plan. We're going to start with the absolute core concept of what an option is. Then we'll decode its price tag. We'll look at what actually gives it value, explore the 2 very different mindsets of the buyer and the seller, and wrap it all up with the single biggest takeaway.
Okay, first things first. Let's get right to the heart of what makes an option, well, an option. It's this one simple but powerful idea.
And here it is, the key phrase you've got to remember. The right, but not the obligation. Think about that. You're buying the choice to do something, to buy or sell a contract, but you are never, ever forced to. That flexibility, that choice is everything. It's the secret sauce that lets you cap your risk.
Now, options come in two basic flavors. First, you got a call option. This gives you the right to buy. You'd use this if you're bullish, if you think prices are going to go up. Then there's the put option. This gives you the right to sell, and you'd use this if you're bearish, thinking prices are about to drop. It's that simple. Calls for up, puts for down.
You know, I love this quote from Andrew Tobias because it just makes the idea of a put so much more memorable. He says you're basically getting a stick to stick it to the other person in the trade, forcing them to buy from you at a price they really don't want. It's a little aggressive, maybe, but hey, it's memorable, right?
Okay, so buying this right, this flexibility, it's not free. Of course not. It's got to have a price tag. And the price you pay for an option is called the premium. So let's break down what actually goes into that price.
Turns out it's actually pretty straightforward. The premium is made of just two things. First, its intrinsic value, which you can think of as its right now value, what it's worth this very second. And second, its time value, which is kind of like its maybe later value, the extra bit you pay for the possibility of it becoming even more valuable in the future.
And these charts show that perfectly. See that solid, straight line? That's the option's real, tangible, right now worth, its intrinsic value. But all that extra space, that shaded area above the line, that's the time value. That's the premium you're paying for pure potential, for what could happen.
So what exactly is this intrinsic value we're talking about? Well, it's the actual real money profit you'd make if you exercise the option immediately. If the futures price for something is 110 and you have a call option to buy it at 100, your option has $10 of intrinsic value. We call that being in the money.
But what about that other piece of the puzzle, that maybe later value, the time value? This is where things get really fun, because this is what you're paying for, pure potential. So what drives it?
It really boils down to two huge factors. The first is pretty obvious. How much time is left on the clock before the option expires? The more time, the more chances for something good to happen. And the second is the volatility of the market. Basically, how much the market is jumping around. Now, time is your friend, but it's a friend that's always leaving. Think of an option's time value like a melting ice cube. This effect is called time decay. And look at this curve. It's not a straight line. The value melts away faster and faster and faster as you get right up to that expiration date.
And that second driver, volatility. Just think of it as the market's wildness factor. A sleepy, flat market has low volatility. A market that's making crazy, huge swings every day has high volatility. And if you're an option buyer, you love wildness because it dramatically increases the chance of a huge price move in your favor.
And this isn't just theory. I mean, look at these numbers. For the very same option, with all else being equal, cranking up the volatility from a calm 10% to a wild 50% makes the price explode from just over $1,000 to nearly $6,000. Volatility is a massive, massive component of an option's price.
Okay, so we've been looking at this mostly from the buyer's point of view. But for every single buyer who's hoping for a home run, there has to be a seller on the other side of that trade. And their goals, their whole mindset, are complete opposites. It's like they're playing two completely different sports on the same field. The buyer is swinging for the fences. They accept that they'll probably lose their premium, but they do it for that shot at an unlimited reward. The seller, though, is playing a totally different game. They collect that premium knowing their profit is capped, but they have a very high probability of just keeping it.
This just begs the question, right? You look at the seller's column, you see unlimited risk, and you have to wonder who in their right mind would ever sign up for that. It sounds absolutely insane.
The answer, in 3 words, is the power of probability. The seller is literally playing the role of the casino, the house. They know that most options, the vast majority in fact, expire worthless. So they are willing to accept a tiny chance of a huge loss in exchange for a very high chance of collecting all those small, steady wins over and over again. All right, let's pull all these threads together. If there's one single concept, one big idea that you should walk away with from all of this, what should it be? It all comes down to one word: flexibility. That is what you are truly buying or selling. Options are just these incredible tools that neatly separate the right to take an action from the obligation to actually follow through.
And that separation, that choice, is where all the power lies.
So let's do a super quick recap. Calls are your bullish bet. Puts are your bearish bet. The price you pay, the premium, is made up of its right now value and its maybe later value. And that potential is fueled by time and volatility. And finally, buyers want home runs with limited risk, while sellers want to be the casino playing the odds.
And that leaves us with one final big question to chew on. When you look at this whole structure, the unlimited upside for one person, the casino-like odds for the other, where do options really fit? Are they a highly strategic tool for managing risk, or are they just a fancier, more sophisticated way to gamble? Something to think about.
All right, today we are jumping in to demystify one of the most powerful and maybe one of the most misunderstood tools in the financial world: options. Whether you're a pro or just getting curious, we're going to break down how they really work, and I promise it's going to be crystal clear.
You know, I love this quote because it just perfectly nails the central puzzle of options. How can something be a splendid thing for both the person buying it and the person selling it? I mean, that sounds impossible, right? But stick with me, because that's the exact puzzle we're going to solve today.
When you boil it down, trading often feels like a really simple two-way street. You think the price is going up, you buy. You think it's heading down, you sell. It's a world of straight lines, up or down.
But what if your prediction is, a little more specific than that? What if you think the price is going to go up, but only a little bit? Or what if you think it's about to absolutely explode higher? Or, get this, what if you think it's not going to move at all? That simple buy or sell world doesn't really have a way for you to make those kinds of bets.
And this is where options come into play. See, they're not just another way to bet on which direction the price goes. Think of them as a whole new set of sophisticated tools that let you build strategies around how much things move, how fast, and even when. It's a complete expansion of the trader's toolbox.
So to really understand these tools, we need a kind of blueprint. And in trading, that blueprint is called the profit/loss profile. Honestly, this is the key to visualizing everything we're about to cover. Once you get this, you get options.
It might look a little technical, but it's actually a super simple and powerful graph. Okay, so the horizontal line at the bottom, that's just the price of the asset. The vertical line shows your profit or your loss. Anything on the graph that's above that center line, that's profit. Anything below is a loss. Simple, right? So let's start with the most basic trade there is, just buying something or going long. The profile is a perfect straight line. As the price moves to the right, as it goes up, your profit goes right up with it, potentially forever. But, and this is a big but, the reverse is also true. If the price goes down, well, your losses can also be unlimited. This is our starting point, our baseline.
And now look at this. It's the perfect mirror image. This is a short position where you're betting the price will fall. As the price moves to the left, as it goes down, your profits go up. It's the exact opposite of being long. So, there you have it, our two basic tools, one for betting up, one for betting down.
Okay, now for the fun part. Let's start building on that. We're going to add our first new tool for when you think the price is headed up, buying something called a call option. So what is a call option? It gives you the right to buy an asset at a locked-in price, which is called the strike price. You pay a little bit of money for this right, that's called the premium. But here's the magic part. You don't have to buy it. It's an option, not an obligation. That's the whole game.
And just look at this profit profile. It's totally different. This is for what's called an at-the-money call. All that means is its strike price is right around the current market price. But see that kink in the line? That flat part at the bottom is everything. It shows that no matter how far the price crashes, the most you can ever lose is the premium you paid. But on the upside, your potential profit is still unlimited. This lets you bet on a stock going up, say right before an earnings report, without risking a total wipeout if the news is terrible.
But what if you want to risk even less money? Well, you could buy an out-of-the-money call. That's where the strike price is above the current market price. As you can see, it's way cheaper, so your maximum loss is much smaller. The catch? The price has to move a whole lot further just for you to break even. This is your classic lottery ticket trade, a low-cost bet on a massive, unexpected move. Then again, you could go the other way and buy an in-the-money call. Here, the strike price is below the current market price. Now, it's a lot more expensive, and its profile looks an awful lot like just buying the stock.
but that little flat part at the bottom makes all the difference. It acts like a built-in insurance policy, capping your loss if the market totally tanks. So you get almost all of the upside of owning the stock, but with a hard floor on your risk.
So, here's the main takeaway. There's no single best way to be bullish. A trader can literally pick the exact tool from their toolbox that fits their prediction. Do you want something cheap? Do you want something with a higher probability of success? Or something that acts like the stock but with protection? You choose the option that matches your forecast.
So that's the bullish playbook. But what if you think the price is going to fall? Well, for that, we turn to the other side of the toolbox for a different kind of option.
Meet the put option. It's basically the mirror image of a call. It gives you the right, but not the obligation, to sell an asset at a specific strike price. It is the perfect tool for betting on a price drop.
And its profit profile is, well, it's exactly what you'd expect. Your loss is capped at the premium you paid. You see that familiar flat line at the bottom. But if the price completely collapses, your profits can be huge. This is incredibly powerful. It lets you, for example, protect your stock portfolio from a market downturn without actually having to sell all your stocks. It's all the power of a short position, but with a risk that is strictly defined from the start.
Okay, so up to now, we've only talked about buying options. But for every single buyer, there has to be a seller. So let's flip the script and see what the whole trade looks like from their side of the table.
And here it is, the big reveal. On the left, that's the profile for buying a call. We've seen that, but on the right, that's the profile for selling that exact same call. It is a perfect upside-down mirror image. Where the buyer has limited risk, the seller has limited profit. And this is the scary part. Where the buyer has unlimited profit potential, the seller has unlimited risk.
And this right here shows the fundamental trade-off that's at the heart of every single options trade. The buyer pays a premium for a shot at the moon, a chance for an unlimited win with very limited risk. The seller, on the other hand, collects that premium. They accept that unlimited risk in exchange for a limited profit, but a profit that has a much higher probability of happening.
So we're right back where we started. Is it better to be the buyer or the seller? The buyer is swinging for the fences, right? They're hoping for that one massive home run. The seller? They're happy to just get on base, again and again, playing the odds. So you have unlimited profit potential versus better odds of success. The question is, who is making the smarter bet? And that is the fundamental question every single options trader has to answer for themselves.
So let me ask you something. Is your trading a serious business, or is it more like a trip to the casino? Today, we're going to break down a framework from the legendary author Jack Schwager. It's all about how to transform trading from a high-stakes gamble into a disciplined, planned profession. Let's dive in. You know, this quote just hits the nail on the head. In the markets, wealth you might have spent months building up can literally vanish in minutes if you don't have a solid plan. The stakes are just incredibly high, which is why having a structured approach, well, it isn't just helpful, it's absolutely essential for survival. And this really shows the two paths you can take. On one side, you've got the gambler. They're all impulse, hot tips, and some vague market feel. Then on the other side, you have the professional. They operate with a sharp, well-defined, and disciplined plan. Guess which one succeeds? Every single successful trader falls into that second camp. And this explainer is all about giving you the blueprint to get there too. So here's our roadmap for today. We're going to start with why a plan is totally non-negotiable. Then we'll get into building your foundation, mastering risk, super important, creating a documentation routine, and finally, learning how to analyze your own performance so you can keep getting better. All right, Section 1, Plan or Perish. And that name is no exaggeration. This is the core principle. If your goal is to actually make money consistently and not just, get a thrill, then that shoot from the hip style is a guaranteed recipe for disaster. So that brings us to Section 2, building your foundation. This is where the real work starts. We're talking about defining your core philosophy and then deciding which markets you're actually going to trade in. First things first, you have to define how you're going to make decisions. And a vague answer like, I just have a feel for the market, well, that's not a strategy. You have to ask yourself, am I using chart analysis? If I am, which specific patterns am I looking for? Am I using technical systems or fundamental analysis? The real key here is that you need to be able to explain your method with real precision. The more specific you can get, the better off you'll be. Okay, next up, you have to choose your arena. And don't just pick markets randomly. You got to consider three things.
First, suitability. Do these markets actually work with your strategy? Second, diversification. And this is a big one. Choosing unrelated markets is one of the best ways to slash your risk. And third, volatility. Look, if you have limited funds, you should probably steer clear of the super volatile markets, where one wrong move can wipe you out. And that brings us perfectly to Section 3, Mastering Your Risk. Look, I can't overstate this. The rigid, disciplined control of your losses is the single most critical part of successful trading. If you get this wrong, I'm telling you, nothing else you do matters. So here is your first hard and fast rule. You should never, and I mean never, risk more than 2% of your total trading equity on any single trade. This isn't just a suggestion. It is a fundamental rule for long-term survival in this game. And in fact, the real pros, they often aim even lower than that. The real sweet spot for risk management is 1%, or maybe even less. Sticking to a number like this forces you to be disciplined and prevents any one bad trade from completely blowing up your account. This might just be the most important sentence in all of trading. Before you even think about clicking that buy or sell button, you must have a predetermined exit point if the trade goes against you. Without that, you're just leaving yourself wide open to hope, fear, and procrastination. And those are the exact emotions that lead to catastrophic losses. Now, beyond that single trade rule, your risk plan needs a few more tools in the toolbox. This includes diversification across different, unrelated markets, dialing back your size in markets that are highly correlated, trading fewer contracts when things get extra volatile, and, of course, making sure your position size grows or shrinks right along with your total account equity. Okay, on to Section 4, the discipline of documentation. You know, a great plan is totally useless if it just sits in a drawer. This section is all about turning your strategy into a concrete, daily routine that you actually follow. Every single evening, just set aside 30 to 60 minutes for this simple 3-step routine. Step 1, update your charts and systems. Step 2, plan out any potential new trades for the next day, and that includes your entry and exit points. And Step 3, review all of your open positions and adjust your stops to lock in profits or reduce risk where you can. It's this simple habit that builds true, lasting discipline. All right, this right here is your command center, the trader spreadsheet. This is where you systematically track all the hard numbers for every single trade. Your entry price, your initial stop, your current stop, your risk as a percentage of equity, and of course, the final profit or loss. This is the quantitative backbone of your entire trading business. But, you know, numbers only tell half the story. The other essential tool is your trader's diary. Think of this as the qualitative side of the coin. It's where you record the why behind the numbers, the story, the psychology, and all the critical lessons you learn from each and every trade. So, what goes in the diary? It has to include 3 things. First, the reasons you entered the trade, and you have to write this down at the time of entry, not after the fact with hindsight. Second, comments on your exit. Was it a good, disciplined decision or a bad, emotional one? And third, the lessons learned. Actually writing down your mistakes and your successes is an incredibly powerful way to reinforce good habits and get rid of the bad ones. And all of this work leads us to our final and maybe most important section, becoming your own analyst. All this data you're collecting is basically gold, but it's only valuable if you actually use it to find and sharpen your unique edge in the market. And here's the bottom line on that. Professional traders don't just analyze the markets, they relentlessly analyze their own performance. Your personal trading data is the most valuable data you have, period. This is where you can really start to find those hidden patterns in your own trading. By breaking down your trades into different categories, you can make some powerful discoveries. For example, you might analyze by market and, boom, realize you consistently lose money trading oil. Or maybe you'll find your short trades are way more profitable than your long trades. You might even discover that all your day trading is actually a net negative, or that one specific chart pattern works incredibly well for you. See, this analysis has one simple, incredibly powerful goal. It allows you to systematically do more of what works and a whole lot less of what doesn't. This is how you really refine your edge and truly improve over time. And that really is the key takeaway from all of this. A planned, documented, and analyzed approach is what elevates trading from a game of random chance into a structured, manageable business, one with a real shot at long-term success. So I'll just leave you with this one question to think about.
When you really look at your own methods, are you holding a business plan or are you just holding a lottery ticket? The choice ultimately is yours.
So, Jack Schwager's 75 Trading Rules. This book basically takes decades of hard-won market wisdom and boils it all down. And in this explainer, we're going to distill it even further. We're going right for the essential rules that honestly make all the difference between the pros and everyone else.
You know, this quote really hits on a core truth in trading. No matter how smart you are, the market is going to prove you wrong eventually. The real problem is, the best advice for dealing with this, stuff like cut your losses, we've heard it so many times it just sounds like a cliche, right? We all know it. But, and this is Schwager's whole point, almost nobody actually does it.
I mean, let's be real. This is the rule. It's the one thing that could, all by itself, save a trader from going bust, and yet, it's the one we break over and over again. Honestly, ignoring this one little piece of advice is the absolute fastest way to blow up an account.
So that brings up the big question, doesn't it? Why is the single most important advice also the hardest one to stick to? Well, it all comes down to that huge gap between knowing what you're supposed to do and having the guts and the discipline to do it when your own money is on the line.
Okay, first up, the trader's dilemma. Let's really dig into this fundamental battle between our brain and our gut that every single trader has to face.
In this dilemma, it creates this really painful cycle. You hear some bit of proven wisdom and you kind of roll your eyes, thinking, yeah, I know. Then you go out and learn that same lesson the hard way by losing money. And the worst part? It often takes getting punched in the gut a few times for that lesson to really finally sink in. Everybody agrees that risk control is everything, but the discipline to actually do it, that's what's so incredibly rare.
Section 2. Build your trading foundation. Look, the solution here isn't some secret indicator or a magic formula. It's all about building a solid, disciplined plan before you even think about placing a trade.
So one of Schwager's first rules is all about focus. Think about it like this. The huge majority of your money, your attention, and your real brain power should go into your major, well-thought-out trades. All that other stuff, the short-term noise, the little day-to-day gambles, that should only ever be a tiny fraction of your risk. This is so crucial. Your biggest trades have to come from calm, deliberate planning. They can't be a gut reaction to a squiggly line on a chart. One of those is driven by logic, the other is pure impulse. And that impulse? That's the fast track to making emotional decisions. And you know where that leads? Losses.
Now for Section 3, master your risk. Okay, this is it. This is the heart and soul of survival and trading. According to Schwager, this part is absolutely 100% non-negotiable.
This quote just nails the professional mindset because it is the exact polar opposite of what a struggling trader does. See, the amateur is run by their emotions. They're hoping their losers will magically turn around, and they're terrified their winners are going to disappear any second.
The losing strategy is just like watering your weeds and cutting your flowers. It makes no sense. It's all based on hope and fear. You let your losses get bigger and bigger while you snatch these tiny little profits. The winning strategy is the opposite. It is ruthless discipline. You nurture what's working and you kill what isn't immediately.
So how do you actually force yourself to be this disciplined? Well, your number one tool is the protective stop. And listen, this isn't just a number you put on a screen. It's your pre-planned escape hatch. It's the eject button. It's the point where you say, okay, I was wrong, and you live to trade another day.
So here's the question you have to ask yourself every single time. If the answer is no, then you don't have a plan. You have a gamble. Having that exit point defined before you get in is the absolute bedrock of controlling your risk. All right, let's move on to Section 4. Let your winners run. So once you've gotten good at cutting your losers, you need the patience for the other half of the equation, letting your winning trades do all the heavy lifting for you. Because let's be clear, you are going to have losing trades. It's just part of the game. Everybody does. The entire strategy hinges on this one idea: making sure your wins are big enough to more than pay for all those small disciplined losses. You need one great trade to wipe out a whole bunch of small mistakes.
So how do you actually do it? Well, you have to fight that incredibly strong urge to just take a small profit to feel good. In fact, if a trade takes off in your favor right away, that's often a signal to stay put, not to bail. You can use tools like trailing stops, which let you lock in profits while still riding a trend for as long as it goes. Patience with your winners is just as important as being quick with your losers.
Okay, finally, let's talk about how all this becomes a career. Because successful trading isn't a finish line you cross. It's this constant process of learning, adapting, and always sharpening your edge.
You know, the secret to long-term success is a constant feedback loop. Step 1. Document every trade. Why you took it, what your plan was, how it turned out. This isn't optional, it's mandatory. Step 2. Stay plugged in. Review the market every day. And step 3, and this is the big one, use that diary to go back and tweak your own rules, learning from what actually happened, not what you wished would happen.
And here's one last pretty sobering warning. Discipline isn't a one-and-done thing. You don't just achieve it and then you have it forever. It needs constant vigilance. Because as Schwager puts it, the second you get lazy, the second you get complacent, all those old destructive habits are just waiting to come rushing back.
And so, we kind of end up right back where we started. The knowledge you need, it's not some big secret. The rules are simple, they're timeless. The real question, the final challenge, isn't about finding some hidden strategy. It's about finding the discipline inside yourself to actually follow the rules day after day after day.
For anyone serious about trading, Jack Schwager's Market Wizards books are basically required reading, but they're dense. So today, we're going to cut right to the chase and distill the absolute core lessons that separate the legends from everyone else, using their own words to guide us. This quote right here, this is the foundation for everything that follows. Every single market wizard lives by this idea of radical self-responsibility. No excuses, no blame in the Fed, no blame in the news. If a trade works, it's because you were right. If it doesn't, you were wrong. Simple as that. It's a tough pill to swallow, but it's the absolute starting point. All right, so let's kick things off by busting the biggest myth in all of trading. We have to get this out of our heads right now. There is no secret formula. There is no holy grail method that's going to print money for you. And you know what? This should be a huge relief. When Schwager interviewed these incredible traders, he found that their methods were all over the place. I mean, some were long-term fundamental guys, others were split-second chart junkies, some were literal polar opposites. The lesson isn't to find and copy someone else's magic system, it's to build one that is 100% authentically you. So if there's no secret method, then what is the secret? Well, all the wizards point to the exact same place. It starts with you. The real foundation of great trading isn't about the market, it's about the inner game. It all begins with some serious self-reflection, long before you ever even think about placing a trade. And that self-reflection boils down to one brutally honest question. Before you risk a single dime, you have to look yourself in the mirror and ask, why am I really doing this? What's the deep down motivation that's pulling you into this world? And the wizards are crystal clear about this. If you're in it for the excitement, the adrenaline rush, or some fantasy of easy money, you're not trading, you're just gambling. The true masters, the ones who last, are driven by something way deeper, a genuine passion for the puzzle of the market and an absolute commitment to mastering their craft.
This quote from Randy McKay just nails it. Your trading style has to fit your personality like a glove. Think about it. If you're a super patient person trying to day trade minute by minute, you're going to go crazy. If you're an impulsive person trying to hold a position for months, you're going to crack under the pressure. The second your method goes against your human nature, you've already lost the game.
Okay, so once you've done that internal work, it's time to build your blueprint. We're shifting from the why to the how, the actual practical process of creating a real, measurable advantage in the market.
So what is a trading edge? It's really simple. It's just the statistical advantage. It's the reason casinos are billion-dollar businesses. They don't win every single hand of blackjack, but they know that over thousands and thousands of hands, the odds are just slightly in their favor. Without that positive edge, all the discipline in the world won't save you. You'll just lose your money slowly instead of quickly. This might be the most important sentence in the entire Market Wizards series. It is the ultimate litmus test. If you can't sit down and explain your edge, what it is, and why it works, in a simple, clear way, then you don't have one. Period. End of story. So, how do you get that edge? Well, sorry, but there are no shortcuts. Every single wizard walked the same path, countless hours of research, patient observation of the markets, and just relentless, grinding hard work. You've got to remember, you're playing against some of the smartest people on the planet. You have to earn your right to win. All right, so you've looked inward, you've built a system that has a real edge. But you know what? A perfect plan is totally worthless if you can't execute it. Now we get to the hardest part of all, mastering your own mind when real money and real fear and greed are on the line. The foundation of mastering your mind isn't some complex psychological trick. It's a simple number, 1%. This is the golden rule you hear from almost every wizard. You never, ever risk more than 1 to 2% of your total account on any single trade. This one simple rule is what keeps you alive long enough for your edge to actually work. It's your survival mechanism. Discipline was the word Schwager heard over and over and over. And what does it mean? It means you know exactly where you're getting out before you ever get in. It means you accept that losses aren't personal failures, they're just a business expense. It means tuning out the noise from everyone else, taking full responsibility for every single outcome, and always, always doing what your system says is right, not what your gut feels is comfortable. And all that discipline brings us to maybe the most powerful metaphor for what a professional trader really does. And it all comes down to the art of patience. I mean, how perfect is that analogy from Mark Weinstein? The cheetah is the fastest thing on the savannah, but what does it do most of the day? It waits. It conserves energy. It doesn't just chase after every antelope it sees. No, it waits for the perfect setup, the baby, the one that's sick or limping. That is professional trading. It's supreme patience followed by sudden, decisive action when the odds are overwhelmingly in your favor. So you take all of this, the self-awareness, the statistical edge, the ironclad discipline, the cheetah-like patience, and it all leads to this final, kind of paradoxical idea. This is the true endgame. This is what mastery looks like. Now hold on. After everything we just talked about, the hard work, the grind, the discipline, how on earth can good trading be effortless? That sounds completely contradictory, right? So what does this actually mean? The paradox disappears when you realize you have to separate the preparation from the performance. All the hard work, the struggle, the sweat, that happens before the trade. It's the thousands of hours you spend doing research, testing your system, and training your mind. The actual execution, when the moment finally arrives, should feel smooth, intuitive, almost effortless. Think about a world-class marathon runner. They look like they're just gliding along, while the amateur next to them is red-faced and gasping for air. The pro's race looks effortless because the real work was done in the hundreds of miles they ran in training. Another wizard compared it to archery. If you're straining to pull the bow, your form is wrong. That feeling of effortless performance is the ultimate sign that you're in sync with the market. So there you have it, the journey from knowing yourself to building your edge to executing with discipline, all the way to that state of effortless mastery. Now, the real question is for you. Of all this incredible wisdom from the greatest traders who ever lived, which one of these lessons speaks to you the most right now? Which one will be the first step you take on your own path?